Good morning, everyone. I'm Brian Sazi. Alexis Christophorous has the day off. This is the first trade for New Year's Eve, Tuesday, December 31st. Trimming their gains, Wall Street aims to wrap up 2019 and the decade near record highs, but a late-stage sell-off is putting a damper on today's New Year's Eve bash. On the run, Nissan's former chief escapes Japan and somehow makes it to Lebanon despite being under house arrest for alleged financial crimes, why he insists he was a political prisoner. And no reservations. Ford fills up its pre-order list for the new electric Mustang crossover months before the vehicle hits the road. Is it a good sign for Ford's turnaround? Well, with all that said, folks, the amazing run in the markets in 2019 is today's big story. All good things must end, and today Wall Street is saying goodbye to a record year with a whimper. Right now, stock futures are down ever so slightly. Dow futures down about 38 points here after yesterday's surprising sell-off. But it comes on the heels of a truly amazing decade for the markets. Just look at these gains. The Dow is up 170%. The S&P 500 is up more than 180%. And the NASDAQ Composite is up nearly 300%. Big stuff here, folks. Editor-in-Chief Andy Serwer joins us now, along with Jared Blickery at the Wi-Fi Interactive Board. Good morning to you both. Andy, I was reflecting a little bit on the past decade, and we came here with the European debt crisis. Really, it has changed completely relative to 10 years ago.
Yeah, and it's interesting you say that there were some questions at the beginning of the decade. Of course, there were questions at the beginning of this year as well. Remember, I mean, it was not a pretty picture at all, and yet we recovered both for the decade and for the year very nicely. And I think if you could sum it all up, again, both for the year and the decade, one little acronym comes to mind: FANG. It was all about the big tech stocks, and you see the NASDAQ outperforming over the year and over the decade, and that's all about those tech names.
And one tech name that is not included in FANG, Microsoft. What a comeback story the past decade. It might be time to add them to FANG in some way.
Yeah, and of course there are other sort of shoulder FANG stocks as well, like that. And Microsoft, of course, yeah, they came all the way back. The stock peaked in 2000. It took them so long to come back. Hats off to Satya Nadella, the CEO there, who really brought Microsoft to a whole new level.
In with Steve Ballmer, out of this decade with Satya Nadella. But Jared, let's get over to you at the Wi-Fi Interactive Board. Interesting sell-off yesterday. Are you seeing any red flags in the market as we look to start 2020?
Just based on one day's price action, no. And there is kind of a temptation anytime you're at all-time highs to really kind of read into things when we see the biggest sell-off that we've had in nearly a month. But it's only been about 0.5%. So if we go up and we look at, let's say, the S&P 500, we'll look at a candlestick chart. Yeah, yesterday kind of sticks out a little bit. But, you know, the big question is, what are we going to be watching in the new year? We're going to get earnings in a couple weeks and a lot of 2020 forecasts. Those are going to be important. We got phase 2, maybe phase 3. Let's not get ahead of ourselves because phase 1 is not even completely inked yet. And we also have other things going on in the credit markets. We're probably going to see a lot of oil company bankruptcies this year, and we're going to want to take a look because usually credit deteriorates first. But so far, this is a very strong market. And I'll tell you what, too, I'm looking at the US dollar and it's finally selling off here, kind of breaking down, which is what you would expect if the global growth story, you know, that upswing that everybody's expecting is kind of in full force here.
And Jared, it has also been a year of extremely low volatility.
Yeah, I mean, if you look at the VIX, and we can take a look at that right here, and let's look at a year-to-date chart, actually 1 year, we can see we had a few peaks. So going back to January, we began this year with an elevated VIX because, you know, December was pretty bad last year, but then we had this spike on the trade war, and then we had a series of other spikes, but these are really low level. Volatility is something that people have been selling, and of course, we remember they were doing that into the beginning of 2018 as well. Then it really turned out well in February. People not really expecting a repeat of that. And then there's one other thing going on, which is the turbulence in the repo markets. And we're just not really seeing that today. There was some concern because of what the Fed has been doing, that there wouldn't be enough liquidity or credit, but it looks like that problem is probably not going to metastasize here.
And Andy, what do you think the big market theme will be to kick off 2020?
You know, it's hard to say. Everyone's looking for some sort of correction here. And that has to come, Brian, at some point. I mean, you cannot have the market up roughly 30% without reverting to the mean somehow over time. And you're going to hear a lot of people saying when the market's up this much, it actually goes up the next year as well. And of course, that's just an average. It's not actually really going to be a prognostication. And when you look over the decade as well, same kind of thing. I mean, the NASDAQ's up 4 times. Right, you had 100 grand in NASDAQ, is now 400K. And so you have to think that at some point, you're going to get underperformance to get back to that more historical 9%, 10% per year return. So I think that, though, the one thing to remember is technology, and technology is the trade of our lifetime. So dollar averaging into the NASDAQ is probably the smartest investing thing you can do for your lifetime, because you're going to be probably buying the NASDAQ when it's high now, but if you just keep putting in the same amount of money over time, it will work out.
Andy, you follow these big name tech companies very closely. What does the next decade hold for them? Do we finally get that regulation?
I think that that's a really strong possibility, and I think that the tech companies would be smart to preempt that by working with Washington, D.C., and you hear people at Microsoft talking about regretting that they didn't do that more closely, Facebook in particular. And I think that, then there's all the new forms of technology that are going to really take hold over the next 10 years, like 5G, like VR, AR, and big data and cloud and all those trends that are already here a little bit, but I think that they're really going to be things that drive these companies forward. And of course, there will be new names that we either don't know or barely know that will be leaders as well.
Maybe WeWork will finally be public.
That'll be an interesting one, sure.
Jared, back to you.
All right, we got the NASDAQ 100 heat map here, but we're looking at year-to-date performance, something we don't always do, but it's good to reflect on these things. And to Andy's point here, it's all about tech. You look at Apple, 85%, and if we look at it over 10 years, the last decade, which is closing today, up nearly, let's check this out. Look at that, 868%.
Wow.
And then we got Facebook up 55.9%. It's almost recovered its all-time high. Microsoft near record highs, 55%. But if we sort here by performance, we're going to see AMD. We talk about this stock a lot. That's up nearly 150%. We got another chip name here, Lam Research, up 115%. The top is littered with these chip stocks, which have really been on a tear these years. The Philly Sox Index up about 60%. But also Lululemon, Applied Materials, Apple, Skyworks. You don't see that much red on the board. Only Milam, Kraft Heinz, Baidu, Walgreens, and American Airlines are down this year, and really not that much.
We'll have to leave it there, but bring on January 2020. Jared Blickery, Andy Sower, thank you.
Thanks.
Coming up here on The First Trade, a daring escape. Nissan's disgraced former CEO Carlos Ghosn runs from Tokyo and makes it to Lebanon. We have the latest. And as we head to break, here's a look at the fireworks as New Zealand rang in the new year a few hours ago. We'll be right back. Let's get down to New York Stock Exchange and check it with Yahoo Finance's Scott Gamm. Scott?
Hey there, Brian. Well, we're watching a couple tickers in the pre-market. First up, Boeing, the company agreeing to a compensation resolution with Turkish Airlines as it relates to the still grounded 737 MAX jet. We know Turkish Airlines had ordered, or at least had, a few dozen of those planes. Now, not sure if this is exactly a market-moving headline for Boeing, but take a look at Boeing stock, set to open at around $325, $326 a share. If Boeing stock declines today and closes below $322 a share and 50 cents, that would put Boeing stock in the red for 2019, which is pretty significant just because back in February, Boeing stock was trading as high as $440 a share before that tragic March 737 MAX crash. And then also keeping an eye on shares of Uber. Of course, Uber and Postmates have filed a lawsuit in a federal court in California claiming that legislation that could require its drivers to be classified as full-time employees is unconstitutional. Uber stock is down in the pre-market. Postmates is not a public company, at least not yet, Brian.
Scott Gam, thank you. Carlos Ghosn has fled to Lebanon. The former CEO of Nissan has left Japan, where he faces charges of alleged financial wrongdoing. Ghosn said in a statement, "I have not fled justice. I have escaped injustice and political persecution." Yahoo Finance senior columnist Rick Newman joined us now to break this down. Rick, bizarro situation.
A weird situation, just got weirder. So this case has not proceeded the way we're used to cases like this happening in the United States. So there was the surprise arrest when Carlos Ghosn got off a private jet in Tokyo in 2018. He was arrested a total of 4 times. And he's never really been able to have his say and say, here's what's going on here. So the charges are basically that he embezzled money from Nissan Renault, that he got the company to pay for private expenses. And he says, no, that this is all about my retirement, preparing for my retirement pay. So it's very unclear. And there have been instances in Japan where prosecutors seem to have arrested him, like once they arrested him the day before he said he was going to give a news conference. So it's like they don't want him to speak. They don't want him to tell his side of the story. It's really hard to tell what's going on here.
It's crazy because I think Ghosn's lawyer was quoted as saying they have all his passports. So how did he get out of the country?
I don't know. I mean, it's unknown. I mean, apparently he arrived in Lebanon via Turkey. Now, he is a citizen of Lebanon. His parents were Lebanese. He's lived there for part of his life. His wife is also Lebanese. So it's a place where he's familiar, and he's also very popular, and they have they don't extradite people to other countries. So he's seemingly safe there, but he would have to stay in Lebanon.
Is there any read-through here regarding Nissan? Nissan has put a new leader in place, but this is the last thing, I'm sure, the last publicity Nissan wants to see right now.
Yeah, there are implications here for Nissan Renault. So he's out of the company at this point. I mean, he's never coming back to be involved with Nissan Renault. But this company has really struggled with him gone. And what has become apparent is, this is not a merger. This is an alliance, Nissan Renault and also Mitsubishi. So it's, these far-flung auto companies that Carlos Ghosn was able to kind of keep together, and the partnership allowed them to buy some components in unison, share costs where it made sense, and do things like that. That's really important in the auto industry these days with all the R&D money going into electrification and things like that. This alliance has really fractured since Carlos Ghosn has been gone. Nissan is really struggling. Sales are down. So it's some evidence that Carlos Ghosn really was holding this alliance together.
Rick, from what you know about Carlos Ghosn, do you think he pulls a Papa John's John Schnatter here, comes out and speaks out aggressively against the company?
Well, he has said he's going to do that. So he said, next week I'm going to have something to say about this. It's going to be quite interesting because it's not entirely, it seems possible to my mind that these are politically motivated charges for some reason. So he has said all along that he thinks it's people inside Nissan. He thinks this is part of kind of a power play inside Nissan. That these are kind of drummed up charges. I have no idea about the legitimacy of the charges, but it does seem at least somewhat plausible that there could be some truth to that. So it's going to be very interesting to see what he has to say.
And Japan effectively can't do anything here?
I'm not sure. So Carlos Ghosn can't leave Lebanon. Is he going to live as a celebrity fugitive in Lebanon, but no place else? Supposedly he owns a winery in Lebanon, so he's got something to do. Yeah. He has a big mansion there, and he's popular. They put him on a postage stamp. He's kind of a national folk hero. So I guess he could sort of bide his time in Lebanon, but I mean, he's been a globetrotter for so long. I mean, the guy lived on a private jet for years. You have to wonder, could Carlos Ghosn actually be comfortable cooling his jets in Lebanon without leaving, or might he get the the travel itch and decide to go to Paris or something and be nabbed there?
Well, maybe
it's really fascinating.
Maybe he'll make some wine and send it over here.
You know, automotive executives are usually boring these days, and now one of them is a celebrity fugitive who's about to thumb his nose at the Japanese government.
Waiting for the next Netflix movie. You know it's coming.
I hope so.
Rick Newman, thank you.
Yeah.
Next up here on the first trade, more than just a smoke break. Why Carrie Underwood is giving up one of the longest running gigs in country music. Here are your news bites for today. The U.S. Embassy compound in Baghdad has been evacuated after angry protesters attacked. The mob smashed a door and set fire to a reception area while chanting "Down, down, USA." But they don't appear to have gone into the main buildings. They're angry over a series of U.S. airstrikes that killed members of an Iran-backed militia. In a tweet a short time ago, President Trump accused Iran of orchestrating the attack. Sydney, Australia rang in the new year with fireworks despite concerns over safety. Brush fires have spread across the region caused by the spike in temperature and months of drought conditions. The fire department granted the fireworks spectacle a pass despite a petition fighting to get the event canceled that has over 270,000 signatures. And a federal judge has dismissed a lawsuit from one of President Trump's former aides. Charles Kupperman had asked the court to step in and decide if he had to comply with the House subpoena in the impeachment inquiry. The judge said the case was now moot since House Democrats had dropped the subpoena. And Chinese tech giant Huawei reported solid revenue for 2019 as U.S. sanctions continue to weigh heavily on the company. In a year-end note, the deputy chairman said that Huawei's sales were at nearly $122 billion, just under the company's initial sales target. But he forecasted that Huawei would not grow as quickly in 2020 as it did in the first half of 2019. And after 12 years, Carrie Underwood is stepping aside as the host of the Country Music Association Awards. Underwood took to Instagram saying, quote, "It's hard to imagine topping what we have accomplished together, so I've decided that it's time to pass the hosting torch, at least for now." She'll still be performing, though. Underwood is in the middle of her Cry Pretty Tour 360 and is publishing a book in March 2020. Coming up here on the first trade, on the rise, why 2020 could be a big year for the U.S. housing market, and we have the details on the latest Case-Shiller report on home prices. Some breaking news. President Trump just tweeted that he'll be signing the Phase 1 trade deal with China on January 15th. In a new tweet, the president said, quote, "I will be signing our very large and comprehensive Phase 1 trade deal with China on January 15th. The ceremony will take place at the White House. High-level representatives of China will be present. At a later date, I will be going to Beijing, where talks will begin on Phase 2. All right, so President Trump signaling a potential Phase 2 trade deal in early 2020, perhaps/maybe. Now, we're just getting a new look at the state of the U.S. housing market. The latest Case-Shiller Home Price Index is just in moments ago, and it shows a stronger than expected price gains for October. Let's talk about it with Craig Lazzara, Managing Director and Global Head of Index Investment Strategy at S&P Dow Jones Indices. Craig, good to see you here. Pretty good month for the Case-Shiller.
It was indeed. The national index, the most comprehensive one, was up 3.3%, which is ahead of its pace last month. So we've seen a very stable and steady growth for the last several months now. That's quite encouraging.
What should housing market watchers look for in some of the data that comes for November and December? We've seen a big push higher in the stock markets. Do you think price gains will show more strength for those 2 months?
It's hard to make a direct equivalence between what goes on in the stock market and the housing markets. The thing I would say is that we've seen over the last year and a half, say, continued price gains, but at a lower rate, so a rate of deceleration. And that came to an end 2 or 3 months ago. So we've been very stable since then. Now, that may continue to be stable, or it may decline, it may go back up. The things that I think are more relevant to the decision about housing prices, or one's forecast about housing prices, I mean, housing is of course, very local. What goes on in San Francisco, which actually was down this month, the only one of our 20 cities.
San Francisco was down.
San Fran was down. The big leader this month was Phoenix, up I think 5.8%. Tampa and Atlanta were strong, and Charlotte was strong. So mainly the Southeast. And given how far San Francisco had run, it's not a shocker that it would be down. But the game was very broad-based. Well, that said, housing is a local market. The things I would look for are things equivalent to what you just mentioned a moment ago. Is there going to be a trade war, or is the economy going to overcome that hump and continue to grow? We're at record low unemployment rates, very low interest rates. Those things are both important in people's decisions about whether they can afford a house and how big a house they can afford.
What are you seeing on the housing shortage front? We were just talking a little bit off camera. My brother cannot find a home. He's getting beat out with people with cash in their pocket. It seems to be getting worse.
I think that's again very market specific. There are certainly places where that has happened and can happen. But generally speaking, the market, it's not robust in the sense that it was robust 2 years ago, but it's certainly steady and stable. I think the most obvious conclusion that I would draw from looking at the data this month and last month is that if people were waiting to see if house prices would actually decline as they did in 2006, 2007, that's probably not going to happen, at least given the current economic backdrop.
You also follow the markets very closely. It's been quite a decade. What do you think the next decade will mean to investors? You knew the question was coming.
I worried that it might be coming. I think we have seen an extraordinary decade, particularly in the U.S. If you look at the U.S. stock market has been far ahead of other developed markets, although, interestingly enough, Jamaica, I think, is the highest national market in the past 10 years. No pun intended.
News you can use.
No pun intended. But the U.S. has done very well, supported by very low interest rates worldwide. But as we said earlier, the U.S. economy is doing well. GDP is increasing, unemployment is low. When that happens, you expect the stock market to do well.
But how worried are you over the next decade? Interest rates will probably rise, and I think the market at some point will start caring about the country's debt levels.
That is indeed a possibility. The question is whether we can grow ourselves out of the debt burden that we now have. The market doesn't seem terribly concerned about that today. You can certainly envision circumstances where that concern would leap to front of mind. I think the likelihood of that happening depends greatly on the strength of the economy. If the economy begins to decline, whether because of supply shocks, tariff wars, anything that things that we can't think of now, otherwise they'd already be compounded into prices. But whatever might happen to slow the economy, that would be the thing that would cause the stock market perhaps to begin to decline. And in that environment of slowing economic growth, there you might see more concern about debt levels. Absent that, the market seems to be comfortable.
Well, we'll leave it there, and we'll bring on 2030.
Look forward to
Here
it.
it comes. Craig Lazare, good to see you.
Thank you, Dre.
We'll talk some more markets next here on The First Trade. But first, here's a look at the action in overseas markets, and we'll be right back. Welcome back to The First Trade. The opening bell is just moments away. Right now, futures are in the red. Surprise, surprise. We did see that sell-off yesterday, though. Dow futures down about 62 points. Let's go around the bell now with Tom Essay, founder of 7 Report Research, along with Jared Blickery at the Wi-Fi Interactive Board. Good morning to you both on this New Year's Eve. Tom, I've really enjoyed reading your notes this week. You sound like you have a more measured tone on the market and where we could head in 2020.
Hi, guys. Good morning and Happy New Year to everyone. Thank you for having me back on. It's been a great year. I think that everybody should be very happy. It's undeniable, that the outlook for 2020 is much improved as we were compared to a year ago. But at the same time, this market is now very expensive and a lot of good things have been priced in. And we have to see that come to fruition. We got reminded of that this morning via the Trump tweet with apparently the phase 1 signing ceremony now set for January 15th. So everybody, there's your first big day of 2020.
Tom, I've seen a range of outlooks for the first quarter of 2020, everything from a potential 6% to 8% pullback to a full-on crash, let's say in excess of 25%. What say you?
I think some digestion. I think if we got a 3% to 5% pullback, I think that would probably be healthy. I think it would be good for the longevity of the 2020 rally. I mean, look, my accounts were down yesterday, and I was like, oh, God, that can still happen, huh? We need to take a little bit of a break. I think a churn, a little bit of a pullback is a reasonable expectation.
And there you have the final opening bell in 2019. The Dow has opened up 59 points, down about 60 points, excuse me. Jared, let me head over to you at the Wi-Fi Interactive Board. 2 stocks I've been watching all morning long, actually all week long, is Uber and Lyft. You've really seen a leg down in each name, I guess, off of this news in California.
Yeah, the regulatory environment in California is just getting a lot more tough. And guess what? Wage costs are going up next year as well, with minimum wage set to go up there, as well as New York. A lot of key markets for a lot of these gig companies. This is this is a little bit too far, but let's take a look at what Uber has done this year. And we can see it's just kind of floundering here, down by its lows. Lyft really not doing any better here. If we take a look at what's happened year to date in these IPOs here, we can gauge what really the big picture is. So the IPO ETF is supposed to track everything, and yet it's outperforming just about everything. And that's because a lot of the smaller players not here, not necessarily brand recognizable names, are doing that well. But if you take a look at the NASDAQ, completely different story here. This is, again, sorting by year performance, and Apple up 84%, Microsoft up 54%. Now, Alphabet underperforming just a little bit, but still up over 27%. Amazon, it's up only 22%, but we know it's recently caught up here. Just over the last few days, this week, it's kind of broken out of this resistance zone right here. And if we sort by performance, we can see the chip stocks have really taken the cake this year. AMD up 145%, followed by Lam Research, and then we got Mercado Libre, KLA, all these stocks up nearly 100%, Lulu up 90%, and not that much red. Mylan is down 30%, that's the biggest loser, followed by Kraft Heinz, but then just a couple more, Baidu, Walgreens, and American Airlines in the red. Overall, a great picture for the end of the year here.
Tom, Jared mentioned some IPOs. It's been a pretty terrible year for some big name IPOs in terms of performance. Do you think you see a rotation into the likes of, let's say, an Uber, a Lyft, and even Levi's? I look at Levi's, that's a profitable denim company, yet its stock has gone right in the tank.
Yeah, I think that there's definitely going to be some value hunting occurring here as we go into the new year, and rightly so. I think with specifically Uber and Lyft, there's a lot of uncertainty around these companies in the short term. I mean, this new law really kind of implies a lot of changes for the whole business model. I'm sure they'll work something out, but at the same time, that uncertainty is going to weigh on the stock. Nonetheless, longer term, you're talking about a company that revenues a ton of money, has a paradigm-changing technology and business model. So for those longer-term investors, if you are looking to take a chance on something that has big return potential, those ride-sharing names are attractive, I think, in the new year.
And Jared, not all of the IPO class from 2019 has been pretty horrific.
No, we have a couple of outstanding performers here. TradeWeb is up 31.3%. We can see even this stock had a rough tumble here. A lot of stocks peaked in late July, early August. Not only IPOs, but the growth names. And that's kind of when we saw this shift from momentum back into value. But value didn't really get started until September, October. So a lot of these stocks had a rocky year. We can also look at Ping, Grocery Outlet, Beyond Meat. I mean, there's another one. This stock was up several 100%, and now it's barely up 13% from its IPO day. Kind of rough going there for a lot of IPO investors. We have seen a couple of success ones recently, and we're not going to really get any until the new year, of course. This is the last trading day of the year. We'll have a few next week, and then we'll kind of pick up in January and see where the capital markets lie.
Tom, I know you follow market internals very, very closely. Are you seeing any red flags right now?
I'm seeing some caution flags. Typically, we would have expected, as the market ramped higher in December, to have that rally led by cyclical sectors, so things like financials, industrials, because the whole rally is predicated on the idea of better economic growth in 2020. That didn't happen. Instead, we saw essentially large cap tech leading the rally. And we call large cap tech here in the firm long rentals, because when I'm a financial money manager and I need to get some long exposure, one of the easiest things I can do is buy Apple, Amazon, Google. They're large cap, they're very liquid, and they give me upside exposure. So I'm a bit concerned about the market internals in the short term going into the new year.
You mentioned earlier we could see some digestion in the early parts of 2020. What triggers that?
I think any sort of disappointment, and I think you're almost seeing it a little bit right now. Now, the declines of the last 2 days are certainly majority window dressing, but at the same time, geopolitics have sort of come up a little bit. Look, we have people were storming the embassy in Iraq this morning. Now, that's not necessarily a bad thing. I don't think that's going to be a bearish influence, but I think it highlights the point that at these levels, the market is essentially pricing in almost a perfect scenario across every front: economics, earnings, geopolitics, domestic politics. And all of us know that perfection doesn't last very long. So I think any one of these issues could cause a bit of digestion. What causes a bigger correction would be something either economic data, badly missing expectations, or earnings disappointment in mid-January.
Do you think that first disappointment could be the jobs report coming next week?
No, I don't think so. I think the jobs report should be strong, especially around the holidays. The data is very noisy, so traders tend to give this a pretty large band. I think the biggest thing is earnings, honestly, in January. People have penciled in a big earnings rebound to justify these valuations, and it needs to start showing up. The idea of just being not as bad as feared earnings in 2019 worked. That won't work in 2020. That's got to be better than expected.
Jared, back to you.
Well, we're taking a look at the leaderboard for this month. This would be December, and we see the SOX. The chip index is up nearly 8%, followed by emerging markets, high beta, and then we have the cyclicals, the KBW Regional Bank Index, that's still up 4%. And if we look at year to date, the chip stocks really just taking it away, along with home builders, though. Home builders had a nice year, they're up 40%. And then we have tech software, that's IGV, that's up 34%. And why don't we take a look at the Dow and see how the Dow has done year to date? And we can see a lot of the big names, a lot of green there, similar to the NASDAQ, but let's take a look at sorted by performance. So, of course, Apple and Microsoft, the big two there. But then we also have Visa and JP Morgan up 42%, just plowing to record highs, along with United Technologies up 40% as well, and Goldman Sachs. And then finally Nike at 36%. And only three stocks to the downside. Walgreens, also a NASDAQ 100 member, that's down about 14%, followed by Pfizer and 3M. But we saw healthcare really come back in this quarter. And this is the sectors sorted by year-to-date performance. Tech is on top, 48%, communication services, financials, all of those outperforming this year. Energy still in the green, but the laggard for the third year in a row. Healthcare second last, but if you look at quarter to date, it really made that comeback, and we can see it's second most in this quarter, up 13% since October.
Yeah, Jared, speaking of green, we briefly saw all three major equity indices go into the green. Right now, the NASDAQ and S&P are in the green. The Dow is slightly in the red. It's pretty good to see. Tom, looking out over the next decade, what do you think one of the biggest challenges will be for traders? A little different than investors, but in terms of trading, look, you guys are up against the algos every single day, and they only seem to be getting faster.
Well, that's exactly right. I think you hit the nail on the head. Is that the whole infrastructure of the market is changing. I said just a bit ago that I expected a 3 to 5% digestion / pullback in the market in January. That could easily stretch to 8 or 9% just based on the algos. And I think for all of us, especially traders, dealing with this extreme short-term volatility is something we all have to get more used to, and we have to somehow assimilate that into our trading plans and figure out how we deal with that on a risk management standpoint, because the market is getting more volatile in the short term for no good reason, and that can swing you out of trades, which we all know can hurt performance over the longer term.
Sounds like the best course of action could be just chug some Red Bulls and hope for the best. Get fired up.
Pretty much, right? I mean, it's completely nonsense, some of this volatility that we see, and because it's purely computers doing what they're coded to do. And we've just got to sort of grit and bear it and really stick to our convictions and keep risk management top of priority.
We'll have to leave it there, but Tom Essay, I just wanted to thank you coming on all year and making some really good market calls on our network. We'll talk to you soon.
Thank you guys very much. Happy New Year.
Coming up here on The First Trade, fighting back, why Uber and Postmates are going to court to stop a major law that could change the world for gig workers. Scott Gamm is standing by at the New York Stock Exchange for us. Scott, we're seeing some green on the screen again.
Well, that's right. The Dow was in the green for just a moment, but has since turned back into the red, down about 12 points, building on some of the declines we saw yesterday. The stocks leading the Dow lower right now are names like Merck, Goldman Sachs, and 3M. Outside of that, Brian, we're keeping an eye on shares of NIO. That stock surging for a second day in a row. This is the electric car maker out of China. Remember, yesterday the company reported a 35% rise in vehicle deliveries. Net losses also narrowed. Today the stock is up once again. It had an IPO right here at the New York Stock Exchange back in 2018. And then also take a look at shares of Sina. This is the China-based technology company. They're up today, up about 3%. The company announcing a stock repurchase plan worth $500 million, Brian.
Scott Gamm, thank you. Easing trade tensions and OPEC production cuts have set oil up for its strongest year since 2016. Jared Blickery is back at the Wi-Fi Interactive Board with today's commodities report. Jared?
Yeah, strong year, but crude oil is down right now, about 1.6%. And we can look at some of the price action here. Actually, let's go to overnight. And we did get kind of a sell-off starting at about 7 a.m. or just before that hour. No particular news, but it could be some rising geopolitical tension or the easing thereof. We really don't know. We are going to get the Department of Energy numbers, but only on this Friday at 11 a.m. And we'll be getting the API number. That's a private number after the bell at 4:30. Of course, tomorrow is an off day, and then we resume trading in the new year on January 2nd on Thursday. But if you think about what happened this year, some of the big catalysts, well, oil was coming off a huge oversold condition. It's up 35% on the year, but most of those gains came in the first 4 months. And then some other notable events. We had a kind of a sell-off on the trade war escalation, and then we had that attack on Saudi Aramco. But oil has been pretty bullish lately. We can see it's broken above the $60 price level and has really held there over the last week or so.
Jared, the U.S. dollar has continued to weaken. What are you seeing in gold?
Well, gold is up, and it's had an impressive run over the last few days. It did kind of break this down channel that it was stuck in, and we can see it's up to $1,522.80 right now, which is a solid price. There was some resistance at $1,520, so if it's able to hold above there, we have some more resistance at about $1,550. But all in all, going into the end of the year, gold is looking pretty strong, and the U.S. dollar, the U.S. dollar has sold off big time over the last 3 days. And the other factor is interest rates. Interest rates not really moving today, especially on the long end, but it is nice to see gold ending the year up here.
Jared, the word of the day for me has been two words, red flag. Isn't it a red flag to see gold rallying and the market still hovering around all-time highs?
I'll tell you, one of the things to look out for in 2020 is the potential for commodity price inflation, which could leak into the general economy. I don't think that's on a lot of people's radar, so that's something we're definitely going to be monitoring.
All right, Jared Blickery, thank you. Uber and Postmates are suing California in an effort to block the state's labor law aimed at gig economy workers. Tech editor Dan Halley is here with the details. Dan, this seems like a really big deal. Uber and Lyft shares have pretty much fallen through a trapdoor the past 5 sessions.
Yeah, AB 5 is essentially a bill that will take freelance workers, contract gig workers, and turn them into traditional workers, whereas they will get health benefits, steady pay, basically what you would expect any kind of full-time employee to get. It takes away, though, the ability for companies like Uber and like Lyft, DoorDash, Postmates, anything along those lines, to basically call these workers freelancers or gig workers. Now, there's two sides to the story. There's the side of the workers who say, look, we want better pay, we want benefits. You know, we're driving around in these cars all day. We want to be paid fairly for that. And the side of the businesses that are saying, look, if you do this to the employees, you're going to take away their ability to work at different jobs, do things along those lines. We've seen announcements from the likes of Vox Media that said it's going to lay off people from its SB Nation site because it can't afford to pay those freelancers and provide them the benefits that they would have.
So it's not just an Uber and Lyft thing.
No, it's not. This is across the board. But this lawsuit specifically says that Uber and Lyft, Postmates, the like, are being unfairly targeted. It's unconstitutional because the law only goes after certain sectors, but not others. So, for instance, truck drivers say that they're exempt from this law under federal standards, and so they wouldn't have to abide by this California bill. So that's really where this argument comes in, is Uber and Lyft saying, look, you can't treat us differently just because we are what we are, and then allow truck drivers and other sections of the economy to be exempt from this bill.
By all accounts, this will still kick in on January 1st. And do you think it impacts first quarter? Does it have that type of immediate impact for an Uber and a Lyft?
I mean, anything affects Uber and Lyft now. They don't make any money. So, but I think, that's their fear, is that if they have to treat these workers as non-freelance and provide them with the benefits that the California bill forces, they may have to cut back on the amount of drivers that serve certain areas. And that's really their argument. Whether or not it'll hurt their bottom line, I mean, California, it's the 5th largest economy in the world, obviously. It's a hugely important spot for Uber and Lyft, very not mass transit friendly. So you need a car to get around, and if you don't have a car, you're going to use an Uber or Lyft. We might see them get kind of a cut into their revenue, but I don't think it's going to be on the scale that it'll actually impact the companies substantially, especially given the fact that Uber is a worldwide company. Lyft, on the other hand, they might see a bigger impact, but I don't think it's really going to hurt their bottom line as much as they're saying.
Isn't the big fear here that other states adopt what California just did? That's
exactly it. Yeah, it's they want to put the kibosh on this, as I guess my dad would say, and make sure that this doesn't spread across the country and become a blanket kind of treatment of these gig workers. And I mean, there's been this debate going on. Gig workers have had major issues, especially in cities like New York, because there's been backlash to how they take jobs from traditional medallion cabs, yellow cabs. There's been this ongoing conversation of where do they fit into the workforce, and I think this is just another level to that conversation. Do they stay freelance if they're forced to work for or continue to work for one of these companies? Would freelance writers, for instance, would they be able to continue to work for different companies? Or if they specifically work for one, will they be considered a full-time employee or get the benefits that a full-time employee would need, like healthcare? So I think it's going to be interesting to see how these different lawsuits play out. There are a number of them against this bill, but as it remains to be seen, it will go into effect tomorrow.
What a year for Uber and Lyft.
Yeah, right? Oof.
Dan Halley, good to see you.
Thank you.
On deck for the first trade, Microsoft ends a big hacking operation, and they're blaming a major enemy of the U.S. Your companies and stocks to watch are next. Taking another quick check of the markets here. The return of some green on the screen. The Dow is up about 10 points. Over at the NASDAQ, also in the green, and the S&P 500 is clinging to some gains. We'll be right back. Now for a quick look at some of the companies and stocks the Yahoo Finance newsroom is watching for you today. Tencent is taking a big stake in the world's largest music company. They're buying a 10% stake in Universal Music Group from Vivendi for some $3.4 billion. The deal values Universal Music Group at more than $33 billion. And JP Morgan is looking to gain complete ownership of its futures joint venture in China, according to Bloomberg. The bank is planning to raise its current 49% stake to 100%, making it the first global bank to jump on the opening of China's futures market. The change will allow big banks like JP Morgan to expand their footprint in the country. A JP Morgan spokesperson didn't return Yahoo Finance's request for comment. Boeing and Turkish Airlines have reached a compensation deal over the grounding of some 24 737 MAX jets. A local Turkish newspaper is reporting the deal is worth $225 million. Media reports swirled earlier this year that Turkish Airlines would be opening a court case against the aerospace giant if a deal wasn't reached. Microsoft says it has taken down 50 web domains reportedly used by a North Korean hacking group. The software giant says the group called Thallium used the sites to launch cyber attacks. In mid-December, Microsoft filed suit against Thallium. Shortly after Christmas, the courts gave Microsoft the authority to take the sites down. And fully committed, that is what Ford is saying about reservations for its Mustang Mach-E. The first edition electric Mustang crossover sells for about $60,000. Ford didn't say how many reservations it took, but has said global production in the first year for all versions of the Mach-E is limited to 50,000 vehicles. And those are your companies to watch for Tuesday, December 31st. Coming up here on the first trade, a vaping ban back on. The new rules that could be very bad news for Altria and Juul. A vaping ban could be back on the president's agenda. He just received new guidance from the FDA on potentially banning flavored vapes. That's after he walked away from an earlier ban. Anjali Kamlani is here to break it all down. Anjali, quite the potential turn of events here.
Yes, it is. It's a pretty big market. As we know, there's some major players. You have the tobacco industry involved, and we're talking about what is an increasingly seen as an increasingly good way to get off of smoking cigarettes. So there's so many different views on why this should or should not happen. I found it very interesting that there's actually a report out of Montana where they have tried to do a sort of a temporary ban similar to what's being proposed federally. And they found that there's some really entrepreneurial minds who have decided to sell kits. And so rather than selling the actual flavored, the flavors, you can put together the kit yourself.
That sounds like a lot of work.
It
and
does.
Kind of like going underneath the radar of
Right.
the government. Probably not good. What do you think? What do you think the president ultimately will do here? It's hard to tell. You never know with President Trump, but it seems to make sense that why do we need flavored vapes at all?
Why do we? I mean, they already took one step, right, with the increasing the age to 21 to selling. So that has already taken place, and that might be the most we see. I wonder if this is just all talk right now, because any kind of action is going to be something that becomes political and does affect his reelection bid. So it definitely remains to be seen.
The lobbyists on this topic have been fierce.
Fierce, absolutely. Yes. I mean, you're going to get it from all sides. So you've got the health concerns, you've got the people who are worried about whether or not this puts an entire industry out of business in one fell swoop. And that's really the concern is, do you take all these small shops that have been building up to and meeting the demand for the increasing number of customers, right? We've gone from, I think we have about like 10 million people vaping in the US now versus the 34 million that are smoking, and they hope to see those numbers inverse. And you've seen the market become, going from, I think it was like about 15 billion last year to double that in 2022 is a projection. So you're really going to hamper that industry.
The flip side of the coin would be that people just go back to smoking cigarettes.
Right, and that's the concern is, should that happen, is that which one's the worst of two evils, right?
Well, I don't do either, but we'll leave it there. Anjali Kamlani, good to see you. And that's it for the first trade for today. I'm Brian Sozzi. Happy New Year, and thank you for starting your investing morning with us each day. We really do appreciate it. Now let's get one more check of the markets with Scott Gamm down at the New York Stock Exchange. Scott?
Hey, Brian. Well, we're keeping an eye on shares of Boeing after the company reaches a compensation agreement with Turkish Airlines. The financial terms were not disclosed, but this all relates to compensation surrounding the still grounded 737 MAX jet. Turkish Airlines had about 24 of these planes. By the way, Boeing shares are in danger, at least today, of wiping out their 2019 gain. If they close below $322.50 a share, Boeing would be in the red for the year. Pretty striking, just because Boeing was at $440 a share back in February. And we're also keeping an eye on shares of NIO, the stock up for a second day in a row. Remember, yesterday it surged more than 50% after reporting a 35% rise in vehicle sales. This is, of course, the electric car maker out of China, widely compared to Tesla. NIO had an IPO right here at the New York Stock Exchange back in 2018. And that'll do it for us on the first trade. Thanks very much for watching. Stay tuned, because Wi-Fi AM is coming up right after the break.
Good morning and welcome to Wi-Fi AM. Happy New Year. This will be the last show before we ring in 2020. Here we can see live footage of New Year's celebrations in North Korea. I'm Heidi Chung in for Dan Roberts today, and joining me on the couch we have Yahoo Finance's Angelique Kenlani and Julia LaRoche. It's a ladies' power hour to end this decade, and I am super here for it. Thank you for being here. Now let's take a look at how markets are faring on this final day of trading. We have the major indices all marginally higher here, and this comes after President Donald Trump tweeting moments ago, quote, "I will be signing our very large and comprehensive Phase 1 trade deal with China on January 15th. The ceremony will take place at the White House. High-level representatives of China will be present. At a later date, I will be going to Beijing where talks will begin on Phase 2. Now, we will continue to monitor the market action coming after this announcement from the White House. But first, the battle between the gig economy and the state of California is escalating. Uber and Postmates are suing California in an effort to block the state's labor law aimed at the gig economy workers. We have Yahoo Finance's tech editor Dan Howley here to break everything down for us, Dan. So this is in response to the AB5 bill in California, right? So can you sort of break that down for us first?
Yeah, AB5 is a bill very controversial.
Yeah.
Very controversial.
Really? Hadn't heard.
A little bit. Essentially what it does, it takes gig workers and it says if they work a certain number of hours for a company, then they have to be classified as workers for those companies and receive those kinds of protections that workers would get, either full-time or part-time. And so this is an issue for companies like Uber, like Lyft, like Postmates, like Grubhub, like anyone else that you can think of that might be a gig economy, as well as media companies that have freelancers. Right, so it becomes an issue for a huge swath of industries, and there are some that are being exempted from this, and that's really where this suit comes in. Uber, Lyft, the whole essentially are saying if you allow these exemptions to other industries, like truck drivers, for instance, fishermen, fisher people, then you're basically singling us out. So that's where they feel it's unconstitutional. Now, they've both paid lip service to the bill itself, saying, yes, we want our workers to be protected, yada, yada, yada. But then they also say, out of the other side of their mouth, well, if we have to have these kinds of protections, then we might not be able to provide the same level of service in particular areas that are covered by the bill, for instance, California as a state. So they're basically saying, this bill is good because it protects people, but if you still want to get around in an Uber or Lyft, you might not be able to anymore because then we have to pay out more money to employees or these workers that are then classified as employees, so we might not have as many drivers around. So it's really an interesting issue for the media side of things. SB Nation, which is owned by Vox Media, they specifically said that they're going to have to lay off a number of people from their California operations because they have to take them on as freelancer full-time or part-time because they work specifically for those sites, and they're not going to be able to do that. So they're opening up positions for part-time and full-time employees, but laying off a slew of freelancers that they had already had. So it's a large kind of spread issue that's going to impact a number of industries. And as of now, it's going into effect tomorrow.
And a lot of these industries are either new, in the case of the ride sharing, or they have been surviving because of the gig economy when you talk about media, right? A lot of companies, with all the criticism that you can have about it, is they've survived because they've been able to not have to focus on the benefits and not take on that expense. So any thought to that? Has that come up in some of these conversations as well?
Yeah, I mean, that's really one of the main issues as well is, how do you allow for workers to receive the protections that they're entitled to or feel that they're entitled to, while also ensuring that at least we can pay them, So it's, okay, you get health care, you get certain labor rights, but then at the same time, now you won't get paid anymore, or we won't be able to pay as many people because we have to provide these protections and these benefits to these workers. So it's going to be an ongoing issue. There are multiple lawsuits going on with this bill. It's not just this.
So what are the next steps here, though, in terms of?
So Uber and Lyft, we're focusing on them because they're, Uber and Lyft, they're going to continue to try to push this lawsuit forward and fight this bill. They said they're going to do as much as they can to fight it. There's $110 million already put into the fight against it from them as well as other companies. So this is going to continue to be a problem. This is not going away just because the bill goes into effect on the 1st. It will be something that we continually come back to. There could be an injunction. Perhaps the bill will be put on hold for a bit once it becomes legal. But we'll see where it goes. It'll be interesting though for this entire sector of the economy.
Thanks for bringing that down, Dan.
Thanks.
Have a happy new year, by the way.
Oh my God, yeah, champagne, woo!
All right, shifting gears, Carlos Ghosn has fled to Lebanon. The former CEO of Nissan has left Japan, where he faces charges of alleged financial wrongdoing. Ghosn said in a statement, quote, "I have not fled justice. I have escaped injustice and political persecution." Yahoo Finance's Rick Newman here is to break this all down for us. What's going on here? I feel like this all started in late 2018,
Right.
and then the drama sort of played out all through 2019. And so what's the latest?
It's become quite a fun story now that Carlos Ghosn is a celebrity fugitive. So you're right, this started in 2018 when Carlos Ghosn was arrested, kind of like a surprise raid, getting off a private jet when he was landing in Tokyo. And this has not proceeded the way a sort of criminal investigation of white-collar crime would proceed here in the United States. So basically, the Japanese government prosecutors there are saying that he basically embezzled money, that a lot of Nissan money went to pay for residences and other things for him. He disputes that. He says this was all part of a pay package or retirement package, and other things were legitimate business expenditures. But what's been odd about this from an American perspective is the first thing they did was throw him in jail. Then they kept him in jail for a while. Then there was this weird thing where he snuck out. He didn't sneak out, but he got out of jail, but he wore a security guard's outfit so nobody would recognize him. He's been arrested 4 times. And there's a almost $14 million bond payment that apparently he's going to forfeit for having fled. But it's just been very odd to us that they didn't let him speak to his wife for almost a year, and every time he got arrested once when he was about to hold a news conference. So maybe he's guilty, but it also seems like there's stuff that the prosecutors don't want Carlos Ghosn to say to the public, which is why they keep arresting him.
Well, he kind of has a point, though, bringing up real issues. When you think about Japan and their legal system and you compare it to America, it is quite stark, especially when you're talking about white-collar crime. Do you think that would eventually change culturally? Because he's not a Japanese CEO, but he was running a Japanese icon, and some could argue that maybe he should have been paid more, even though I know in Japan, they do look at how they're paid compared to the average worker, whereas here in the U.S., we always, the CEO gets paid much, much, much more.
I mean, I don't understand the Japanese legal system or what the cultural overtones are here. It does seem to be the case that once you are indicted for financial crimes in Japan, almost all of the time you're found guilty. So Carlos Ghosn has complained that this system is set up so that you are presumed guilty and you have to prove yourself innocent. That's his side of the story. We may never know. Did he actually embezzle money? Did he take money that wasn't his from Nissan? Or these trumped up charges? What we do know is that without Carlos Ghosn running this kind of far-flung alliance, Nissan, Renault, and Mitsubishi, this alliance is crumbling. I mean, these companies are all performing poorly since Carlos Ghosn has left, so they're struggling without him.
Any thoughts on how he might be able to get back? Because I understand he left without his passport.
Nobody gets this. He has 3 passports.
I wonder how he got out.
He has citizenship in 3 different countries, and somehow he got out of there without a passport. So that suggests maybe the government of Lebanon helped him out under some kind of diplomatic cover or something. I mean, maybe we'll find out at some point.
Well, he's going to talk to the media soon.
And it's one of the things he says he wants to do. He wants to be able to have his say publicly, and the Japanese were prohibiting him from doing that.
Rick, we have you here, so I have to get your thoughts on the market reaction to the earlier tweet from Trump. Much of it priced in, I think, the fact that we were going to sign a phase 1 trade deal. So do you anticipate real negotiations to start soon for phase 2?
I mean, I've been a skeptic. I've been on the show so many times saying don't believe most of what Trump says on trade. He called this, he said soon we're going to sign this, quote, very large and comprehensive trade deal. I don't think anybody believes it's very large and comprehensive. Just to give you some idea, before Trump started his trade war and started imposing his tariffs, the average tariff on Chinese imports was 3%. With the trade deal, the average tariff will now be about 20%. So most of the tariffs he has imposed stay there, and that raises costs, most importantly, for U.S. businesses, and that has been showing up in a manufacturing slump and other things. It seems very unlikely that Trump is going to get any major concessions from China in an election year for himself, where he has kind of a weak negotiating position. And most of what this trade deal accomplishes is it just undoes some of the damage of the trade war, not all of it.
All right, thanks, Rick. Have a
Thanks,
happy New
guys.
Year.
You too.
Oil prices are holding steady in the last day of the year, and the commodity is on track right now for its best year since 2016. We have our energy expert, Yahoo Finance's Jared Blickery, here to break everything oil down for us. So let's wrap up the year. Let's talk about 2019 and then sort of what we're looking for in 2020 for crude.
Well, we began with a huge oversold condition in crude oil because stocks sold off and crude oil was down 45% high to low in the fourth quarter. So we got this big rally from January to April, and then in May we got the resurrection of the trade war, you know, the escalation of it. And so we saw a big decline, and really crude oil couldn't really get on track, and it was kind of bearish for several months until recently. And with the exception of the Saudi Aramco drone attacks, and when we had that big spike up that lasted 2 days, we didn't really see much bullish price action until the last few weeks. But that has to do with the Phase 1 trade deal, and it looks like crude oil wants to hold above $60 a barrel here.
So 60 was sort of that technical level that we were paying attention to. Do you think 70 is the next level that we hit, or do you think we could potentially go back to that range-bound 53 to 56?
Well, I think we could get up to 65, maybe 70 if there's some kind of geopolitical shock, and that could certainly happen with the U.S. embassy being stormed right now in Iraq. But we're not seeing really any bullish price action today based on that. In fact, we've seen kind of a decline of about 1% or so since 7 a.m. But you think about the factors that have really affected crude oil this year, OPEC Plus is the big one. So we have more supply coming on next year. We've talked about that not only from the U.S., but other countries like Brazil and Norway. And OPEC Plus may have to cut even more. Russia's not necessarily on board with that, so I think that's going to be important to watch. The current cuts are set to expire in March, and we'll have to see what the rumors are going into that, because that's probably going to be a big factor for the price of oil.
Maybe looking out further than just a year, how much do you think the growth or the potential growth in the EV market could impact oil?
Oh, that's huge. And that's going to affect, and, you know, we used to talk about peak oil. Well, we're going to have another peak oil, except it's not going to be supply, it's going to be demand. And there are varying forecasts for when that's going to come. The more conservative ones are putting it in the mid-30s. In fact, Saudi Aramco, when they were doing their IPO, that, you know, is their best case scenario because they want to sell more oil. They say, okay, we're going to meet peak demand in the 30s. It could come as soon as 4 or 5 years from now, maybe 10. So we'll have to see, but EV is going to be a huge play here, especially as battery costs come down.
Also, give us a quick update on Saudi Aramco post-IPO. How's it doing?
Well, you know, in those first 2 days, got up to $2 trillion from $1.7 trillion. That was the initial valuation, but now it's sunk right back down to where it was a couple days. It's traded actually below its first day of trading. So, you know, I don't think this stock is worth $1.7 trillion, or this company. I think more, you know, based on the dividend, probably more like 1.2, 1.3 trillion.
Thanks, Jared. Have a happy New Year.
You too.
Coming up, one Chinese tech giant had a pretty blockbuster year despite the ongoing trade war between the U.S. and China. We'll tell you what it is right after the break. Welcome back to Wi-Fi AM. Let's head down to the floor of the New York Stock Exchange, where our very own Scott Gam has the latest on what's moving the market. Scott?
Yeah, well, we've got the Dow down slightly, down about 12 points, building on yesterday's declines. But we also want to bring your attention to shares of NIO. This is a stock we don't really talk a lot about, but nonetheless, it's surging today more than 12%. This is the electric car maker out of China. Yesterday, you'll remember the stock surged more than 50% after reporting a 35% rise in vehicle delivery sales. Their net losses also narrowed for the most recent quarter. Today, the stock building on that big gain. It's still trading under $5 a share, and it's actually down more than 30% for 2019. Hard to find a stock that is in the red for 2019. By the way, NIO had an IPO right here at the New York Stock Exchange just over a year ago. Heidi.
Thanks, Scott. We'll check back in with you in a little bit. Chinese tech giant Huawei had a pretty solid year. The company reported revenue of nearly $122 billion, even as pressure from the ongoing trade war weighs on the company's future. In a year-end note, Huawei's deputy chairman forecasted that Huawei would not grow as quickly in 2020 as it did in the first half of 2019. We have Yahoo Finance's Crystal Hu here with all the details. So this is pretty good, all things considered, right?
Yeah, if you look at what has happening in this company this year with the U.S. blacklisting and then all the lawsuits going on, so they have been able to achieve an 18% year-over-year growth. That is slightly lower than next year, which was 19.5, but still considered pretty good. And if you look at the smartphone market especially, because that's the part that was supposed to be hit most by the U.S. blacklisting, that they still able to sell 240 million phones, which is about a 70% year-over-year growth.
That is a really tremendous number that you just pointed out. Given the blacklisting in the U.S., where are they finding the opportunities for growth?
I think part of it is definitely their core is the telecommunications business, which is how Huawei got started. And from our talk with Huawei CEO Ren Zhengfei, they told us that their core 5G business hasn't been affected by the U.S. blacklisting at all because they have all developed their own technology, so they don't need to rely on U.S. suppliers to supply components for that part. And for the smartphone part, that was supposed to be really hit because their latest flagship series have no regular access to Google apps. So we'll see more of that impact next year.
That's really interesting too, because you're talking about, number one, an international market that knows the brand really well, and it's not just U.S. reliant, even though the parts are. So I wonder if this opens up the opportunity unintentionally for other companies to sort of get in the game. I know that they started using parts from Europe as well, right? And so having that sort of inroad now without the U.S. competition, some of these companies could really flourish.
For sure, that's one of the points Huawei chairman Eric Xu was making in his note, that they want to be more self-reliant and also diversify the sources of their suppliers. Because after the U.S. blacklisting happened, they were talking about they have to develop their own system so that they don't need to rely on Google or anyone else.
And they also mentioned that they are specifically looking at not just being self-reliant, but that they themselves said this won't affect us. The blacklist won't affect us. So it's not necessarily, even with the slower growth in 2020, it's not that it's negatively affecting them. It's just that their growth is slower. Yes?
Yeah, I think in terms of how you define negative affecting, I mean, they could have much better growth this year because if you remember, in the first half of this year, their growth rate was something like 23%. I think still they are looking at more higher growth this year, but because of what happened in the U.S. government, so they are seeing a slower growth. And also to note that Huawei is not a public company. They're not obligated to report their financial results. So this is unaudited results.
Thanks, Crystal. Have a happy new year.
Thank you.
Wi-Fi AM will be back after a quick break. Time for today's trending tickers. First up is Tencent. The stock is slightly lower this morning after the company announced that it will be taking a big stake in the world's largest music company. Tencent will be buying 10% of Universal Music Group from French media giant Vivendi for $3.4 billion. Now, the deal values Universal Music Group at more than $33 billion and gives Tencent exposure into some of the biggest names in the music biz, like Drake and Ariana Grande, guys.
Not surprising at all. This is, I mean,
Why?
This is exactly where the industry is going to go. This is what you're going to see is all these tech giants now, or like tech companies, gobble up all the traditional, or whatever traditional companies there are in various industries. You see that across the board. I think this becomes like the new norm.
Well, especially because of the rise of streaming, which has really helped the music industry, because before it was, the piracy issue, as we were, going back more than a decade now.
Is it more than a decade now?
Yeah, it's more than a decade. I just remember
goodness.
that it was like a big issue when I was in college. No one's buying albums anymore. What is CD? Even downloading your own music. So it's been the rise of streaming, and it does make sense for a tech company to have access to the artist because, look, Tencent, we were just talking about the company, massive Chinese tech company with millions, hundreds of millions of Chinese consumers. And this is a great way for them to get exposure to some of these artists, because I know in China, K-pop is huge, but who's to say that Taylor Swift's not going to be big? She performed at Alibaba Singles Day this year. So
I think it catches up
to watch.
Yeah, and I think it catches up to the whole internationality of music right now.
So I was reading that actually Asia is facing a lot of issues when it comes to music streaming because of piracy concerns.
Oh, yeah.
So, I think it varies by region, definitely, but I think this kind of gives Tencent a better hold on sort of their presence within the music industry. Yeah. It's the end of the decade, guys. What was your favorite song or favorite performer? Because this list includes Taylor Swift, Ariana Grande, Drake, a lot of big names, Lady Gaga.
Oh, well, that's the thing. Like, I kind of move. Like, I think.
If you had to
what am I listening to?
Define your 2010s.
We don't have enough time for this segment.
Right, really.
Okay, fine. I'll go.
Okay, go. Give it to us.
I think I have to say, despite all the drama that Kanye West puts himself in, his music kind of defined my decade.
Really?
I was listening to Kanye West in the gym this morning, but mine's more of like defined my year, and I'll just say this year was probably my favorite in the decade, Lizzo.
Okay, I like that. All right, let's take a look at another trending ticker, Rite Aid. It has been an extremely volatile month for the retail pharmacy chain. The stock is actually up this morning, after sinking in the pre-market, and it tanked 21% yesterday. Now, if we take a look at December's performance alone, it's been an absolute roller coaster ride. Following earnings, the stock soared a whopping 187%, but now we have the stock down about 33% from the recent highs it hit on Friday. So now this most certainly looks like a short squeeze to me, but we have Anjali on the couch, and I always want to talk about retail pharmacy with you.
I love it.
Because it's one of those spaces that we don't really talk about all too often, but it's so very, very important, and I think a lot of folks will be paying close attention in 2020. So break it down for us.
They will be, because I think what you're going to see now is competition ramping up. You've seen for a very long time sort of CVS and Walgreens take the lead. Retail on the front end has always been just sort of a way to get people in the door, and it did translate for a very long time into some prescription sales. But I think increasingly, as more people are buying online, you also have the mail order, really ramping up, and more companies, not just the pharmacies themselves, but pharmacy benefits managers as well as insurers, really supporting this idea. I just got a call the other day from my pharmacy benefits manager saying, hey, we'd like to help you get a mail order on your prescription.
Why does no...
Well, you mean CVS was doing the delivery, that's another thing. And you could argue that Amazon set the stakes. Everyone thinks Amazon's going to disrupt healthcare. Sure, they're not going to kill it, though. So unless you adapt and get better at it, like look what CVS is doing. Look what Walmart's doing with their pharmacies and their health clinics. I think you have to be more like a one-stop shop and really leverage the knowledge of a pharmacist, too. Right. Because they can... this country's sick, and they are. A lot of people are sick. It's so true, but I think if you can leverage your pharmacist and have that relationship with them, that could really be something to watch.
So that's what it is. It's sort of this battle right now in the industry, right, between the tech sector and what they can do with digital health, with telehealth, and how they're developing this relationship, and what does that relationship even look like? Do people our age even have that relationship with their doctors, with their pharmacists? Not really so much. But when you talk about what Amazon is doing, what they're really doing is really on the logistics side, because their idea of buying PillPack and what PillPack is doing isn't the novel part. There have been companies that have been doing that for years, right? The mail order, the specific. There are even like companies that are making essentially vending machines for your pills. Like it'll just pop down when in your house when you need it. So it's going to be really interesting to see how this develops. Rite Aid's big push really came from the fact that they understand that they're in this competitive space and they're pushing out the pharmacy benefits side. So that's something that's really important to watch.
Awesome. I mean, the pharmacy talk, the healthcare talk is going to be really ramping up ahead of the 2020 election.
Yeah, you have to evolve too.
Yeah. So coming up here on Wi-Fi AM, managing money is not an easy task, but one company is breaking down everything you need to know, get this, on napkins. We'll explain right after the break. Well, if you find learning about money and finance challenging, fear not. Our next guest is all about making financial literacy as easy as possible. Tina Hay is the author of Napkin Finance, and she joins us now in studio. Tina, so this all started with one napkin and business school. So sort of tell us the story and history behind everything.
Sure. So I come from a liberal arts background, and I was pursuing my MBA at Harvard and found that I'm more of a visual learner. It's more difficult for me to connect with numbers and text, and most people are visual learners. And so I've always used images and graphics to understand different topics. Visual learning is a classic concept. Einstein, Da Vinci, Mozart all use images to solve the problems that they faced. And so what started as one napkin off of, with compound interest, grew into, now we have a library of content that we use internally, also with a lot of financial partners and nonprofits, organizations, and now the culmination is our book.
Tina, you also create videos too, though, right? So
Yes.
you're doing really multimedia when we think about it. I have to ask, because it's so interesting that you decided that everything should be able to fit on one napkin. Of all the napkins that you have created, which is your favorite and why?
So I have so many favorites. The first is compound interest, because it's just really the foundation and so such a key topic for within money and finance. Recently, we've created some content that is not evergreen. So things like how Kylie Jenner became the first self-made or youngest self-made billionaire, how Apple became $1 trillion company. But I love a lot of the content that we have. It's hard to pick a favorite.
I love that you're almost targeting millennials, it feels like, with this. And when you think about that generation, the younger generation, learning about personal finance, what is that one thing that you've come across that you realize this is just bad advice that people have been getting all along?
Sure, so there's a lot of bad advice. I think the one thing that we've learned is that simplicity is really the key. Whether you're developing a financial plan or trying to understand different concepts, we're bombarded with information, and I think the opportunity to kind of understand knowledge is power and also prepare yourself to make major life decisions is really key. So simplicity is really at the core of everything we do, and especially financial advice and information.
And who do you feel is more of a target audience? Is it people who, like you, were learning, and this is sort of like, you know, the Cliff Notes version for them, or is it people who don't really know and don't have specifically an interest?
Sure. So our content reaches all ages. We work with kids, we work with millennials and young professionals. We even work with AARP. We have a lot of older women who are connecting with our content. There seems to be no age window for learning about money. And it's not even about education. People can learn about different topics and be very educated in their profession. But when it comes to money and finance, there are different life moments and life stages where we need additional knowledge and information. So we're a great resource, especially when it comes to quick, bite-sized, snackable content in a world where we're bombarded with information.
Tina, hey. Thank you so much, and
Thank
have
you
a
for
Happy New
having me.
Year.
Happy New Year.
Well, those people that were trying to get their hands on the first edition of Ford's electric Mustang might be out of luck. When the car was unveiled in November, Ford began taking $500 refundable reservations for the car, but the company's saying in a statement today that it will not be taking any more reservations for its Mustang Mach-E. The car costs anywhere between $45,000 and $60,000, and it's roughly around the same price as a Tesla Model Y. Ford didn't say how many reservations it took, but it has said global production in the first year for all versions of the Mach-E is limited to 50,000 cars. Guys, it's a pretty cool looking car.
It's cool. It's interesting also to see that because, you know, with all the pressure that Tesla constantly has continues to face on its production numbers, I think it's interesting to see a legacy company like Ford sort of.
Well, maybe it's Ford putting realistic expectations on themselves,
so
right?
The same.
Exactly,
Yeah.
and saying, okay, I think it's realistic that we're going to be able to produce X amount of cars, and we're just going to stick to that. Who cares about the demand? We're going to stick to our numbers.
It almost makes it that much more appealing that they have this smaller batch, because when you see one of these Mach-E Mustangs, it's going to be a head turner. I feel like because it's going to have that beautiful Mustang look, but that quiet noise. And people are like, what's that? And so I feel like there's a point to that.
There's a point to that, and almost like a copycat, right, of the Tesla idea of going after that sort of luxury level first and then bringing it down to
and because it's kind of rare too.
Do you guys think though that sort of as a consumer, when we think about EV space, right, the EV cars that are out there, Tesla is sort of like the Mercedes-Benz or the BMW, and then we have Ford, which is just Ford.
I wouldn't say that
Ford's
anymore,
not just Ford. It's an American icon. The best-selling truck is the F-150. And when I was in high school, the Mustang was like the sexy car in the parking lot if you had a Mustang.
Wait, you had a truck?
I didn't have a truck. I wanted a truck. I wanted a Dodge Ram. I wanted a pink Dodge Ram. I did not get one.
So you're American muscle all the way.
I love a good truck. I'm not gonna lie. So make an EV truck.
Just going back to Tesla really quickly. The Model Y is supposed to be the same price point as this Mach-E, but the Model Y, we have no idea when that car is essentially going to be rolled out, because we did get a teaser earlier this year on what it's going to look like and the price point and everything, but in terms of when customers are actually get them is a whole other story.
Well, and that's the difference, right? Because Ford already has the infrastructure, the system, the knowledge to be able to do this, whereas in Tesla is building as it goes.
What are your guys' thoughts, though, on the fact that a lot of analysts say, well, Tesla's batteries are top-notch. Nothing can compete with Tesla's software or its batteries. So at the end of the day, you have to go Tesla or nothing.
They've seen that, of course, and all the companies that have come out and that have been trying to follow suit, the batteries fall short every time. Even companies like BMW, right? They come close, but they're not there yet.
Fair enough. Coming up here on Wi-Fi AM, it was a big year for the big screen and small screen. With Disney and Netflix dominating, we're going to break down all the biggest winners next.
All right, welcome back to Wi-Fi AM. I'm Scott Gamm on the floor of the New York Stock Exchange, joined once again by Peter Tuchman. Okay, happy New Year's Eve.
Same, Happy New Year. Happy New Year, everybody.
Thank you. Hey, you called it yesterday when we had some declines, that we might see more declines today, just given the profit taking that we tend to see towards the end of the year.
You know what? Look, this market, we had an interesting opening. Market is trading in a range. It is a little bit red. You know, funny thing is we're not accustomed to red, right? We could talk
Especially
about
not over the past 6 weeks.
Correct. We've seen this market go up, and away. We're trading at really high levels here across the board. I don't think anybody could have predicted it would be at this level today. So being off 40 points in the S&P 4 handles, it's right in line with a little bit of profit taking, a little bit of tax selling, and a little bit of a pause. Are we going to see a busy day? My gut is we will. Will it be a volatile day? I probably think it will. You know, it's the two voices. Is there anybody going to actually be buying stock aggressively on the last day of the year? Probably not.
Well, and we got, that tweet from President Trump with a specific date on when that phase one deal would be signed. I mean, not moving the markets, perhaps that was priced in.
You know what, I'm not clear if we really understand. And I think people are a little bit jaded at this point. What does that mean? If I were to ask anybody in the know, do we know what phase one is all about? Is there phase two and phase three? How much of this is locked in stone? I think the market is sort of disengaging from that. Yes, it's a good thing. Clarity on the Chinese story would be wonderful. We still have a lot left to know.
All right, so last week you printed the Dow 29,000 hats.
Yeah, I guess I may have jumped the gun on that.
There was hope we would hit it by today.
I was hopeful. I guess I was wrong.
We would
stand corrected.
We would need a 575-point rally in the Dow. I think that's a lot to ask for.
It is a lot to ask for, but it's possible.
All right, Peter Tuchman, thank you so much as always for joining us. Happy New Year. Wi-Fi AM will be right back after the break. Stay with us.
Netflix releasing its top 10 most popular releases from 2019. Topping the list at number 1 is Murder Mystery, the crime comedy feature film starring Adam Sandler and Jennifer Aniston. Number 2 was Stranger Things Season 3. And number 3, Six Underground. And that 3-hour Scorsese feature film, The Irishman, rounds out the top 5. So let's go over this list really quickly because I had not heard of Six Underground, had not seen Six Underground. Turns out I Googled it. It's the Michael Bay film featuring Ryan Reynolds. Got a 37% on Rotten Tomatoes. That was number 3.
Well, remember, we're talking about watched.
And right, most popular.
Most popular. So we're talking about, and according to Netflix's own words, it's someone who watches it for 2 minutes. So you could easily...
A whole movie, like 2 minutes
Okay,
of
I was going to ask, is it like you click on it and you're like, oh, okay.
And this is why, I mean, this brings up actually a debate in my head about, there are articles that cite, well, this is essentially the version of unaudited, right? And we know that Netflix is notorious for just releasing whatever
Which is Dan Roberts' argument.
And every time.
Yeah, every single time.
We talk about it so much on the show. And, if you look at the idea of, number 1, you're just counting people who've watched it for 2 minutes at least, that gets you nowhere. You're at the credits and you're like, well, am I going to care about this? And number 2, you're talking about Netflix itself offering these numbers versus like Nielsen or other, ratings. So I don't know. It's questionable as always, but is it interesting to see what people are clicking on at the end of the day?
The ones featuring the big stars and the big directors. Those are the ones that are getting clicked on the most. So
how do you even tell? How can you even tell who's behind the movie? Unless like Ryan Reynolds' face is on there.
No, and Dan Roberts always says this too. The pre-rolls that you see.
Oh, I hate those pre-rolls.
I hate the
But it's
pre-rolls.
so genius.
It is.
Oh, it's so obnoxious.
so
It really is.
genius.
I get sucked into watching some things that way. I'm like,
But it's also what plays isn't necessarily the preview. It's like sometimes giving you the whole entire show
Yeah.
in the preview or whatever it is that little box is showing you. But I think when I think about what I'm reading here, what we're talking about right now, this also just kind of plays into Netflix's strategy of spending a ton of money to get these directors like Michael Bay and get these actors like Ryan Reynolds so that they can get these 2-minute clicks and then thus say they had a crazy, crazy good year with a lot of popular pieces.
It's a good brand boosting. It's a really smart strategy for the dominant player who started, right, what we now know as a lifestyle.
Yeah.
We're just in the streaming lifestyle now, and if you're in that comfortable position, why wouldn't you use this method? Why wouldn't you use this strategy? There is nothing else out there.
I mean, the only one I watched on this entire list, well, I fell asleep during The Irishman. So great for napping. Highly recommend for napping. Great napping content. I watched Stranger Things 3, love Stranger Things. It's just a lot of nostalgia. I wasn't an 80s kid. I was born in the 80s, but I wasn't an 80s kid. But I just love that kind of sci-fi feel. So I can definitely see why that one was number 2 on the list here.
Can we just say Murder Mystery was honestly kind of
I tried watching it. I gave it 2 minutes. I watched that for 2 minutes, and
you
it was
counted.
terrible. I count. I contributed.
Yeah, this list is definitely most popular,
Questionable.
but doesn't mean it's the best quality content that they had on their site all year.
Absolutely.
Well, Disney's dominance at the box office is unmistakable. The media giant had 7 of the top 10 movies worldwide this year. On top of that list, we had Avengers Endgame bringing in a whopping $2.8 billion, along with Lion King with $1.66 billion, and Frozen 2 rounding at the top 3, taking in $1.22 billion. And right now, at the number 10 spot, we have Star Wars: The Rise of Skywalker, bringing in about $72 million globally. You are clapping in excitement. Julia, you watched 3 movies.
Yeah, but no, I watched 4 because I forgot to mention Downton Abbey and Angel Has Fallen and all those other.
But you're excited about Star Wars.
I'm excited about this. Because I've been watching Star Wars since I was a little kid. I actually, over Christmas, I had the original Disney Plus, aka a VCR, and watched it on VHS. So that is called real fan.
But that kind of like strengthens my argument that people that go to watch this are only people that are already fans.
No, my husband got into it because I made him start watching it. He had never seen it, and now he's totally into it because of that. So
did he rewatch everything though?
Yeah,
From
we
the
watched the
prequel?
original 3. Yeah,
What
not
about
the
episode
Clone Wars and that
1?
other garbage. Who cares about that? That's just that was bless their hearts. That was terrible.
You're like an elitist
Those
with
are not my
Star
favorite
Wars.
Star Wars. We'll never see those again. So maybe I'm not that.
So
I'm
you
a
have
fickle fan.
You have a movie date tonight to watch this.
Yes, I do. This is the way to spend New Year's. I'm not going to Times Square. No
one needs
freaking
that.
way. But I gotta say, this was Disney's year, y'all.
Yeah.
Not just
Oh,
the box
100%.
office, but opening up their Star Wars theme parks, Baby Yoda, Disney Plus, just tremendous year. Also want to give a shout out to The Lion King because I watched that on the airplane.
Oh, wow.
Beautiful movie, just so great, better than the cartoon. I
Really?
cried
I
in
was-
public.
I was weirded
cried
out by Beyonce singing.
Yeah,
No,
Country
oh
Music
my
Pretty in
gosh,
there.
Singing Nala's voice.
Can't you feel the love tonight?
I mean, it's good, but she kind of showed up Donald Glover because she's the vocalist of,
cares?
you know, the
Century,
decade,
yeah.
century, whatever you
I
want
don't
to
know.
say.
Just so many feels watching that movie.
But
It made me
also,
really happy.
Disney was Yahoo Finance's company of the decade because
correct.
it's honestly not just 2019 that this company has been thriving. This decade was dominated by Disney.
Big
essentially.
deals, Lucasfilms, and
Shanghai, Disney World, Disneyland. It was
navigated some also like just some crises as well.
Yeah.
And
Tremendous.
Going back to the, how we've all been influenced in our childhood by it, it's always been a pretty influential company if you think
Right.
about it, right? When Finding Nemo came out, how many kids were
Oh,
drowning trying to find Nemo?
In 2020, I will say I am very excited for Mulan, the
Yes,
remake.
me too.
I can't
Oh my
wait.
God.
I watched the
Being-
cartoon on Disney Plus.
I love me some
yeah.
Mushu.
Make a man out of you. Yes, I love that.
But
love that
so
song.
from the trailer, what I gathered is they're not having any of the songs in it.
Really?
It didn't
No, I
seem
feel
like the songs were in
Well,
it.
they had the Christina Aguilera, who was that girl I see playing
The
kind of
Reflection
music.
song.
Yeah, like a musical version.
Yeah, but Mushu was absent from the trailer as well.
yes.
So, I mean, I think that's going to be a defining Disney movie. come March.
I wonder if it's gonna. It gives me the feel of like a Wonder Woman type thing. I wonder if they're just. I think that there is this whole trend going on, and just like really strong, female leads, and trying to make it less of a cartoon, right? Like to take out the lightness of it and really give it that gravitas of like, here's a strong woman.
But when we talk about Mulan and the actress that's playing Mulan, we also have to mention that she was under a bit of fire earlier this year for taking the side of the Hong Kong police. Yes. Amidst the protests that have been raging and ravaging that part of the country or the part of the nation for a really, really long time. So it's interesting to see how that movie fares. I'm going to be watching it.
Me too.
I will be paying $18 a ticket to watch it.
Will. In theaters by myself.
Yes. Oh, you're not going to go on a date?
Well, I took Alec to see Beauty and the Beast live action, and
he didn't like
bless him. He's just such a good husband. That was so sweet of him to do that, but I'm not going to put him through it again. I will keep my Disney princess movies to myself.
We can just all three go.
Yeah.
Yes, we should go. We should go. All right, it's a date in the new year. Yes. Coming up here on Wi-Fi AM, Tesla CEO Elon Musk's space dreams might be about to come true very, very soon. We're going to explain right after the break. Elon Musk is shooting for the stars. That is today's Musk Minute. Musk is sharing photos of Starship, a new spaceship under construction at SpaceX's Texas launch site. He has been saying the rocket could be ready for its first flight in just a few months. And if the launch is successful, the company could take on an additional 20 prototypes. I feel like we talk about Elon Musk every day because he's literally dabbling in something,
doing everything
every day. Well, I mean, he does stir up a lot of talk and controversy.
And with the success that SpaceX has been seeing, right? I mean, we've been watching it from infancy, essentially. It's like watching your child walk, right? We're watching these rockets, re-land and et cetera. So I think it's about time.
Yeah.
Does Elon have too many irons in the fire, though?
Oh,
that's my argument every time. Company, Tesla,
Solar City.
Mm-hmm. Yeah, it just sometimes it seems like you can only dedicate so much time to something, and then you're out there, I'm giving a pretty lofty timeline there of when you want it to be completed. So
I think at this point we're kind of used to it, aren't we? Isn't that? I mean, the markets are just used to the uncertain timelines, the questionable rollout. Mm-hmm. I think to Julia's point, though, that has been my argument for a very, very long time, is that a lot of people say, well, remember when Jack Dorsey was under a lot of fire in 2016, 2017, because Twitter was underperforming? Oh, the fact that he was running Square and Twitter, how can one person handle all of that? Well, the same argument can be made for Elon Musk and Tesla, right? But to be fair, I do not think Tesla investors care because they are investing in Elon Musk. They're investing in the idea.
Right, so they don't necessarily care.
Absolutely.
Well, the stock is at all-time highs or near all-time highs. Okay, you make a profit, and so investors cheer it. despite it being sustainable or not, whether or not he's going to be able to meet the deliveries in the next quarter, that's all, that still remains to be seen, but investors do not care.
And this is, if you want to make a comparison, this is like pointing out that Amazon is in a million different places also, going into healthcare, going into the cloud, going into retail, right? You have a lot of companies that are in fact doing exactly what Elon is doing, which is just diversifying and getting into all these major, potentially profitable, new age type ideas.
The space race is hot, though.
You often hear the thing with Tesla or SpaceX, not SpaceX, but Solar City, for example. You hear and see on social media, it'll be like, oh my gosh, my car's on fire, or something happened to the car, and it kind of goes viral, okay? Or the Solar City panels catching on fire on Walmart stores. These are real issues too that come up from time to time, and you don't often hear about that with like Amazon, for example.
Well, I guess, we're going to see what 2020 brings for Elon Musk and all of his other companies. But don't go anywhere, because Wi-Fi AM will be back after a quick break. Welcome back to Wi-Fi AM. Let's take a quick look at how stocks are faring this morning. Markets are accelerating their earlier losses, but despite the recent pullback, stocks are still near those all-time highs and are on pace to close out their best year since 2013. But mark those calendars, because January 5th is known as Dating Sunday. The first Sunday in the new year is notoriously a busy time on dating apps, but Match is predicting the busiest dating Sunday in the history of online dating. Match is predicting an 80% increase in people using their app, and they've even predicted the busiest time of day is going to be 9:15 p.m. Eastern Standard Time.
That is so interesting. That's
precise, right?
True, though, because right before you go back to work on Monday, swiping right, swiping left.
Well, I think it's like, okay, it's Sunday night. I'm going to lay in bed. I'll just do some swiping and see what happens.
And it's after the holidays where you saw all on social media, everyone getting engaged or having their New Year's kisses. And it's like,
what happened to those gym membership sign-ups?
Oh, those are going to be.
Is that like not a thing anymore?
I guess not.
New Year's resolution, date more this year.
Maybe like a dating app with a gym membership involved.
Should we talk to Peloton? That would be so funny.
That would be.
They're already working
connect
on
with
that.
other Peloton riders. Like, oh, I like that. I don't know. I don't ride Pelotons, but
I think it doesn't work with Peloton though, because you're kind of just in your own living room or own home, and you're isolating yourself from other people in class. So maybe.
Peloton and Match should have a partner. They should have a conversation. Peloton, Match, have a conversation. We're asking you.
But Match sort of dominates the online dating space, right? They have Plenty of Fish. Right, and they recently acquired Hinge not too long ago. So the only ones that aren't sort of locked into under the Match.com umbrella is Coffee Meets Bagel and Bumble.
Is Coffee Meets Bagel still around?
It is. Oh. Yeah, it's a private company. Remember, they were on Shark Tank, though.
Oh, yeah.
And one of the sharks was going to invest in it, and they said, nah, we don't want to buy it. Yeah.
I mean, it is.
We had the founders on AM before.
Right. And to a degree, it is still a competitive space. It is something that, we are tracking just in this day and age where we're interacting everywhere online. It makes sense. It's interesting to watch.
And it's actually all generations, too. Like, I was actually talking to a woman, and she's probably in her mid 50s, and I said her husband and her, and I said, well, how did you all meet? And it was through a dating app. So it really is for everyone.
We're ending the decade, and so we've been looking back on the decade a lot. I feel like the surge in online dating, it was all this decade, right? It was, I think, 2011, 2012 is when it sort of started.
I had Match in 2010, like I actually used my laptop.
That's not to say OkCupid wasn't around before then, but I feel like the real popularity was just this decade.
And like the second half,
your
too,
iPhone.
of the decade.
Right, and it's
100%.
changed the way sort of people interact with each other in public places. A lot of people just go to Tinder and swipe and see what happens there.
And there used to be sort of like this stigma on it that there isn't anymore.
Zero stigma now.
Yeah.
But sticking with online dating, it seems like actress Sharon Stone will be joining in on the fun on Dating Sunday if her account doesn't get deactivated. Stone took to Twitter to complain that her Bumble account was deactivated after people reported the account for being fake. I mean, that's a fair assumption on the part of users, right?
Absolutely.
Why is this person trying to catfish me, being that catfishing is such a big issue within the online dating community?
Absolutely.
If you see Sharon Stone online, who's going to think that's
Believe
really
that.
Sharon Stone?
Well, now they will because they actually fixed the problem, and maybe this would actually open up an opportunity for more people who are celebrities to feel comfortable in venturing into dating. I could see Bumble asking Sharon Stone to be a spokesperson for them.
Absolutely.
How do you guys feel about the fact that a lot of these dating apps at one point had a specific sort of part of their app that was dedicated to celebrities or really wealthy people? Do you think that's discrimination at some point?
What was it?
There was that one.
That was like about your education.
Yeah. Oh, that's the league.
Oh, was it called Elite? Oh gosh,
just on point there, on the nose. No, I think that if you are specific, it is discrimination in some way, right? No, for sure. And if you're the type of person that is looking like that, I believe that there are other networks out there that you can be a part of if you're looking for that.
Yeah, if that's like your threshold for love, that is, come on. Like,
well, Julia, you've been in a relationship and then now you're married, so you haven't really dabbled in the
here's my
online
advice. Here's my unsolicited dating advice. Go to things with friends who invite you to different events, even if you don't want to go. I got dragged to a hockey game and I met my husband.
You know what? That's so funny because I was complaining about SantaCon and how New York City SantaCon is absolutely the worst day of the year. But a friend told me he was dragged to SantaCon and he met his wife there. And you can find love in the craziest of places, right? You never know. But thank you guys so much for joining me on this final show of this year. It was so much fun. We're gonna check back in next year too, right?
Next decade.
All right. Well, that is our show today. Thanks so much for joining us on the final day of the decade. Happy New Year. We will see you back here Thursday at 10 a.m. Eastern, but don't go anywhere because On the Move starts in just 2 minutes.
It is 11 o'clock here in New York City. 90 minutes into the trading day, stocks are selling off a bit right now. The Dow, S&P 500, NASDAQ in negative territory as we end the year and the decade. Time to sign. President Trump announces plans to sign phase one of the trade deal at the White House in mid-January. Ghosn, gone. Nissan's former top executive, Carlos Ghosn, flees Japan for Lebanon. The details of his daring escape just ahead. And tech fights back. Uber is among the big names challenging California's new gig worker bill. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks so much for joining us on this New Year's Eve. We are 13 hours away from midnight here on the East Coast, but we want to wish a Happy New Year to everyone in Beijing as well as in Taipei. Take a look at these live pictures as they celebrate the next decade and ring in 2020 on the other side of the world. This is Beijing in particular, as you can see, as the celebrations are ongoing there. And of course, we'll spread across the world. We'll be showing pictures from some of those places.
Speaking of celebrations, progress on trade to end the year. President Trump says he will sign phase one of the trade deal with China in January and will travel to Beijing at a later date to start working on phase two. Let's go straight to Washington and Jessica Smith, who has details for us. Jess?
Yeah, a little more than 2 weeks after the U.S. and China announced this phase one deal, we now have a date for the signing. President Trump tweeted this morning saying, "I will be signing our very large and comprehensive phase one trade deal with China on January 15th. The ceremony will take place at the White House. High-level representatives of China will be present. At a later date, I will be going to Beijing, where talks will begin on phase two." Now, the president did not specify who from China would be coming to sign this deal. Earlier this month, Ambassador Robert Lighthizer, the top trade representative in the U.S., said that he expected this to happen on a ministerial level. So we'll be looking for more info on that. Another new piece of information in that tweet, President Trump says he'll be traveling to China for phase two. Ambassador Lighthizer told reporters earlier that he wanted to see how phase one went, get that implemented before starting phase two. And it's not exactly clear what is going to be included in phase two, but it could be the trickier issues like Beijing's subsidies for Chinese businesses. But again, this phase one signing will be on January 15th, according to the president, and then the deal should go into effect 30 days later. Adam and Julie.
Jess, thank you. Appreciate it. Well, we are, of course, nearing the end of the decade. 2019 was a big year for stocks, and this decade brought the longest bull run in history. Scott Gamm on the floor of the New York Stock Exchange to help us look back. Scott?
Well, Julie, it was just about a decade ago, early January of 2010, when the Dow Jones Industrial Average was trading at 10,500, give or take. Fast forward a decade later, and we are nearing 29,000 on the Dow. That's a 175% increase over those 10 years. Now, of course, a decade ago, in 2010, we were still reeling from the financial crisis of 2008 and 2009. But it's not just stocks that have had a striking move over the past decade. Take a look at bonds as well. The 10-year Treasury yield in early 2010 was trading at about 3.8%. A decade later, it's about 2 full percentage points below that level at about 1.9%, although it was just 13 months ago when the 10-year yield was over 3%. So certainly a lot of volatility in bonds over the past decade. And then finally, oil prices. A decade ago, early January of 2010, West Texas Intermediate, that's the U.S. benchmark for crude, was trading at about $79 a barrel. A decade later, it can barely even stay above $60 a barrel. Of course, the U.S. shale revolution, so to speak, has really come to light over the past decade, with the U.S. flooding the scene with oil production, which of course has pushed down prices for the benefit of consumers. Julie, Adam.
Scott, thank you. We want to talk more about the wild decade for these markets, and let's introduce this hour's panel. Bruderman Chief Market Strategist Oliver Porsche and Lending Tree Chief Economist Tendai Kapfitze. Good to have both of you here. Is there any one thing that you think should stand out in the minds of investors as we look backward to help them figure out the next move going forward?
Yeah, it's very easy. Don't fight the Fed. This was a lot of money printing over the past decade, easy monetary policy. But also combined with that, because they tried that in Europe as well and didn't go as well, a lot of fiscal stimulus as well. So don't fight the Fed, don't fight Congress when they're spending money. Very simple.
What do you think?
I mean, that's spot on. And I think that when you look forward, though, you have to ask the question, when is the money being taken away, right? When are they taking away the punch bowl? There's been some emergency liquidity provisions that were put in over the last few months by the Fed because of the repo rate issues that we experienced back in September, October, right? That is set to go away in April. So you want to pay attention to that and see what type of words come out of the Fed, what kind of actions come out of the Fed to make sure that the punch bowl doesn't get pulled away too aggressively. Because when you think back over the last few years, the Fed has done a lot of things very well and were right, but they also had some pretty big missteps, mainly a couple of years ago when they raised rates way too fast. So that's the thing to look out for.
And what about on the fiscal stimulus front? Because obviously we're going into an election year, and it doesn't look like, at least in the very short term, that there's going to be any fiscal stimulus. Maybe out to 2021, there'll be some talk.
Yeah, I think that's okay. At the end of the day, the U.S. economy is a consumer-driven economy. You are seeing some modest wage growth starting to pop up, and so that's a big positive. The consumer, while leveraged, is not over-leveraged. And now that we're getting some clarity on trade, there's a possibility of businesses doing more investment, and that could be very helpful. I think if you're looking at 2020 as a whole, the sky's pretty clear, at least as far as it can be.
Okay, I get don't fight the Fed, but when I hear Oliver say, they're eventually going to have to pull that punch bowl away, I immediately think of Japan, because the punch bowl didn't get pulled away. And we are, in one regard, we're going to be talking about this later on, our birth rate and our population growth rate are at levels not seen since almost 100 years ago. They're essentially flat. How are we not Japan? Why would they pull the punch bowl away?
Yeah, so I think that's the big question, right? And a challenge for the Fed now is, can they tolerate a decline in the stock market, for example? Are they open to that? Because it seems every time the stock market wobbles, they kind of get spooked and they act. And then on the demographics, we have had a decline in the growth rate, but it's still positive, whereas, in a place like Japan, it's negative. So, as long as we stay positive on demographic growth rate, maybe get a little bit more immigration, maybe after this administration, then, this.
And Dai's advice in 2020, make some babies.
The issue, though, the issue on demographics that the U.S. Is facing is a shrinking working population, right? The amount of adults that are able and willing to work, the 18 to 65, it continues to shrink. So in that sense, it's negative population growth. And that means you're going to continue to see very low unemployment numbers, but little wage growth. And that's problematic because you need productivity then to be the key driver. And that's unlikely to happen in the next 20 years as the way it did in the past 20 years.
It also seems like the next decade is by necessity going to have to bring more of the retraining that we've been talking a lot about, but not necessarily seeing as much of. And maybe also, we've talked about this trend, people have been very reluctant to move to where the jobs are in many cases, right? Or they've been reluctant to move, period.
They've gotten burnt the last couple of times they did it, right? The big shale boom when people moved to North Dakota, and then all of a sudden that goes away because prices collapse, and you're sitting in North Dakota doing nothing. I mean, there's nothing, if there's no job, you've got a problem. So that explains the reluctancy. Again, I think overall on balance, 2020 is a pretty positive year for everything, for the economy, for markets. But there's certainly headwinds to watch out for.
Yeah. I think the big risk for 2020 is still on the business side. So this year we had a strong consumer year. Business spending and investment was kind of weak. I think with the election coming up, there's still uncertainty, in corporate boardrooms and, corporate investment teams as to where they put their money and what kind of legal or regulatory environment they will face after 2020.
Well, speaking of both legal issues and corporate uncertainty, I think this falls into both categories. Former Nissan chairman Carlos Ghosn, he fled Japan. There he was facing charges of financial wrongdoing. Ghosn confirmed that he traveled to his homeland of Lebanon. In a statement, he said, "I will no longer be held hostage by a rigged Japanese justice system where guilt is presumed, discrimination is rampant, and basic human rights are denied." And reportedly, he snuck out of Japan in a box used for what? Musical instruments. This was a real cloak and dagger operation. And he had been sort of in and out of detention and finally just said, and apparently he's got a lot of support in Lebanon.
Yeah, I mean, look, I'm not a legal expert and certainly not an expert on Japanese laws, but my understanding is that 99-point-something% of people accused of these types of crimes are found guilty, and then the government gets to appeal in the off case that somebody's found not guilty, and you got to go through it again. Look, he's effectively a fugitive at this point. And so we've seen this before throughout history. He's given up his adopted homeland in this case, and it is what it is.
From a bigger picture, though, it's not only a black eye for the Japanese, but it is also, when you look at Nissan, he said that he was the fall person for wrongs at Nissan that he did not commit.
Yeah.
So does the focus now, are we going to focus on Nissan, which, by the way, has not had a good year?
No, I think probably the story ends. And I'm not an expert on Japan either, but I did my very scientific survey of one of my Japanese friends, and he thinks they let him go. He thinks that it was kind of a face-saving deal where they have the Olympics coming up next year. They don't want everybody focused on this. And it's kind of like, well, everybody exit the stage, and it's done.
What a great
Wow,
movie.
little
Netflix, are you watching?
Theory that's going on. And in the meantime, of course, we also have with Nissan's partner, which of course Ghosn was also involved in, a merger that is going on. So one would imagine that they wouldn't want the distraction as Renault and Peugeot get together of this ongoing.
Yeah, I mean, look, it's a mess, but like most of these types of messes, I think 6 months from now it will be forgotten of because that's just, we move on.
What
right?
happens to him? Does he stay in Lebanon? I mean, if he came to the United States, I imagine we have an extradition treaty, I don't know for a fact, with Japan, but where does he go?
I would think he stays in Lebanon.
He might be able to go to Brazil also.
Nice beaches.
Yeah, he was born in Brazil.
Yeah.
He was born in, and Bolsonaro certainly wouldn't care about a treaty, whether he has one or not, so.
Yeah.
All right. Tech fights back. Uber and Postmates filed a complaint in California's federal district court alleging that a bill limiting companies from labeling workers as independent contractors is unconstitutional. Joining us is Dan Howley, who follows tech for us. And I got to ask you a question. When you look at what they call it AB5, that's the bill that's now being challenged in court. There are a bunch of exemptions for industries with freelancers or part-timers. And the argument they're making is these exemptions make no sense.
Yeah, that's really, I mean, I'm done.
Sorry, I didn't mean to steal your thunder.
No,
And it's
I'll
not
take
even
off.
just exemptions for other industries, it's even for other jobs at these companies, right?
Yeah, so basically what Uber, Lyft, the whole gig economy, as well as media actually, is fighting this for is because of these exemptions. Now, in this particular case, Uber and Lyft are essentially saying, look, what you're doing is unconstitutional because you're targeting us specifically and allowing other industries to kind of escape these kinds of parameters.
Picking winners.
Right, exactly, and that's the what the crux of their argument is. Truck drivers, fishermen, they're all exempt from these kinds of rules, whereas drivers for Uber and Lyft, Postmates, whatever, they all would fall under it. So essentially, what's going to happen is, if this continues as it seems to be tomorrow, these drivers or employees would end up becoming either part-time, full-time. They would be given the kind of protections that regular employees of businesses have, rather than being treated as freelancers. Now, for Uber and Lyft, they say that means it could impact service in certain areas of California, because that means that they'll end up having to pay out certain protections, healthcare, what have you, to these workers, and that will put a dent in their bottom line. So they will have to potentially cut back on the amount of drivers that they allow. Now, on the media side of things, some companies out west, Vox Media has come out and said that they're cutting some of their employees who are freelancers for coverage of certain California-based teams, or if they're based in California, because according to the rules, they can only write something along the lines of 40 or so articles per year for each individual site that they might work for. And then beyond that, they're full-time workers. So because of that, they're being cut, and they're going to try to hire in full-timers and part-timers now. So it's really interesting to see the different swaths of the economy that this is going to hit.
So I'm not an expert on the law. It generally sounds to me like it's somewhat of a poorly written law. But isn't the bigger question here more of a cultural question around the tech industry itself? And by that I mean, there's a culture of like celebrating these big valuations, X billions of dollars, 50 billion, 80 billion. And it's just like huge, huge numbers. And then the people who are doing the work on a day-to-day basis are kind of, struggling. And in some senses now, because I think there's pressure on profitability, they're getting, pressure on their earnings from these big companies. But the companies want to keep pushing out the big valuation headlines.
Yeah, I mean, that's really where this comes from is, Uber, Lyft, they were valued at, multi-billion dollars, still don't make money, but
they don't make money. That's the key, though.
Right.
And do you want to spend, if you have a $10 Uber or Lyft ride, are you willing to spend $20 so that these people get a living wage or are considered full-time. That's really what it boils down to, doesn't
Yeah,
it?
I think that's the moral question that people will have to answer. I mean, there's also, for instance, traditional taxis that have been pushed aside as a result of the likes of Uber and Lyft being able to offer on-demand and in some cases cheaper service. We've seen in New York City the kind of wrangling that's been going on between how they can get medallion cabs, the traditional yellow cabs, and Uber and Lyft to exist in the same ecosystem on the roads. Hasn't really worked out either way yet. But yeah, I mean, it's going to come down to, will you pay more, will you not pay more, and how much will this impact the companies?
Most of the time, people have chosen not to pay more. If you look at different instances, and look at the Amazon situation right now, right? There have been a number of reports of various abuses, or at the very least, sort of too stringent requirements for workers in Amazon warehouses. Amazon doesn't seem to be slowing down. And it happened with Walmart in the 80s and 90s, if you recall, where people criticized the company for putting small businesses out of business. Walmart didn't slow down because people wanted lower prices.
Right, and I think this is something that's going to continue to evolve. Obviously, the idea for this suit will eventually flush itself out, I guess. We'll find out whether or not Uber and Lyft will continue to be targeted by this or not. And I think for the average worker, there are arguments on both sides. We want to be treated better by these companies.
And there are workers who are parties to this suit.
Exactly, yes.
But I mean, when you took the job at Uber or at Lyft or any of these places, you know the deal going in, right? You're not, and so this is, and look, I understand that there needs to be certain regulations and there needs to be certain standards. But this, I think, is really a case of, I don't think any person, and I know a couple of people who drive for Uber and Lyft, go in there saying, well, geez, I'm going to have a great benefits package, right? That's not part of the deal when you take that. It's extra money. And that's how they advertise to get people to do it, right? Do this in your spare time, earn some extra money. And then some people do it full time, and that's great. I'm not saying anything against it.
But you're saying they'd make the choice to do it full time.
You made that choice ahead of time. Maybe it's time to reconsider. I can tell you, for me personally, I mean, I prefer taking the subway in New York City any day of the week. But if I end up taking motorized transportation, I'll take a taxi cab over an Uber or Lyft inside New York City anytime because of availability and because of reliability.
But isn't it that most of the people who are providing the majority of Uber's services are really doing it on a quasi full-time basis, right? There's more drivers who do it part-time, but the volume of the transactions volume, most of the rides are with people who are doing it full-time.
I agree with your initial point of saying it's a poorly written law.
We'll debate more off camera. Thank you so much, guys. Dan, thank you. Coming up, changes to your retirement plan, how a new bill going into effect tomorrow could affect your savings. Plus, record growth at Huawei, how the Chinese tech giant continues to succeed despite the White House's best efforts to harm the company.
All right, welcome back to On the Move. We are looking at stocks under a little bit of pressure. The Dow Jones Industrial Average, that's down about 16 basis points. But we're going to take a longer-term look. This is a 6-month chart, and we're going to actually go to the S&P 500 because we're right at support right here. If we go down a little bit further, 3192 or thereabouts, we do have some more support, but what we're really focusing on is the VIX. That kind of tells a story, and again, we're watching this trend line. Might have a spike up to about 16.5, and if we do retreat from that level in the VIX, that could mark a bottom in equity. So we'll be watching out for that. 10-year T-note yield, not doing much here today. It's only up about 1 basis point, but we can see over the last 6 months, it's kind of been consolidating in this wedge that's formed right here. We also want to take a look at gold because that is up again today, kind of nicely to end the year. We've had a 3-day rally, and we can see that it hit about 1530. That is a little bit of resistance, but 1520 is held, and that's a level of support that we want to watch, 1524 as we sit here. And then the NASDAQ 100 heat map. We're not going to look at today, we're going to look at year to date, and we can see the tech BMOS over here. A lot of the FANG stocks delivering results. Apple up 85%, Microsoft 54.5%. Alphabet came back as of late, it's up 28%, and Facebook 56%. Only Amazon kind of underperforming the market, but it has bounced back over the last few days. And if we sort by performance here, we can see the chip stock really coming out ahead. AMD, that's at the top, up almost 150%, followed by Lam Research, about 112%. Look at that chart. Really not much of a retracement while the trade war was going on here. That has been the strongest stock of the year in the NASDAQ. We'll be right back.
A newly signed law called the Secure Act was created to expand ways all of us can save for retirement. The changes go into effect tomorrow, and one area that's going to be impacted is investing in annuities. Joining us now to talk about what this means for investors as well as your 401k is Ramsey Smith, founder and CEO of Alex FYI. And Ramsey, joining us from Key Largo, say hi to Humphrey Bogart. So how does this work? There's going to be an annuity now offering perhaps in my 401k. Should I be worried? Because I see those ads on TV that say, beware annuities.
All right, so first things first. I want to say that the Secure Act is a really big win for the American consumer. And it's a big win for a number of reasons. For one thing, as proof of that, it had bipartisan support. It passed in the House 417-3. So there's a lot of agreement on what this can do. It's actually going to take some time before we see the actual implications from an annuity perspective be rolled out. Essentially what it does is it makes way for the provision of annuities in 401k plans. Historically, that is not something that was done for a variety of reasons. One of them was an issue around potential liability for employers. And so employers have been given safe harbor that allows them to proceed to add annuities to the mix without creating undue liabilities for them on a going forward basis. So at the end of the day, what's happening here is that consumers are going to have more choices, and more choices are better as far as I'm concerned. And then secondly, the annuities are going to be part of employee-sponsored plans, and there's a lot of great benefits for that, including greater cost efficiencies.
So it seems as like it's also a big win for the industry that's offering these annuities, right? Because they'll have probably bigger customer base to choose from. Is there anything that people need to be aware of when they are looking at these various choices?
So I'm going to answer both parts of that question. First part of the question is it good for the insurance industry? And I think it is. I think it's going to bring more attention to the benefits of annuities. It's going to create broader availability. It's going to create availability to potentially smaller clients. So in that sense, it's good for the insurance industry. But at the same time, I think it's fantastic for consumers because your employer is going to be able to negotiate essentially on your behalf to be able to get you potentially fantastic deals. I actually, my hypothesis is that this is going to be a very, very competitive market. And in fact, I think the insurance industry is going to have to do a lot of work to set up for a business that's going to be built around lots and lots of potentially small accounts as opposed to fewer.
The issue is really that you're assuming that the employer is going to have the wherewithal to negotiate, and you're talking about fees specifically. I think that the unspoken risk in all of this, and I agree with you that more choice is generally better, but annuities specifically are very complex. There's a number of there's variable annuities, fixed annuities, indexed annuities. They're complex instruments, and investors in their 401ks who are trying to save for their future, being asked to make those additional decisions and analyses without necessarily having access to financial professionals that can walk them through that in a fiduciary capacity, I think raises some real risks and some dangers. And we just don't know all the answers. As you said yourself, it's going to be months, if not possibly a year or two, before we fully understand the trickle-down effect and the impact of all of this. So my advice to anybody who would be asking me would be calm, be careful, and understand the risks.
Let me take up what you're saying, and I have a question for you, Ramsey. Let's say for this question, you have $100,000 in your 401k. You're in your late 40s, early 50s, and now you get this annuity option. If you're looking at putting, $100K into the annuity, I think fees can be anywhere from 6 to 10%. Are you looking at losing $10,000 just for the privilege of putting that money into an annuity that would then guarantee you income when you retire? How is this going to work?
All that remains to be seen. For one thing, you could wait till closer to retirement to buy the annuity, and you can invest in stocks and bonds in your or stock and bond mutual funds in your 401k in your earlier years if you so choose. And I think the fee issue here is a very important point. Now, and from my prior visits to your show, that I'm a strong believer in very, very simple annuities that look as much as possible like traditional pension plans or Social Security. Those tend to have lower fees, and you know what? They can go even lower, and they're very, very they're as simple as you can get in terms of the annuity offer. So what I would like to see, the market share of simple annuities. So that would be immediate annuities and also deferred income annuities grow dramatically on the back of this. So I'd much rather see growth in those particular types of annuities versus variable and other types of more complicated annuities.
All right. Thank you, Ramsey. Great to see you. Enjoy the rest of your time down there. We'll see you again in person soon. Appreciate it.
My pleasure. Take care. Bye-bye.
Well, Huawei seems to be shrugging off any impact from the trade war. The company reported sales growth of 18%, record revenues of $122 billion. This despite the Trump administration's attempt to crack down on the Chinese tech giant. Joining us now with more is Akiko Fujita. Akiko, it's not publicly traded, so these are the self-reported numbers. Do we know how much credibility they have? I believe they're also unaudited.
They're not audited numbers. So this is basically the company self-reporting. But if you look at the individual units of Huawei, so we're talking about the consumer division, the carrier division, the devices division, it's all posted consistent growth this year. If you look at smartphones alone, roughly 28% growth. Double-digit growth, more than any other smartphone company out there. So what they have done, though, they've found the growth in China.
I was going to say, most of that growth is the...
So a lot of that growth has been in China. And so I wouldn't say they're necessarily shrugging it off, because if you look at the numbers that came from the rotating chairman, Eric Xu, they were lower than the company's projections. And I want to point to something he said in this New Year's address, because he does suggest that there's some bumpy roads ahead going into 2020. Specifically, he said, we won't grow as rapidly as we did in the first half of 2019. Growth that continued throughout the year owing to sheer momentum in the market. It's going to be a difficult year for us, and survival will be our first priority. So he does suggest that next year may be a little rougher, and he also talks about potential cuts and downsizing down the line. So I wouldn't say it's all a rosy picture, but I think the takeaway from this New Year's message that reported these numbers is essentially that this U.S. attempt to basically bring Huawei to its feet hasn't had that impact.
Well, why is it, looking forward perhaps in survival mode, if very little of the business in the United States, is it because they're not getting the supplies or the parts that they need from the U.S. exporters?
So that's part of it, because if you think about when the company was put on the U.S. entity list, which essentially banned American companies from supplying to Huawei, that was back in May. Now, reports at the time suggested the company knew it was coming, so they stockpiled enough parts to last through the rest of the year. So that would suggest that maybe, going into next year, it could be a little rough. Having said that, they just launched their high-end phone, the Mate series, and that didn't include any American chips in there. So that was a big statement. And also I would point out, it's not Chinese suppliers that are supplying to Huawei right now. It's NXP from the Netherlands. It's Sony and Panasonic from Japan. So all of the U.S. pressure to try and get other companies in other countries to ban Huawei just hasn't worked, or at least affected their product just yet.
So what's their path to resolution to their problems with the U.S.? Because I don't think Huawei, it's not part of this phase one deal, right? Is it a part of the broader trade negotiations, or is it a completely separate issue?
Well, I think that's still a big question mark, right? The administration has gone back and forth on that. What we do know is the Commerce Department has started to grant licenses again to American companies like Qualcomm and Intel so they can supply to Huawei. And I would argue that the last several months, 6 months, 7 months, Huawei has essentially been buying time. They've got, their R&D center in overdrive right now to be able to supply themselves moving forward. So on the one hand, they're pushing forward on that so they don't have to rely as much on other suppliers, but they've also got suppliers outside of the U.S. And so I think it's twofold in terms of how Huawei moves forward. In terms of what the U.S. resolution is, I think that's still a big question mark, and we don't know if it's part of the trade discussions.
Akiko, thank you. Coming up, protecting your privacy, how a new law is set to help California residents keep their information private. Plus, before we go to break, take a look at some of the trending tickers right now on Yahoo Finance as we get ready to close out 2019.
Just after 11:30 a.m. here in New York City, about 2 hours into the trading day, we've got stocks pulling back a little bit on the last trading day of both the year and the decade. And oil, let's take a look there. We've seen it pulling back as well today. It's down about 0.5%. Hack attack, what you need to know after Microsoft warns North Korean-backed hackers tried to steal highly sensitive information. From the possible end of Uber Eats to Tesla's China dreams, Wedbush's Dan Ives joins us with his top predictions for the next decade in tech. And crypto crushes it. We're breaking down Bitcoin's wild ride over the past 10 years. Welcome back to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. Good to have you here. As we ring in the new year, the toughest data privacy law goes into effect in California. Starting January 1st, all Californians will be able to find out what personal information a business is collecting about them, their devices, and their children. Companies are also mandated to tell you what they are collecting and delete it all, but only if you ask them to delete. Yahoo Finance's Dan Howley joins us now. And Dan, so this is California specific. will it come to the rest of the nation? Because usually what happens in California happens everywhere else.
Yeah, it spreads like a vine. Yeah, so it will.
It already has, right? I mean, haven't you guys been getting all these email notifications?
I actually haven't received
I've been
any.
getting them.
The big thing. So this law has a lot of facets to it, and it's pretty complex in how it came together. Originally, it was supposed to be a ballot initiative, and because it was a ballot initiative, the legislation in California wouldn't have been able to alter it if it was put into place as law through that. So there was a lot of wrangling back and forth, and eventually it became the CCPA, California Consumer Protection Act. And really, it doesn't just apply to the likes of Google, Apple, Amazon. It's everything from Home Depot to Facebook and Walmart, everyone in between. Anyone that collects your data, makes over 25 million in revenue, or collects the data of more than 100,000 people, those businesses fall under the umbrella of CCPA. And really what it means is if you are a resident of California, your data will be collected, but you have the option to opt out. Now that differs dramatically from the EU's GDPR, which is an opt-in. So they'll already be collecting your data, and then you have to tell them, turn that off.
Would it perhaps be the best move, but would this apply to the credit scoring agencies?
So that's actually something that's going to be exempt from it because of credit regulation. So that's totally not involved in this. This is more of who's taking my information that I like to look at dog videos and selling me dog food. That's basically what this comes down to. A little more important than that, but and so what's happening now is companies, Amazon, Microsoft, Apple, they're all now saying that they're going to extend the ability to see what data these companies hold on you and then ask for it to be deleted to everyone across the US. And the reason why they're doing this is because it's easier to have one website and one rule for the entire country, and B, they want a single piece of legislation to govern all of privacy rather than a patchwork of laws. So they're jumping on this California initiative to basically say, look, let's just do this. Let's get this over with already. But there's one problem. You don't get the same protections that Californians get with your ability to fight back. So if they screw up and say they were collecting your data when you said, don't collect my data, you can do nothing to them. You can't sue as a result of them losing your information if they happen to lose it. And there's a whole bunch of different caveats there that are problematic that the ACLU and people who originally drafted this first initiative take issue with.
So it's surprising to me, or interesting to me, that we get a lot of these regulations coming out of California, where the tech industry is so huge. I think typically jurisdictions try to defend the industries that are big within their areas from other, regulations from other jurisdictions. So does it mean that we get smarter regulation because maybe the tech companies are involved in the crafting of these regulations because they're coming from California?
So that's part of the issue with it going to the legislature, right? If it was originally voted on by the citizens as it was proposed as the initiative that was put forth, the tech companies could have had nothing to do with it. They would have had no input, and it would have just gone into law like that. It just would have been a huge hammer for a small nail, basically. And so now what this did was it allowed the companies to come in and say, well, we kind of want this, but we want that, and we don't want this. And as a result, you have no private right of action, which means that if someone does end up selling your data and you told them not to, well, you can't sue. That's just too bad. What can happen, though, is the Attorney General steps in and says, now we're going to sue as the state. But the state Attorney General of California has said we can only cover maybe 3 cases a year. So there's too many companies in the country for the state to handle. And if it goes nationwide, then maybe it'll have a chance to really take effect.
Thank you, Dan Halley. We'll talk about that in 2020, I'm sure.
Yeah.
All right, coming up, Hair of the Dog. Red Lobster is ringing in the new year with a Bloody Mary that will satisfy even the hungriest of hangovers. Plus, we'll look back at the past 10 years for Bitcoin, how the cryptocurrency could sustain its record run in 2020 or not. Let's take a look at some big movers in midday trading right now. First of all, on the upside, we've got FuelCell, which is rising today, but it's been rising for the past several days, ever since it said its wastewater treatment facility in California started commercial operations. Late last week, it said it had entered into a 20-year power purchase agreement with the Southern California Edison to buy renewable and carbon neutral power to then supply to the California grid. This company relatively heavily shorted until recently. As of the end of November, about 20% of its shares of its float was sold short. So some of this could be short covering. And then we're looking at McDermott, and this has been a story all year long. This is an infrastructure provider to the oil and gas industries. It's been trying to integrate the acquisition of Chicago Bridge and Iron, not very successfully. Talked about hiring advisors back in September. Now there are reports that the company is negotiating with lenders ahead of a potential bankruptcy filing. That's been a specter that has been haunting it all year long. We'll be right back.
Microsoft is targeting North Korea with a lawsuit. The company is suing North Korea Hacking Group for allegedly stealing highly sensitive information from computers here in the United States. Joining us now is Ron Gula, president and co-founder of Gula Tech Adventures. Suing North Korea, where and how do you make that actually happen? How do you collect if you win?
That's an excellent question. So hats off to Microsoft for suing people out in North Korea. I think what's most compelling that Microsoft's doing is they asked for help. They actually published information about what these hackers are doing, what resources they're having. They asked for people in the United States and worldwide to take them offline, which is a great thing.
And so now what?
Yeah.
If they're doing this.
I mean, it's even though it's hacking and it's North Korea, this group's been active since 2010. And they're basically phishing people. They're sending out emails and getting people to cough up their usernames and passwords. And I think we've done this story probably 1,000 times this year. I'm probably going to do it 1,000 times next year. It's the kind of things we need to do to educate people and talk about this. But hats off to Microsoft for trying to go to the heart of the problem after the hackers themselves.
Well, you think back to what was the North Korea Sony attack a few years back. When you say the things we can do, what are the hackers doing to shut down, the U.S. hackers doing to shut down the North Korean hackers at the request of Microsoft?
Well, we operate in cyberspace, and cyberspace is mostly in the United States. So there's a lot of stuff that we can do as people. We always give too much power to these hackers who are trying to take our data and whatnot. We can actually control what's on our network and how things work. So publishing information and sharing it allows people to reconfigure their networks, clean up their email, fix their DNS, and it's a good thing to be doing that.
Ron, I want to ask you, we were just talking about the new California privacy regulations, and obviously that's information that you give voluntarily, right? Or at least in theory, you're giving voluntarily. But what's your view on that new legislation and whether it will indeed protect people if you tell companies to delete your stuff?
So the legislation is really good. Not only does it force organizations who collect data to have a sense of what they should be doing with it, a byproduct of that is you're going to increase the cyber hygiene and the amount of security defenses that organizations might not otherwise have. And also, there's a lot of people who think cyber doesn't affect them. They might be collecting data. They might think they just have credit card data, but maybe they have a mailing list for their customers. That data could be subject as well, depending on how much information is on there. So anything we can do to raise awareness, I'm a big fan of.
Do we really need to change our passwords every year or more often? Because I'm thinking how many passwords I have, and keeping track is just a nightmare.
Well, password complexity is definitely a usability issue, and it's very inconvenient. But we've innovated quite well in the cyber industry. We've got ways to authenticate with multiple ways to save your passwords, with identifying your computer, with trying to look at the patterns of how you're using that. And most of the industry is adopting that. So, I think it's still habit that we have the same passwords, and that's bad. But we have a lot of options. If you're frustrated with changing your passwords, you should be talking to somebody else about ideas of what you can do to manage them better.
Ron, good to see you. Ron Gula is president and co-founder of Gula Tech Adventures. Thank you.
Happy New Year.
You too. All right, it's been a blockbuster decade for Bitcoin. The cryptocurrency has seen 9 million% increase since its creation. Let's turn to the panel for their thoughts on this. I mean, obviously, that's from zero. But is this? Have you looked at Bitcoin?
So I own several cryptocurrencies. I got into them 2016, late 2016, early 17. I bought them equal weight with the specific thought that there's something here. I just don't know what it is. I own 5 of them. I think 2 of them will probably go to zero. 2 of them will kind of just do, and if I'm lucky, 1 of them becomes an all-star. As it pertains to Bitcoin, I think from an investment perspective, you have to put it in this pure speculative category. Just look at the wild ride this year alone, right? A few months ago, it was at 13,000, then it fell down to 5,000. Now it's at 7,200 or something like that. So the thing goes all over the place. And so you don't want to look at it as a traditional investment. You want to look at it as something as speculative. The one thing I will say that makes me feel a little bit better about all the cryptos, there's no longer that fever pitch that we saw in late 2017, early 2018, where everybody had to have it. Bitcoin went to 19,000 something at one point with no justification
Some of
whatsoever.
that was the confusion over crypto and blockchain and crypto, because one is not necessarily the other.
Yeah.
But
Bitcoin is the first use case
of blockchain.
Right?
But blockchain is not crypto.
Correct.
So where do we go from here with these cryptocurrencies? I just heard you say there's something here, but I don't know what it is. I'm thinking of, investors. You clearly went in knowing you could lose the money, but there's something here, I don't know what it is, not the safest case.
I know exactly what's there. It's a pyramid scheme. You only make money based on people who enter after you. It has no real utility in the world. They've been trying to create a utility for it for 10 years.
The first sale was pizza.
For like 10 years now.
10,000 Bitcoin.
So it's a solution in search of a problem, and it still hasn't found a problem to solve.
Well, I don't know if I agree with that. I don't think it's a pyramid scheme. I think those are very, very different, number one. Number two, you're partially right in the sense that we haven't fully identified what problem it solves. But if you think about it as real advocates would say, there's an equal amount of problems with the current currency systems in terms of the manipulation that goes on there, right? What central banks are doing is not exactly natural.
We saw, didn't someone manipulate mid-year the price of Bitcoin?
Yep.
Didn't one player manipulate it? I mean, it's...
Well, yeah, I mean, they don't know if it was one player or multiple players, but there's clear manipulation, which is why, again, I say it's speculative. I don't think you go into it thinking that you're going to become a billionaire or a millionaire as a result of it. You go into it very soberly, understanding that you can lose all of your principal and that this is purely speculative. For me, it's also a way to get educated on it. I didn't put a whole lot of money at risk here that is going to make a difference if it goes to zero. But to me, if you want to learn about it, you've got to own it, because that's the only way you're going to truly educate yourself and pay attention.
Yeah. It's a scam. It doesn't mean everybody in it is a scammer, but it's a scam.
But why? But why do you think it's a scam? I mean, because there are people who are sort of true believers, right? Who say that
Winklevoss twins.
Well, or all the other people who are buying this stuff because they think that it's going to replace fiat and sort of be the new system of global currency at some stage.
So think of all the intellectual power and energy and time that has been put into Bitcoin over the past 10 years, right? And what do we have on the end of it? We've got nothing. So, I guess maybe at some point somebody's going to come up with some, utility or some useful way to utilize it. But so far, despite thousands of people trying and, thousands of people advocating for it and people trying all types of different things, we still have nothing. So that makes me skeptical.
You get the last word. Coming up, the Indian Navy bans smartphones and social media apps like Facebook after busting a ring of spies. Plus, Jordan's Royal Film Commission, they allowed Netflix to film that new series Messiah in Jordan, but now the Film Commission wants it banned in Jordan. President Trump says the protesters who stormed the U.S. Embassy compound in Iraq are backed by Iran. The demonstrators lit fires after breaching the embassy wall, but they left the compound area and joined thousands outside the compound chanting, "Death to America." They were protesting recent U.S. airstrikes on Iranian-backed Hezbollah brigades. Embassy diplomats are hunkered down inside a safe room inside the embassy. The Indian Navy is banning sailors, officers, and other personnel from using smartphones on board warships, at naval bases, and at dockyards. It is also banning the use of social media platforms like Facebook. The Indian Navy ordered those bans after arresting 7 Navy personnel who were allegedly leaking information to Pakistan. The Royal Film Commission in Jordan is asking Netflix to block distribution of the series Messiah within Jordan when it begins streaming tomorrow. Messiah is a drama about a CIA agent trying to determine if a Middle Eastern man is the second coming of Jesus Christ. The Royal Film Commission allowed scenes to be filmed in Jordan, but has since reversed its decision. A police officer in Harrington, Kansas admits he faked the insult he previously claimed had been written on his cup of McDonald's coffee. The officer posted a photo of the insult, which included an expletive and pig scrawled on the cup, but video shot inside the restaurant proves no employees wrote that message. The officer, who served 5 years in the U.S. Army, resigned from the police force. We'll be right back.
Time for Word on the Street, where we check in with our panelists and find out what stories they are watching. Oliver, you going to Red Lobster tomorrow?
I might have to. So Yahoo ran a great story. Tomorrow is actually National Bloody Mary Day. I think it's kind of the marketers won that one. It's National Hangover Day. Happy New Year, everyone. But so Red Lobster is rolling out nationwide a new Bloody Mary with a full lobster claw. And I happen to love lobster as a good New Englander. And so I might have to go check it out. Yes, Julie.
It looks like a meal.
It is.
I mean, you get the biscuit, you get the lobster, you get some shrimp, you
Yeah, I
got
was
everything
saying they
in
have
there.
these in New Orleans, a lot of these like really loaded.
I haven't seen it with lobster
Bloody
claw. I mean, there's barbecue places I've seen with barbecue ribs and sausages and all sorts of stuff, and it is a meal.
So you're planning on being really hungover tomorrow, is what you're saying?
Well, I'm planning on having a Bloody Mary. Whether I'm hungover or not is a whole different story.
So you sound like you might have your own Bloody Mary recipe, or do you?
I do, although it's cheating because I do use a pre-made Bloody Mary mix. And
What
then
do you put in it, though?
I add a lot of horseradish, so I like the spice from the horseradish.
Use the Worcestershire sauce?
Very little of it, yeah. I like lemon and lime and a lot of pepper and horseradish, and then of course a good helping of vodka just to make sure.
Oliver's hosting tomorrow. We're all going over there. Tendai, you're following a report by the Census Bureau that we kind of touched upon earlier.
Yeah, I sound really boring now after the Bloody Marys. But the Census Bureau just released that U.S. population growth this year is the lowest in 100 years. So it's less babies and less immigrants.
And so is there any kind of, I mean, I know the census report looks backwards, not forwards, but the birth rates have been trending. I mean, it's been a longer term trend. Is there any sign that it's going to change?
I don't think so, not on the birth rate. People are having smaller families, people are having children later. So that's trending downwards. Probably the thing that might turn back upwards again would be immigration if there's a change in policies. And this really matters for economic growth because one of the factors in the classical economic growth equation is the labor input, and with less population, you get less labor input and you get less growth.
You were talking about that as well, is that there are going to be fewer young people.
It's called the dependency ratio, which means basically how big of the population is dependent on the working age, which is defined as 18 to 65. And that number has grown to above 50% in the United States, which means more than half the population is being supported by those working, and that's not a sustainable path. You go back 25 years ago, and that number was below 30%. And there's a lot of factors to that, including us all living longer, right? That has an impact.
So instead of watching Yahoo Finance, go make babies right now. Get to work. The country, it's your patriotic duty. Oliver, thank you very much.
Thank you.
Coming up, it's the final trading day of the year. We will dig into some of the biggest trends to look for in 2020. Plus, before we go to break, take a quick look at some of the biggest losers in the Dow today.
here in New York City. We're 2.5 hours into the trading day. Stocks are trading a little bit lower on the last trading day of both the year and the decade, unless you're one of those people who think it actually begins in 2021. Taking a look at the 10-year Treasury yield right now as well, we are seeing it push a little bit higher, just a basis point, 1.91%. Time to sign. President Trump announces plans to sign a phase 1 of the trade deal at the White House in mid-January. Daring escape. Nissan's former top executive Carlos Ghosn flees Japan for Lebanon. More on his flight to freedom ahead. And shifting landscape. Mike Mayo joins us to tell us the major changes he thinks we could see in the banking sector over the next decade. Welcome to On the Move. I'm Julie Hyman.
And I'm Adam Shapiro. We are 12 hours away from midnight here on the East Coast, but we want to wish everybody a happy New Year, at least those people right now in Bangkok, Thailand. Take a look at live pictures as they celebrate the beginning of the next decade and ring in 2020 on the other side of the world.
Nice fireworks. All right, and of course, as we near the end of the decade, 2019 is what we're reflecting on. It was a big year for stocks this decade as well, of course, bringing the longest bull run in history. Scott Gamm back with us from the floor of the New York Stock Exchange to take a look back. Scott?
Well, Julie, it was January of 2010, almost 10 years ago, when the Dow Jones Industrial Average was trading at about 10,500. And fast forward a decade later, and now we are getting close to 29,000. That's about a 175% increase over those 10 years. Of course, 10 years ago, we were still reeling from the 2008-2009 financial crisis. But it's not just stocks that have had an incredible run over the past decade. Take a look at bonds as well. The 10-year Treasury yield, you mentioned it earlier, now at 1.9%. Well, a decade ago in January of 2010, the 10-year yield was at about 3.8%. It's of course bounced around over the past decade because it was just about 13 months ago when we last saw the 10-year yield north of 3%. And then finally, oil prices a decade ago, at least for West Texas Intermediate, that's the U.S. benchmark for crude, was trading just shy of $80 a barrel. 10 years later, oil can't even barely stay above $60 a barrel. It's been having trouble doing that. Of course, the U.S. shale revolution has really taken shape over the past decade as U.S. oil production has increased dramatically, flooding the market with more oil, which has pushed down prices. Julie, Adam.
Scott Gamm, thank you from the floor of the New York Stock Exchange. We want to talk more about the wild decade for the markets, and let's introduce this hour's panel. Yahoo Finance's Rick Newman is joining us. LendingTree Chief Economist Tendai Kapfite is still with us. And Rick, let me start with you. There was a great chart this morning on Yahoo Finance. It was a ton of stuff, which basically the key message was there's always something for markets to worry about. What do you think we worry about going into the new decade?
The end of it all. I mean, that's what it's got to be. That's what we've been worrying about all year. I mean, it's pretty remarkable. You can say we've just been through a decade with no recession and no bear market in stocks. I'm not sure that has even happened in 100 years. We know, we say this all the time. We have guests on all the time who say bull markets and expansions don't die of old age, but they often sort of lead to their own demise because of froth and bubbles forming and stuff like that. So the question is, when will it end and what will cause the end? And I don't know.
What are you most worried about going into 2020 on that front?
I guess maybe not. I'll take it back a little bit over the past decade. I think the saddest thing about this bull run is that stock participation is actually at decade lows. I can't quite remember the stat, but I think people got so spooked in 08, 09, that a lot of people left the stock market, this is retail investors, didn't get back in, and most people have missed this run-up.
58% before the financial collapse, 53% have some kind of tie, whether it's through our 401ks or through direct stock ownership to equity. So given what Tendai has said, there are people who have said that the bull market actually came to an end last year, briefly, and that we're really a year into it.
Right, and that's a technical argument over whether you count the low point during the trading session or at the close, I mean, whatever. So to amplify what Tendai is talking about, I think there are fewer people who actually have the money to participate in the stock market as well. I mean, one thing that for sure has happened during the last 10 years is we've seen worsening income inequality. That's a long-term trend that probably began around 1980 or in the 1980s at some point. But that is going to continue. The Trump tax cuts that went into effect in 2018 probably contributed to that. But we do have a situation where the wealthy are doing fine. They're getting ahead of everybody else, and the middle class, in many cases, just lucky to sort of stay even with inflation. I think that is going to be a driving force behind politics. I think maybe it already was in the 2016 election.
Mm-hmm.
I think we're going to see it big time in 2020, and it's probably going to drive policy at some point in the 2020s.
All right, a prediction from Rick. Let's turn to this. Former Nissan chairman Carlos Ghosn has fled Japan, where he was facing charges of financial wrongdoing. Ghosn confirmed that he traveled to his homeland in Lebanon, and he also put out a statement in which he said, "I will no longer be held hostage by a rigged Japanese justice system where guilt is presumed, discrimination is rampant, and basic human rights are denied." Joining us now is Yahoo Finance's Paras Subramanian. And Paras, for now, what's getting a lot of attention is the sort of method of his escape. Allegedly, he escaped in a box sort of to hold an upright base, and that he sort of snuck out of the country and went to Lebanon, where there are billboards apparently in support of him.
Yeah, I mean, he is kind of a hero in Lebanon, but this is really about the great escape, right? I mean, a Christmas band visited him in Tokyo where he's under house arrest. Supposedly, the Lebanon TV station MTV says it was a paramilitary troops that he hired. They put him in this double bass instrument box, which actually is not that big if you think about it, and got him to Istanbul on the way to Lebanon. And the question is, how did he get out of the country? His lawyers supposedly had all 3 passports. It's a big mystery of how he's there right now.
Well, he forfeits, if I read correctly, almost $14 million that he posted as bail. I think he can probably afford it. But Tendai brought up in the last hour that there was a conspiracy theory that maybe the Japanese government allowed this to happen just to get him out of the country.
Yeah, I'm sticking with my conspiracy theory, which I heard from one of my Japanese friends, that they want to save face. There's a lot of big things coming up next year, the Olympics, et cetera. And then you guys mentioned the merger that's coming up. So let's just get this over and done with. You go on your way.
We should mention this has no basis. It's just something fun to speculate on.
But I mean, Nissan, one way or another, it's a massive embarrassment for the
I can't imagine they'd let that happen.
They're not saving face at all.
So is Nissan. I mean, the Nissan Motor Company has been a big problem. And while all the attention was on Ghosn after he got arrested, look, Nissan, they need these mergers. What's going to happen with Nissan? Because there's been no one else apparently arrested or charged with this alleged crime.
I mean, the Nissan CEO had stepped down because of also a stock bonus plan that kind of was a little awry. But if I remember correctly, Nissan actually was doing well. It was Renault that actually is not doing that well, and they really wanted to really get that tie up together with Nissan. And it was Nissan guys that say, hey, we don't want to be run by a French firm, Lisevich, Carlos Ghosn. So I think it's more of a story.
Stock hasn't done very well, judging from the charts.
And they still have their alliance with Renault, alliance with Mitsubishi. They're still a top 4 automaker. So they're in an okay spot right now. But you're right. I mean, they need to figure out what's the next steps for them because of electrification and AV vehicles, things like that. So.
By the way, I don't know if Carlos Ghosn is right about the discrimination in the rigged system, but there's something really fishy about the whole situation. I mean, the way that Japanese prosecutors did not want Carlos Ghosn to say anything publicly. They actually put him in jail so they wouldn't have a news
And they cut off all communication with his wife as well. His wife has spoken out. Well, now that he's in Lebanon, the thinking is, and I believe he said that he's going to be speaking out more publicly.
Yeah.
In fact, one of his detentions in Japan happened after he announced that he was going to be holding a press conference. So we should be hearing from him.
He said after the holiday he would talk freely with journalists to say his story.
I'm sure there's a line of them standing outside his door.
And let's not forget, by the way, that there are thousands of people in the United States whose employment and their incomes are tied to Nissan, what is New Smyrna, Tennessee, where they produce automobiles, not to mention the dealership chain and the Infiniti, Nissan, all of those brands here.
Yeah, and you have a guy on the run, right? I mean, it's a funny
This makes Elon Musk look boring.
Oh, all right. Banks are headed for a big decade, and Wall Street has no idea what's coming. Wells Fargo senior analyst Mike Mayo says this will be the year banks get married to technology. He joins us now on the telephone. Mike, how's that going to work out? Are they going to do it appropriately, and are they going to do it well, or are they going to fail?
Well, I think this will be the golden age of banks and technology. So, yes, we do see banks finally getting married to technology. I mean, if you look back over the decades, they've dated, they've broken up, they went their own ways with risky behavior, they've reconciled, and now we think they're engaged to have a more permanent relationship. So I could take you back in time, if you like, over the last 4 decades, if that works for you.
If you can do it succinctly, Mike, do it for us.
Well, look, the 1990s, that was about consolidation, but the systems were never really integrated. The 2000s, banks had much more risky behavior that ended with the financial crisis. This decade was about recovery from the financial crisis without much, technology trust, or frenemies between tech and banks. But now tech has more tools than ever before to help banks, and banks are more receptive than ever before. So we see this as a win-win-win decade ahead, a win for the customers who have better service, a win for the regulators and the society because banks are a lot less risky, and a win for the shareholders.
Mike, tell us exactly how this is going to manifest itself when you're talking about this integration with technology and the banks.
Well, I recently went to a technology conference that had 800 attendees and 1 bank analyst. That was me. Mm-hmm. And so I saw firsthand how these technology solutions have already been applied to other industries. So you've seen it in the retail industry, you've seen it in the manufacturing industry, and as I've met with some of these representatives from the companies, they're like, we have the solutions, we've done it before, we're going to apply it to the bank. So artificial intelligence, big data, cloud computing, digital banking, electronic payments, faster processing, and most importantly of all is the governance around the process. So it's always been about the chief technology officer is doing this or that. Well, you now have the chief technology officer in the C-suite for most of the largest banks. And the chief technology officer needs to have more power to enforce the technology solutions that cut across so many different business lines.
Mike, so what is the threat to the banks here from the tech companies? Who's going to own the consumer? Because if you look outside the U.S., in Africa with M-Pesa and with Ant Financial, for example, it turns out a lot of places the tech companies end up owning the consumer relationship. How is that going to play out in the U.S.?
Well, that's a great question. We do think that size makes more of a difference, that Goliath is winning when it comes to banking, and that the largest banks have a stronger relationship and more power relative to the vendors that they use. As you go down in size, I think that the smaller banks will need to acquiesce more of that relationship to the technology players.
So let me ask you this, Mike. As a consumer, I can take a digital picture on my cell phone of the check. I can deposit. I don't have to go to an ATM or a bank. I can use Venmo to send money. When can I just use this whole thing as maybe my debit card? And
his phone is what
my
he's
phone.
talking
Yeah,
about.
I'm sorry. Yeah, I don't know if you can see me. I'm holding up a cell phone right now. When do I get to use this as the debit card? And which of a couple of the banks that are in the lead towards that day?
Well, I'll tell you, I look at what Bank of America has done over the last 5 years. They've doubled the number of mobile banking users, and they recently disclosed new information. For them, and for, I'd say JP Morgan too, are the big fintech players among the banks, the best in class. It's not anymore just about are you using digital banking. Bank of America highlighted 10 different ways to be digitally engaged. And for example, when you talk about taking a picture of your check and using mobile banking, only 1 out of 10 of their consumer banking customers are using that right now at Bank of America. So yes, they're a leader, but there's so far to go from simply using this as a utility to having a deeper, more engaged relationship.
All right, Mike Mayo, Wells Fargo senior analyst. Happy New Year, Mike.
Well, coming up, crude awakening. It's been a big year for oil, but could rising tensions in the Middle East cause investors to hit the brakes in 2020? Plus, let's take a look at some of today's trending tickers on Yahoo Finance.
Welcome back to On the Move. I am Jared Blickery. We got the Dow Jones Industrial Average down about 62 points or 22 basis points. S&P 500 down just a little bit less. The NASDAQ off just 4 basis points, but that would be its third loss in a row. Haven't seen that in a while. Here's the S&P 500 intraday price action. So we started out underwater about 32.13, got into the green, but coming down and testing session lows after the last hour. Also looking at 31.92 as a support level below the current level. Let's take a look at the 10-year T-note. Not doing a lot today. It's up about 2 basis points, but holding above 1.9%. That was a level that's been important over the last few weeks. We're also looking at the VIX, slightly elevated here, and we've been holding out for maybe a spike to 16.5. If that happens and we see it retreat, could be a bottom in equities, so we'll keep that in mind. Also taking a look at the U.S. dollar. That is plunging for the third day in a row. Let's take a look at the 5-day here, because it is down for the 5th day in a row, actually, and off 1.2%. Doesn't seem like a lot in percentage terms, but it is in the currency markets, and this is the lowest level in nearly 6 months right now. Here is the Dow heat map, and we're going to go to a year-to-date performance look, and here we see Apple is up 85%, Microsoft up 54%, and JP Morgan 42%. All three have been hitting record highs recently, and JP Morgan has really come out of the gate in the fourth quarter here. Visa also up 42%. If we sort by performance, Apple's still number one here. If we go to the downside, Walgreens, Pfizer, and 3M, those are the three losers in the Dow. Boeing still the biggest point contributor. That is up 0.7% for the year, just about flat and right around this 320 level. So we don't want that to break down. We're going to be right back in 1 minute.
The stock market went on a tear in 2019 as major indexes hit numerous record highs and large cap stocks reaped the benefits. So if confidence improves and the global economy begins to truly see elements of a reacceleration in 2020, will small caps be the ones to benefit? With us now to discuss this is Chris Retzler, Needham Growth Fund Portfolio Manager. We should point out your small cap fund. I mean, you're beating the S&P 500, NASDAQ, and the Dow this year. Congratulations on that.
Thank you.
When we have a lot of volatility, I thought people went to large cap, and I thought we had a lot of volatility this year. So how did you pull it off?
Well, we stuck to more bottoms-up analysis, fundamental investing, and we had a big position in the semiconductor space. We never believed that we were going to be rolling into a recession, which is where the inverted yield curve, I think, gave a lot of scare to people during the summer months. It was an opportunity that let us deploy capital into those areas. And so semiconductors are really forward-looking for a lot of the economy, and we do think next year we're going to see some reacceleration after some slowdowns. We'd like to see some more of the end markets of industrials and automotives come back because they are big consumers of semis. But the real big theme that we think is going to come on kind of second half is 5G. And you have to break out 5G into the infrastructure build and also the devices. And we think Apple and those devices, the iPhones, are going to be deploying 5G technology next fall. So that's going to kind of come first, and then the infrastructure is going to be over a period of time. So
what should people be watching on the small cap side that could benefit from that trend you're talking about? Are we talking more chip makers, that they'll run more?
So we've seen a lot of design activity. So there's a lot of suppliers into that chain of production, foundry. We also should maybe see some recovery in memory as the devices are going to need more memory. We also have we think that the data center took a pause this year, and so a lot of that inventory has been burned off. We think that's going to come back as well. So when you think about the whole universe of kind of how it works, you need to move it around, you need to process it, you need to store it. So that is not going to, we think that's going to do well next year. And
Are small caps more exposed or less exposed to trade barriers? I mean, we're going to continue to have this trade issue with China going through 2020.
So small caps over the last 15 years, at least in technology, have grown to be more global companies. Even though they're domestically based, their supply end markets or the supply chains that they're working within are globally. So the first part of this year, they did get impacted a bit where there was uncertainty. Huawei, ZTE, those were all things that impacted a lot of small cap technology companies based in California for the most part. That was alleviated somewhat. And now with the China trade agreements that we soon to be in phase 1, and we don't know what phase 2 will be, we're firm believers that IP protection is something we need to stick it out for and fight for. But there is a reprieve here, and we're not getting those negative headlines every day. At least there's some détente, which is giving some recovery in that area.
The other vulnerability, perhaps the small caps end of the market overall, as we discussed earlier, is the Fed. And right now the Fed has been very supportive. You've had a great this year. You guys were smacked a little bit, like the overall market at the end of last year, by what was happening with the Fed. What's going to happen this year, and how is that going to affect the small caps?
So the Fed did a 180 this year. Applaud them for the flexibility that they identified the fact that they maybe went too far, which clearly I think last December proved. But now we're into an election year, and I don't think they want to be too political. So I think they're going to remain accommodative, as they said. They want to see inflation kind of go beyond some of their expectations. So for now until November, I think the Fed's probably in a pause mode, which is supportive. What we watch as small cap investors is the high yield market. High yield market still remains quite healthy. There are some pockets, retail, some energy areas that probably are well known by those investor groups. But overall, there's a reach for yield. And so when that occurs, those yields come down, and then people who are really global investors look to small caps. So again, it's supportive, we think, into next year, and we think there will be some reacceleration of economic growth globally.
Chris, thank you. Chris Retzler is the Needham Growth Fund Portfolio Manager, and we wish you a Happy New Year.
Thank you. You too.
All right, we've been watching oil today, which is slipping a bit. It's ending the strongest calendar year, though, for crude since 2016. With us now to discuss is Scott Bauer, Prosper Trading Academy Senior Strategist. Scott, it's great to see you as we close out the year for oil. It's holding above $61 a barrel, but it's sort of been, I guess, a bumpy ride to get there, right? So as we look ahead to 2020, and for example, we saw some unrest today in Iraq. Is that going to continue to be a theme going forward?
You know, there's a lot of themes, actually, and it's surprising that we haven't seen more of a pop in oil over the last couple days, given what happened over the weekend. And I think that's really because maybe this big rally got a little bit ahead of itself. And, otherwise, in the past, when we've seen an attack like this or some geopolitical unrest, we've seen a rally. So, yes, you're correct. It's up 14% this quarter. It's up 35% on the year, but we're definitely at the upper end of the range. Now, there are a lot of, positive reinforcements to say why oil should or may go higher in 2020. I actually happen to think the opposite of that, and I still think that the oversupply that we have and the shale production here is going to far outweigh the cutbacks that OPEC is continuing through the middle, at least, of 2020.
So are you saying people should avoid buying oil right now? Should they be shorting in some way some of the larger oil companies?
I would absolutely short oil futures here with a very tight stop. But this range that we've traded in basically over the last, let's call it 9 months or 12 months or so, we are at the upper end of that range. And again, the fact that we did not get a pop based on this geopolitical event that happened over the weekend, that is very surprising to me. And again, I think that people are really looking more at the fundamentals, not a hopefully what is a one-off event. Maybe there's going to be more unrest, but this could be just a one-off event here. And I think when you look at inventories, even though last week's numbers had a big drawdown, we had seen big builds leading up to that. I do think that production is still going to far outweigh the global demand we're going to see in the next 6 to 9 months.
So, Scott, given that you said you would short oil, but, with a stop, what do you think then is the new range that you would be watching for oil prices?
Yeah, I mean, I think we could see a retreat back to the $56, $57 a barrel level over the next couple weeks, if not over the next month, given, just supply constraints and given what we've seen, barring any other sort of geopolitical unrest. The other wild card here, quite frankly, is what's happening with U.S. and China. If we don't get a setback, if the Phase 1 deal does get signed, as President Trump said on the 15th, and things progress here, okay, but if we start to see some unrest, some uncertainty there, all bets are off. But I really think that oil is overbought here. I would like to see, or I think we're going to see 56, 57, and that range, like we just talked about, probably still hold of about 54 to 62.
All right. In the meantime, we got 2 more weeks till the ink is dry on that Phase 1 trade agreement. So
exactly.
Some time for things maybe to move. We'll see. Scott Bauer, Prosper Trading Academy Senior Strategist. Good to see you, Scott. Happy New Year.
You as well.
Coming up, bipartisan campaign, Democratic presidential candidate Joe Biden says he may reach across the aisle for his VP pick should he become his party's nominee. Plus, take a look at some of today's winners on Wall Street. We're streaming toward the end of the decade here, almost 12:30 in New York City, 3 hours into the trading day. Stocks are still trading down a little bit on this last trading day of both the year and the decade. Gold, on the other hand, we've been keeping an eye on gold, which is trading higher, $1,525 an ounce. Taxes take their toll from New York to Chicago. Big bills are driving people out of major cities. Beyond the pay debate, we will talk to one company that wants to help solve another major issue for women's soccer, concussions. And from pressure cooking to streaming TV, we've got a look at some of the top products that defined the decade. Welcome to On the Move. I'm Adam Shapiro.
And I'm Julie Hyman. Thanks for sticking with us. Well, 2019 was a banner year for U.S. soccer, from the women's national team winning the World Cup to the steady rise in youth soccer, now only lagging baseball and basketball in participation. But behind those glowing numbers lies an alarming statistic of traumatic brain injury, which is on the rise in the sport, especially for women. With us now to discuss is Claudio Storelli. He is CEO of Storelli Sports. It's a company that produces soccer gear focused on reducing injury. Claudio, thank you for being here.
Thank you for having me.
So we've got a couple of your products here on the, I'm surprised by how light it is actually as I pick it up. Headband. So it's not a full helmet like you would see obviously in football. It's a headband. How does it work, and how did you develop the technology?
Sure. So the basic idea is to absorb the impact primarily from head-to-head collisions and head-to-ball collisions in the most lightweight possible, but also most effective way. So what we did was we entered an exclusive partnership with the same manufacturer that makes military helmets for the U.S. Army and the Special Forces, so the same teams that go on some of the scariest missions. And we took the inner lining from the helmets, which is very resistant to impact, but also works really well both in very high temperatures and both very cold temperatures, and then created a sleek headband that protects the areas that are most exposed to risk, while also not making you look too dorky.
Not making you look, actually,
so the kids will want to wear them.
But here's a question for you about this. If you're going to head a ball, do you get the same kind of reaction you would from the bare forehead? Because I'm feeling this right here. It's pretty hard. Yep. It's hard on the inner side. And then also, how does this protect the child or the adult from the concussion? Because this is still pretty hard on the inside.
Yeah, so this is the back.
Yeah.
And this will be the front. So the front will look like a headband. The back is shaped this way and is actually extra thick both on the back and on the sides, because those are the areas that are more susceptible to hits. Yeah. And the front is designed so that you can head the ball without affecting the performance. And it's been used in the World Cup, English Premier League, it's in Italian Serie A, Major League Soccer. So this is currently being worn by tens of thousands of youth players. And anytime a top player in the EPL gets hurt, we get a call and we usually send one of these.
So you mentioned head-to-head collisions, but you also mentioned just like heading the ball, which I didn't realize there was that much risk from just you heading the ball. Does that have to do with the velocity of the ball when you head it, or like how does that play out and how risky is that? Or like what's the frequency of injuries from head-to-head collisions versus just heading the ball?
So head-to-head collision is something that we know much more because concussions are a one-time big hit that causes immediate damage to brain cells. So it's much easier, even though it's still don't know a lot about concussions, but it's much easier to know that you got hurt. So there's a lot of data about that. And there we know that women have concussion rates that rival American football, and they're 2 to 3 times higher than males. When it comes though to heading the ball, this is the new wave of, I guess, bad news, I think, that is coming through new studies. One recently came out of Scotland showing that professional soccer players are statistically a 5 times higher risk of brain degenerative diseases than the average person, which means that if you play soccer competitively and presumably you head the ball, you are a 5 times higher risk of Alzheimer, ALS, and some pretty nasty stuff.
So how have you done research then on those professional soccer players when they're wearing this and then when they're not wearing this, and how much does it actually reduce the risk of concussion?
So on the concussion front, so head-to-head collisions, the best source is the Virginia Tech Helmet Lab, which is the same lab that rates football helmets, hockey helmets, and does 5-star ratings. This product is the top ASTM approved rating on product on the market, 5 stars, and they estimate it reduces concussions by 84%.
Can we go back to a statistic you mentioned about women, though, suffering a greater incidence of concussion than men? Do we know why?
The science is not quite sure yet. I was recently at a conference here in New York at NYU discussing it. Some think it may be due to neck strength, but the reality is that there's a lot of research ongoing. They don't really know exactly why, but we know that they are at much higher risk.
And you guys deal with other products for other types of injuries?
Absolutely. We do head to toe. Head injuries are particularly important considering that the future leaders of America and the world, most of them play soccer. We probably should take care of their brains.
And a lot of these female athletes have said, including Abby Wambach, she's going to donate her brain to science, although obviously, hopefully we have a long time to wait before that happens to do that research. Are you also seeing any kind of movement league-wide, whether you're talking about a youth league or a professional league, to make these mandatory and part of the uniform.
Yes, it's coming grassroots up, meaning we're seeing initiative taken by parents, coaches, and then generally league management to require it. At the moment, the U.S. Soccer Federation, and probably rightly so, is waiting to collect more data. I also believe that more research needs to be done about this, but there's now several data points out there that are showing some substantial benefits, starting with the Virginia Tech study I just mentioned, but a more recent one showed that this product specifically statistically reduced concussions by 60% in girls' high school soccer, and it was the only product that achieved a statistically significant result. So again, more research needs to be done, but you start putting the data points, you start seeing a trend. I personally believe that thanks to the efforts of my company and the industry overall, coupled with the right training and rule changes, within 5 years we're gonna abate.
Were you a soccer player? Did you hit a lot?
I actually was a goalkeeper, so I didn't.
Okay.
Claudio, thank you for being here. Claudio Storelli, CEO of Storelli Sports.
Thank you very much.
Appreciate it.
All right, from headbutts to butt heads, we're heading to Washington, D.C. President Donald Trump, not the President, Congress, signed a bill that increases fines on criminal robocall violations. Yahoo Finance's Jess Smith joins us now from D.C. And save me, I think I'm in trouble.
I don't know, as long as you're not talking about me here. But this bill did have a lot of bipartisan support in Congress, and it is now law. President Trump signed this bill yesterday, and it aims to crack down on those annoying robocalls that are not only annoying, they could be costly. Some estimates say that consumers have lost billions of dollars because of this call, or because of these calls. Now, the law would do a few things. First, it would require that companies, telephone companies, try and correctly identify calls that are coming in. It would also encourage them to block robocalls, and when they do block robocalls, they would not charge consumers for that. It also gives the government new powers to find robocallers and punish them. The White House press secretary said in a statement that this will give consumers greater protections. She went on to say American families deserve control over their communications, and this legislation will update our laws and regulations to stiffen penalties, increase transparency, and enhance government collaboration to stop unwanted solicitation. Now, while some supporters acknowledge this won't stop all of the robocalls, it will go a long way in at least cutting them down. So this is something that maybe you'll see a difference in when you start getting all of those calls that match closely to your area code, but are not anyone but a scammer.
All right, thank you very much, Jess. Appreciate it. Coming up, taxing situation. Bigger bills causing people in many major cities, including New York and Chicago, to pack their bags. Plus, take a look at shares of Netflix. It is the best performing stock of the decade. got some trending tickers for you from YahooFinance.com, and a lot of these are ones that have been on the list regularly this year. Some of them are those that are switching their performance that they've seen this year. In other words, we've got a lot of pot stocks on the list, folks, and that's as we see them rebounding today to end the year after what's been a pretty dismal performance for many of them. Canopy Growth is one of them. The shares are up about 11% today, 10.5% call it. They're down 23% this year. Aurora Cannabis, those shares down 57% this year. Today they're popping by 11%. Kronos Group, another of them, down 27% year to date, up 15% to date. You get the idea. We're seeing people buy these pot stocks on the last day of the year. One of the other things that I'm watching, besides all these many pot stocks that are on the list today, a company called Sina Corporation, which is a Chinese internet company. These shares are also down this year, 26%, but they are up today after the company authorized a $500 million stock buyback. So the shares up by 7% on that news. If you're following today's trending tickers or the ones you've been watching this year, make sure you're watching the ticker. It's right here at 2 p.m. on Yahoo Finance.
People are fleeing New York. In the past decade, nearly 1.4 million New Yorkers left the Empire State for another state in the United States. Can you say Florida? But they're not alone. Illinois, California, Pennsylvania, New Jersey, and Michigan also lost part of their population to another state. We're going to turn to the panel on this one. Is it jobs? Is it the price of a home? Is it the taxes? We'll start with our politician or our political reporter because the southern states are going to pick up in the next census and a greater, footprint in Congress.
I think it's everything you just mentioned. And by the way, weather. I mean, if you live in the north, you could live in the south, pay taxes, and not have to deal with winter. Why not? Part of the issue. I mean, there's some corporations here too. So I know in Connecticut, Connecticut lost big when General Electric left for Boston. Now, given how bad GE has turned out, maybe that has not turned out to be. But that's a lot of high-paying jobs that go as well. I think the northern states are totally going to have to reckon with this. I don't think they've even started to do it because they sort of, I mean, I live in New York. I think you guys all live in New York. I mean, taxes are high here and welfare spending is high. And you can't just lower taxation to keep up with lower tax states because then you've got deficits you can't deal. You've also got to get rid of the benefits, and that's a long-term adjustment you have to make. I think the northern states are just going to have to deal with it because you can't just hemorrhage, high-paying taxpayers forever.
Yeah, I agree absolutely. Another big thing, though, is just the general aging of the population. Yes. So that's why a lot of these people are going to Florida. It's people who are retiring. They're kind of done with their working life, and they're moving for the weather as well. And what used to be the counterweight for that was immigration. So in New York, you'd get a lot of immigrants coming in, which would kind of make up for the people moving out. But immigration has been cut in half into the United States over the past 3 years, so you don't get that counterbalance.
If the northeastern states and Michigan and the Midwestern states could get their tax act together, though, the other issue play that could bring people back, resources. We have water. We're going to have a more temperate climate, whether you like climate change or not. The South, I mean, you go to Florida, traffic, it's hot a lot. There are rising sea levels. They now sell property in South Florida based on how high is it above Ocean level.
Well, I mean, a dynamic local and regional economy is a big deal, and we're lucky that we have that in New York, because that will keep people coming to the New York City area for a long time. I guess you could say the same thing about Chicago. But when you get outside those big cities, I mean, you know, you get into these just kind of dying towns where you
Well, and
really
that's
just
where
get
a lot of the
in trap.
migration is coming from,
yeah,
too.
it's
as you
upstate
pointed
New York and those areas.
Yeah, I mean, you know, when you've got a declining industrial base or the manufacturers are leaving, that's a hard problem, and I don't have a good answer. There's no simple answer for that. I mean, takes a lot of good government policy, probably lower taxation incentives to get people back there or to stay there, and it's not hard to tell people where to go.
All right.
Or where to stay.
Let's get to the buzzer beater now. It's time for our buzzer beater round. 3 stories, 1 minute each. Let's get started with this. Adam Sandler's new movie, Uncut Gems, pulled in $18 million since opening in theaters last week. And it isn't his only film that's making headlines. His Netflix film Murder Mystery tops the streaming service's list of most popular releases in 2019. There is a caveat. They're measuring movies in their first 29 days, I think they come out, people who watched at least 2 minutes. So we don't know if people watched the whole movie or not. Anybody watch it here?
Well, I normally run the other way from Adam Sandler movies, but I mean, one of the mind-spinning developments of 2019 is Adam Sandler is now getting great reviews for real acting.
Yeah.
So I'm not sure about the Netflix show. I definitely want to see Uncut Gems. So if Adam Sandler can, you know, become a serious actor, anybody can turn their actor.
He's done some serious things
I
before.
know.
I think
Happy
he's good
Gilmore
at it.
was.
Comedy, they say.
Happy
I know,
Gilmore was a classic.
Yeah, it's amazing to me. He's getting Oscar buzz.
Right.
So I'm like, surely they're pranking us. There's a joke. There's a joke in here somewhere.
No, but the flip side of a lot of these comedians, and Adam Sandler included, is this kind of pathos, right? Which, if you've watched his movies, some of those he plays that very well, I think.
Okay.
Personally.
And this one gives new meaning to bipartisanship in D.C. At a campaign event in New Hampshire, former Vice President Joe Biden disclosed to voters that he would consider choosing a Republican vice president to serve as his running mate in the 2020 election. Now, this may seem preposterous to some people, but there are, you know, it's New York, I get it, it's the croissant crowd, who talk about the need for a unity ticket.
Oh, I think it's a great move by Biden. Now, he didn't announce this unprovoked. Somebody asked him if he would consider a Republican
And he was
president.
like, sure.
And he said, sure, why not? Except I can't really think of any right now. I think that is that's on brand. That's
Ron Huntsman.
Sure.
Former
Well,
ambassador.
that's on brand for Biden, because he's the one saying, I can actually get along with some of the Republicans, which is his way of saying I can get things done if I'm president. We're not just going to have endless headbutting between the two parties and nothing ever happens. I think there's zero chance he would have a Republican on the ticket. If he becomes president, he could appoint a couple of Republican cabinet members, though.
Yeah, I love the Democrats, but they never learn, right? So Obama did this. He had a bunch of Republicans in his cabinet.
Well,
and
not a bunch, he had 2.
Yeah, but it got him nothing in the midterms.
Yeah.
Or
in Congress.
All right, we got Buzz. Consumer Reports is out with the list of the top products and services that defined the decade. Apple AirPods, the Instant Pot, Tesla's Model S all made the list. Tendai, do you have a top pick of product of the decade?
Yeah, I went with those mattresses in a box that they deliver to your house. A couple of reasons. You probably spend a lot of time sleeping. That's like a good amount of hours. And I got one. I happened to get one for free, which was great because I guess they were still trying them out.
Oh, wow.
And how is it?
You like
It's
it?
great. I still have it.
Is it firm?
Yeah, it works perfect.
How about you?
So I like the Cadillac Super Cruise self-driving feature. Pras Subramanian and I did a video review of this. This is similar to the Tesla, what they call autopilot, but it's better because it has better safety built in. Now, we do not have fully self-driving cars yet, and it's going to be a while before they do. But the next level that we're seeing now is it can steer for you on the highway and speed up and slow down. So at least you can relax a little bit on the highway. Tesla goes too far. Their system is too permissive. Cadillac actually has a camera on the steering column that watches your head, and if it notices that you're drifting off or sleeping, you get a buzz and you need to wake up or it's going to pull off the road and stop.
Just a loud voice that yells, "Wake up!"
So unfortunately, we got Buzz before we could reveal our
AirPods.
top products.
AirPods, love
I
them.
think the smartphone, even though it was not invented this decade, it has dominated this decade.
I would have said Uber, which was March of 2009. So I guess it just missed the cut.
But it still really came of age this decade, so we'll allow it.
All right, Tendai and Rick are sticking around because we're going to celebrate with some bubbly. We'll tell you how to find the best champagne to help you ring in the new year. And Freddie Mercury pronounced it incorrectly. We're going to tell you how to pronounce Moet. So let's take a look at the top trending stories on Yahoo Finance right now. President Trump says he will sign the Phase 1 trade deal on January 15th in Washington, D.C. In a tweet, he said high-level representatives will join him and he will travel to Beijing, China at a later date to start working on Phase 2. Who do you think is the most admired man in the United States? Turns out President Donald Trump and former President Barack Obama are tied. That's according to a Gallup poll. Now, while this is President Trump's first year in the #1 spot, it's Obama's 12th year at #1. And stop the brakes. Ford says reservations are full for its new electric Mustang. The Mach-E Ford unveiled the vehicle back in November with a $45,000 price tag and began taking $500 refundable reservations. That price point is similar to Tesla's Model Y, which ranges from $47,000 to $60,000. We'll be right back.
It's New Year's Eve, in case you didn't notice. 1.5 million people are going to gather in Times Square tonight to ring in the new year. Another way, of course, people are celebrating, as they tend to do, is with champagne. Over 360 million glasses of sparkling wine are going to be drunk over the course of New Year's Eve. Here with more on that is Angela Sauvé. She is She's brand education manager for Moet Hennessy. That was our first point of education, is that it is indeed Moet and not Moet, despite being French.
Yes.
Maybe because of the umlaut? Is that what's the...
Yes, you're absolutely right. So Moet, you pronounce the T because the 2 dots over the E signify that you pronounce the T. It's Moet. So no way will you say Moet.
Okay, so we're going to ring in the new year and lots of celebrations with champagne. But I was reading that the French aren't drinking as much champagne. Are we drinking more? What's going on?
Americans love champagne, and champagne is loved globally. And at Moet Hennessy, we're lucky enough to have some of the most iconic champagnes in the world. I mean, Moet, for example, we were just speaking about it, it is the global icon of celebration. So what better way to toast to a new decade than with a glass of real champagne from Champagne, France?
And of course, you say real champagne because of the designation, only
Here's
champagne.
Your glass, Julie.
Oh.
I know you've been waiting for it. Can we have more?
Excuse me.
Yes.
Is there another glass in here? I'll just do out the bottle.
You know what? I have something
Adam,
better.
you're going to have to drink out of the bottle like you usually do.
A mini Moet. And this is perfect. You know why? Because these are only $12. And they come with their own flute on top, so you don't even need a glass.
So I can drink out of the flute.
Exactly.
These
Who's
are
making the toast?
That little thing?
Arriba, abajo, dentro.
Dow 40,000.
Dow 40,000.
Dow 40,000.
Oh, is that the thing?
By the way, so when we talk about champagne, you were telling us the difference between the Moet and the Veuve Clicquot.
Yes, so champagne, much like fragrance or food, has different styles. So, cheers.
So it is its own flute.
It is its own
Well,
flute.
what's interesting here too is that we're seeing these are not champagne flutes.
Oh, absolutely. Yeah. So what you're enjoying your champagne out of is how we recommend to enjoy champagne. All of these are aged for years. Moet is aged for 2 years. And in order to really experience the champagne, we recommend white wine glasses.
Huh.
You can absolutely use a flute if you have flutes and you love it, but for the best experience, a white wine glass.
I usually fill up my Yeti cooler thingy, you know, my Yeti travel mug.
With the champagne. I'm curious. I think of Veuve and Moet as premium brands, right? In terms of the price point, et cetera, and the reputation. What are you seeing in terms of who is buying the champagne at this point? How are you trying to reach younger generations, especially because it is perhaps a pricier product?
Again, the great thing with our champagnes, they're popular with all age groups. Anyone over 21 most likely will love our champagnes. We have a champagne for any taste preference, any profile, any age, any moment of celebration, whether you like a rich style like Veuve Clicquot, and it's pronounced Veuve. Veuve rhymes with love. And, or if you want a fresher style such as Moet, we have a champagne for everyone.
Do people only drink champagne at celebrations, or is this the kind of, because everyone has white wine or everyone has red wine? Why not just have champagne when we want to have champagne?
You should. Absolutely. And the interesting thing about champagne, it is very popular for New Year's Eve, but it's very popular for any moment, whether it's a Tuesday and you're enjoying French fries or pizza or fried
It's Tuesday.
chicken.
Break out the Moet.
It's Tuesday. Or it's a wedding or a graduation. It's the perfect moment to celebrate with a toast of bubbly.
Adam, I'll try to teach you how to be a little more fabulous in your life. But in the meanwhile, do you guys frown on champagne cocktails, mixing cranberry juice or raspberry or something?
Not at all.
We
We would never frown on how you want to enjoy your champagne. You enjoy it. There are some amazing champagne cocktails out there. For me personally, I love just a simple glass of bubbly, white wine glass. If it's Tuesday and I'm eating pizza.
Have you guys relied on sort of the influencer strategy at all when it comes to social media? What kind of, I mean, because obviously this is a storied brand. You guys have been around for a long time. What are some of the new initiatives that you have?
You're right. We've been around for well over 200 years. In fact, Veuve Clicquot is 1773. But we do use social media. Social media is a great medium to showcase celebratory moments. People want to show these memorable moments with their bubbly, and it's a great moment to just share with the world one of the most famous wines.
And I can attest as a lightweight on set that there's a little bit of a buzz that comes with just a few sips there. Angela Sauvé, Happy New Year.
Happy New Year.
Thank you for bringing the Moet Hennessy. And
Moet.
Moet. I got Freddie Mercury in my mind, but Happy New Year. It tastes really
Happy
good.
New Year.
Thank you.
Happy New Year.
All right, let's take one last look at the markets as we leave you on the last day of the year and the decade here. We've been seeing a little bit of a pullback, but now the NASDAQ has turned a little bit higher. Still, all three major averages continue near record levels. Rick, thank you for being here.
I'm ready for a refill.
Yeah, I bet you are.
We want to wish everybody a Happy New Year as we head to 2020. You can take a look at the headshot they created for us. Wi-Fi PM is going to take you through the next hour of trading.
It is 1 p.m. in New York City, and the major indices are pacing to end their final day of trading in 2019 in the red, but investors aren't complaining. On tap for today, President Trump revealing the signing date for the Phase 1 trade deal with China, why he says he'll be heading to Beijing right after that. Plus, a look back at the best and worst performers in 2019 and what that could mean for stock picking in 2020 and what strategists are picking for the decade to follow. And crunch time for the Democratic candidates on the fundraising trail with the Q4 filing deadline hitting when the ball drops in Times Square. We'll break down who's rallying and who's falling behind. All that and more in our last show of the decade. This is Wi-Fi PM. Afternoon, everybody, and happy new year almost, depending on where you're watching us from. I'm Zach Guzman, and joining me on Wi-Fi PM today is Yahoo Finance's Julia LaRoche, along with Clearnomics founder and CEO James Liu, back with us in studio. Is it too early to say Happy New Year? It might be. Okay, well then Happy New Year, guys. The Dow, as you can see there, is in the red right now, although the NASDAQ is getting close. There it is, in the green right now. The S&P in the red. We'll see where things go throughout our hour and where we end 2019. But first, President Trump confirming the timeline on a U.S.-China trade deal agreement, tweeting today saying, "I will be signing our very large and comprehensive Phase 1 trade deal with China on January 15th. The ceremony will take place at the White House. High-level representatives of China will be present. At a later date, I will be going to Beijing, where talks will begin on Phase 2. So guys, there you go, January 15th, the date set in stone here, looking more and more likely that this Phase 1 trade deal is actually going to get signed.
Yeah, I mean, it's very positive for the markets, although, again, this is a story that's going to continue for quite a long time. This is just a Phase 1 deal. It's quite positive. You get the tariffs that weren't put into place. You get some tariffs rolled back. There's a framework for potential agreements down the road. But, this is a cloud that's going to hang over markets for quite some time.
Yeah, I think you nailed it there, because if you looked at that Bank of America, the most recent fund manager survey, what continues to remain top of mind, and it's trade, it's tariffs. And so until we get to January 15th and that thing is signed, and then you have the other phases to come, there's still a lot of uncertainty around it. So this is the first positive step.
Yeah, and when you think about, too, like the dynamics that really led the market this year, it was all trade. You can make the argument, too, that it was Fed as well, because we got a lot of rate cuts that when we were entering 2019, a lot of people weren't expecting. It's tough to say really which one out of those two, if you could pick one, which one you think led the market the most.
Yeah, I think it's interesting. I mean, if you basically were asleep all year, woke up today and saw this performance, you would look back and say, well, it's the Fed. The Fed goosed the market. It goosed all asset classes. Mm-hmm. But in between all those ups and downs, I mean, that was clearly trade headlines. You had these pullbacks. We were talking about potential tariffs way back early at the beginning of the year in March. Yep. There were deadlines that came in and passed. And so over time, it was probably the Fed that pushed markets up, which again, going into next year is going to be a problem because that can't really push markets up too much further.
Yeah, because monetary policy also operates with a lag, so we'll probably see the final effects of that. And then, I mean, you could have, like Jeffrey Gundlach of Double Line Capital put it to us earlier this month, you could have thrown a dart and pretty much everything was up. Even like investment grade put up equity-like returns. So it's kind of hard to not make money this year.
It's emblematic, too, of the way that the whole decade went, and we're going to be digging into that later on in the show when we look at how 2019 was kind of really a microcosm of the decade. You could throw a dart and hit anything, and it would have been up when you're thinking about it, although there might be some things that weren't up, and some of those picks look even worse now. But when we're looking ahead, though, to 2020, and then also beyond it, and you ask people what might be the stocks, the assets to invest in moving forward, it's interesting because Disney, Alphabet, and cryptocurrency are popular picks, at least when it comes to a dozen strategists surveyed by Reuters planning ahead for 2030. And the Street pointed to Alphabet's progress in healthcare and AI as becoming a major revenue source for the Google parent company. Obviously, they've been focused in those areas for quite some time. But with those picks, would you agree with them?
So I wouldn't be able to claim to be able to look out 10 years. You look at the things that worked over the last 10 years, and a lot of those things were even on people's radars 10 years ago. And so I think what those picks are getting at is just the underlying themes that people are really excited about right now. Now, some of them I think are overhyped. So this term AI has kind of become this cliche. But of course, there are certain parts of AI, certain parts of crypto and the blockchain that probably will be real. But it's very likely that the companies that actually come out of that and actually make a material difference in people's lives, and therefore they'll be willing to spend money on the services, may not even have been invented yet.
Yeah, I mean, there are businesses and opportunities and future companies that we haven't even begun to wrap our minds around because we just don't know what the implications of the technology could be.
The other thing, too, though, when we talk about technology is it's kind of become an all-encompassing term, right? When we talk about Peloton, one of the IPOs this year, that was pitching itself as a technology company. Because, I mean, understandably, when you look at kind of the way that these tech companies are valued, they tend to be richer valuations. So I would want to present myself as a tech company as well. Although the haters of Peloton would note that it's really just a workout company. It's really just a bike company. So, I mean, we do see a lot more companies, potentially those going public, do try and tap the tech niche.
Yeah, and I think it works both ways. I mean, you think about an Amazon. It's not in the technology sector of the S&P, it's in the consumer discretionary sector.
Yep.
And so you think about the legacy of the dot-com boom in the late 90s, it wasn't to pick one or two winners and then to look later on and say, hey, these guys won. It was the dissemination of all this technology throughout the entire industry.
And it really makes sense, too, when you look at how the sectors performed in 2019, why a lot of companies would want to be considered a tech company. And as we look back, obviously, in 2019, it's the last trading day of the year, we have to do this. We got to reflect with the energy sector lagging and technology actually the big winner. And Jared Blickery joins us from the Wi-Fi Interactive board with more on breaking down the year's biggest winners and losers. And Jared, tech, I mean, the standout.
Look at that, XLK, that is the S&P 500 tech ETF from SPDR, up 47%. And then communication services, which is closely related, that's about 42%, Alphabet and also Facebook. To the downside, we have energy and healthcare. But what's interesting is financials, they're also outperforming this year. They're up about 29%. And what happened in the last quarter is really telling because healthcare made a comeback. We can see tech is still number one in the fourth quarter, but healthcare very close behind at 12.5%, financials coming up almost 10%, and then again communication services. And then within the last month, energy, which had been the worst of the year, is one of the better ones. And we can see it's up 1.6% over the last month. Not a stellar performance, but still for a sector that's really underperformed over the last few years, it might have a shot because crude oil is trading higher recently.
That's also, I mean, when we talk about this, people take kind of flip sides of the coins. They might say, you know, the weaker year that you've had maybe this year that could pose good things looking ahead till next year. It doesn't necessarily always work out that way, though, when you break it down. So maybe looking forward, would you expect the trends of energy being a laggard to continue in 2020 and technology to continue being a winner?
I believe in sticking with something until it works. On average, years where we tend to have the market up substantially over 20% tends to carry over into the following year. Doesn't have to happen, but that's what the average is. Now, the one thing that tech has going against it is it's not responding well to higher interest rates, and that's on the long end. So as the 10-year T-note yield rises, tech is just not doing as well, but still a big year for tech. And here, let's look at a year to date. This is a NASDAQ heat map, and we can see the big stocks over here by market cap. Apple up 85%, Microsoft 55%, even Facebook, that's also up 55%, almost reclaiming its all-time high. Only Amazon has been the laggard here, but if we look at a chart of it, and we can look at a one-year chart as well, we can see it's kind of broken to the upside. Kind of hard to tell here because it's a longer-term chart, but we do have some outperformance as of recently, and if it's breaking to the upside and it's bringing consumer discretionary with it, watch out because there are a lot of stocks outperforming here.
And there's a lot of names to pick in technology as well that have been outperforming the overall market. But Jared Blickery, thank you so much for breaking all that down. I mean, guys, just hearing all of that makes it very obvious. I mean, not just in 2019, you think about the decade as a whole, or even just the last 5 years, technology up 115% in that span. Energy, the only sector that's still in the red from 5 years back. So, I mean, that trend, even when we looked at what we just talked about a little bit ago, Alphabet and some of these other tech names seem to be strategist favorites moving forward.
Yeah, I mean, I think when you look at these sectors, they all are tied to slightly different stories. So energy, obviously, you know, very much tied to oil as a commodity, natural gas.
Yep.
And obviously, that's kind of been this roller coaster ride over the last 5 years. But you look at something like technology, and it's not as tied to the economic cycle as something like, you know, maybe consumer discretionary or even consumer staples.
Yep.
Technology, there's a secular long-term trend that's happening, and so regardless of what the cycle is doing, those innovations are happening in that space, which is probably one of the key reasons why it's up as much as it is this year.
But every time that we talk about technology, though, there is that fear. People tend to go back to the dot-com boom and think about what happened there with technology and some of these stocks, but it doesn't seem to be kind of that bubbly, for lack of a better term. That's not necessarily the hype that we're getting from strategists and people on the street.
No, and I mean, when you're talking about like Alphabet, for example, or Microsoft, these have just become such established names. But when you bring up .com, at least for me, something that you're bringing up, for me personally, that I'm thinking of is just some of the IPO debacles that we saw earlier this year. And when I had a conversation with one of the top venture capitalists, because of the stumbles, especially the stumble you saw with WeWork, for example, he was making a case that, look, this could be a really healthy thing for the IPO market going forward because, yeah, there'll be a lot more scrutiny. What is your profitability? I mean, what is this whole adjusted EBITDA and this goofball language in your S1? So maybe they'll be going forward in 2020. We're not going to see as many of these.
Yeah.
Kind of silly attempted IPOs.
Yeah, or mistakes, or hopefully, too, people understanding as well that as these companies wait a little bit longer to actually go public, that some of these companies aren't growing the same way. We even saw that from Uber, even in the first year out as a public company, the way that they slowed down in terms of their growth. A lot of times, you're just investing in companies that are established players at that point, no longer kind of the earlier days of some of the big wins that you could get, especially in tech. And at least that's what we've seen from Uber and Lyft as well. We'll see what happens next year. We're only a day away, only hours away, really, here in New York City. But coming up, the deadline for Q4 fundraising closing in on Democratic presidential candidates. And we're breaking down who's catching a rally and who's starting to fade when Wi-Fi PM returns. Welcome back. Entrepreneur Andrew Yang is gaining traction in the 2020 race. Yang's campaign told Yahoo Finance the presidential hopeful is poised to pull in over $12.5 million in donations in the fourth quarter. That would be a 25% at least increase from his prior quarter fundraising total of $10 million. And Yahoo Finance's Rick Newman joins us now to discuss his emergence here as a real player. Rick, I mean, when we're talking about Andrew Yang, the manager of his campaign also said he surpassed 1 million donations.
He's doing surprisingly well. I mean, we can't deny that. Nobody knew who he was before this campaign. He calls himself an entrepreneur, but he ran a company nobody ever heard of. And he has just caught on. I mean, he's got a sort of small but passionate following. Or that's at least what I used to think until I heard the 1 million number. I mean, 1 million donors is not really that small. I mean, that's not 1 million fans. That's 1 million people who are willing to give you money. So what that does is it keeps him on the debate stage and it keeps him in the hunt.
And it also, I mean, 25% when we talk about other candidates up there, that's a serious jump over Q3. Not all candidates saw an increase in fundraising, though.
Right, and we don't have the final numbers yet. These will be reported to the Federal Election Commission at the end of the year officially, and then it'll be a couple minutes. But they'll tell you little tidbits, and they'll try to spin it in their direction. So I've got my dolls here. So Bernie Sanders has been he's just been remarkably steady. So Bernie Sanders gets tons of small dollar donations, and he's holding steady. And I don't know what the numbers are going to be. He's probably going to be above 20 million for the quarter, and that's good. And so I think a bigger part of the story is Elizabeth Warren, who has fallen off. I mean, she's fallen off in the polls, and she has fallen off in fundraising, apparently. And she actually just issued this kind of emergency email alert, like, we're behind schedule.
Yeah.
Now that's a part of a ploy to, to get money, but I think it might also turn out to be true. So she's kind of fading. And then the bigger question is really Joe Biden. So he's actually lagged in fundraising, given that he's the front runner. He's just not generating the excitement and enthusiasm of some of the other candidates. But my guess is that because Joe Biden has really remained, he has stayed there. He has not flamed out the way some people worried that he would. And I think his fundraising will probably pick up in 2020 as it seems more likely he could actually win.
Yeah, well, and we've highlighted on the show, he continues to spend more cash than he's bringing in when you look at the most recent
That's
quarter.
right. So he's banking on pulling it in and, staying at the head of the race.
Yeah, and it might help. I mean, now that Kamala Harris is out of the race as well, there are more donors feasibly to tap.
I just want to talk about donations. I mean, obviously, we don't contribute because we are in the media, but I mean, who are these individuals? How are they being reached? Why are the individuals so important? Because you often hear in the news, at least, okay, so-and-so had a dinner in a wine cave and billionaires donated, those sorts of things. Why is it that the individual small contributions are so important?
Because that's how the actual campaigns get funded. So we have talked, this other big thing that's been in the news since 2010, the big Supreme Court decision, is super PACs. That's a totally different thing that we're not talking about right now. This is what keeps these small donations are what keep these campaigns going. You can't campaign without money. You needed to buy ads, you needed to pay staff, you needed to do research.
But are they calling you or they emailing? How do they?
Yeah, it's all the above.
It's
word of mouth. So, and by the way, just so everybody knows this, we talk about this whole thing with the Buttigieg wine cave got blown out of proportion because the most anybody can give as an individual donor to a campaign is $2,800.
Yeah.
So even if you're a millionaire at the wine cave, you can't give $500,000. You can only give $2,800. And you could maybe get your family members to give $2,800. When we talk about super PACs, we're talking, the biggest donors give $500,000, $1 million. That's a different part of the system here. So this is not really the big money part that we're talking about.
Yeah, you go to a wine cave dinner, you could be donating, not through the campaign or personal donations.
It's possible that if they put on a great dinner, and you don't even have to give $2,800,
but it is.
You could get more. The dinner might end up being worth more than the donation. So the person who's making the in-kind donation is whoever's hosting that dinner.
Well, what is interesting too, though, and this is a perfect point to what we're all kind of discussing here, is the fact that Bernie Sanders continues to flex the muscles of how many donors he's receiving, not exactly from some big name donors, but grassroots. And the New York Times, the numbers there, he could be approaching 5 million individual donations pretty soon. So,
and that might be a record. So this is something that Bernie Sanders just excels at. And by the way, the average donation, I think, for Bernie Sanders is $18. And if you ever look through these FEC filings that have, if you download the spreadsheet, it's thousands and hundreds of thousands of records. And some people give $3.
Yeah.
And some people give $3 like 4 times. So that's
going to happen.
Bernie Sanders motivates people. I will say that. He just motivates people. And I don't think it's hard to understand why. He's not likely to ever win.
Yeah.
He's probably in 3rd place at this point, which is kind of where he was in 2016. But he's a force.
Did you see him on the Patriot Act recently? He did an episode of the Patriot Act. And they were like, the one person the millennials will listen to. And they pan to Bernie Sanders. And he goes on this interview. But I just wonder if it's something else that he's tapping into.
And he's got to convert it.
You're closer to millennials than I am, so why don't you tell me? Young people like Bernie Sanders.
He's kind of funny.
They think he's funny, but I think that he's also angry, and he says the system is screwing you.
Yep.
And I think younger people are more receptive to that message. So he seems like the crazy uncle who sort of makes sense, I think.
And he also wants.
It doesn't make sense to me.
He
doesn't make sense to me. Yeah, I guess that doesn't hurt either.
Well, all right. You've got all the dolls. You got to get
I'm going to make sure I get my doll back. I noticed you seem to have an affinity for the Bernie doll.
I'm not going to start 2020 off as a thief, Rick Newman. That is not my New Year's resolution. But thank you so much.
Okay, thanks, guys.
For joining us. Appreciate it. After the break, Netflix releasing the list of its most popular titles in 2019. What made the list? And why it could be a bullish sign for the streaming giant. Wi-Fi PM is back in 2. Welcome back to Wi-Fi PM. We are checking the market action as we approach the end of 2019. You can see there the Dow and the S&P pacing to end the year in the red as the NASDAQ is just slightly in the green. We'll see what happens throughout the hour. But as 2019 draws to a close, Netflix is unveiling its own list of popular titles released on the platform this year. And taking the #1 spot was Murder Mystery, starring Adam Sandler and Jennifer Aniston. Season 3 of Stranger Things, 6 Underground, The Incredibles 2, and The Irishman rounded out the top 5, guys. Are any of those a surprise to you?
Basically the whole list, because I clicked on the Adam Sandler movie. Maybe it played for me when I opened my Netflix app.
Yeah.
I can't remember. And I may have watched 2 minutes of it.
That might be
And I
enough
was
to
like,
count.
oh,
We're going to
this
get
is
into
kind
that
of-
later.
This is kind of boring. Yeah, I watched Stranger Things in one sitting because it's
Stranger
that's
Things.
just-
I mean,
I'm
so that's
addicted to that show. I love that show.
I love it as well. And James, I mean, that's kind of one of the big things here, too, as Netflix shifts to its own content and really focusing on doing that, building it out as Disney and all the other main studios pull their content in 2019. That was kind of the big story. It's important to see Stranger Things on that list.
Yeah, I mean, I'm frankly overwhelmed by all the content that's out there. Apparently, The Witcher is supposed to be fantastic as well. So
I keep wanting to click on it.
Yeah, it's on my list as well too. We also signed up for Disney Plus. We have 2 little kids, and so they're constantly watching it. We're watching the new Star Wars content on there as well. There's just way too much to watch. And I think the problem with the shows, for me personally, is that you can't really just have them in the background. You kind of have to watch and pay attention to what's
No,
happening.
it's so true.
It's, you know, it's not like Friends where you can just have it play in the background all day long.
It's interesting you mentioned kids because I'm thinking about this too. I'm not a parent, but my sister has, I have a nephew who's 3 and they just got Disney Plus. So you probably have to think, okay, what can we watch as a family that would work as a family? Stranger Things, love it. Might be a little too scary for kids, but I could see why Disney Plus. It's the nostalgia, but also the next generation, introducing, the children to the classics that a lot of us grew up with.
Yeah.
So, I mean, yeah, it's the content, but you have to get the content just right, the right mix of it that's available for everybody.
And also why Netflix is continually trying to invest in more animated movies as well to kind of steal that
The Incredibles, too.
cachet away from Disney. Yeah, a little bit of that too.
Because
So
my nephew will point to something and say something about Incredibles. Like I was wearing something and I think his dad was like, yeah, he thinks you're like a character from Incredibles. Like I haven't watched this movie, but
there you go. That's
There you
another
go.
good example of pro con here because that Pixar obviously, so it would be,
love it.
there's a problem.
Yep.
There's the issue for Netflix, and we'll see what happens in 2020 if they can continue to make people rave about Stranger Things like we're doing because it is that good. But interesting, though, they're very selective about the way that they release statistics about their titles and what people are actually doing
As they should
on
be.
their platform. They try and hide that. They do a pretty good job of hiding it. We don't get a lot about audience metrics, but this list is no exception. Interesting to note, the streaming service ranked its most popular titles by the number of subscribers who watched during the first 28 days of its release. Just 2 minutes would count as a view when we're talking about this list, guys. Question becomes, is 2 minutes fair?
sure, I think it's fair. I mean, they don't have to disclose their viewership by any means. They have subscribers. That's probably the number that most folks care about because
Yep.
it's not about advertising. So to kind of be upset that, oh my gosh, it's just 2 minutes, you would have to look just broadly, like what is the television industry standard, what is the YouTube standard, streaming, just media and content in general to see what is the standard,
Yeah.
what is the amount of attention someone can dedicate to something that would be counted as a view. So until we get to the point where it's like a full, this is the standard across the industry and this is how things are measured, I'm not gonna just be like, oh yeah, 2 minutes, that's it, really, that's a view? I mean,
Yeah. I mean, and we were talking about Irishman, too, a 4-hour movie, basically. I mean,
yeah.
that's another one where it's not, I don't think 2 minutes would count for a 4-hour movie.
Yeah, I think the problem there, again, Martin Scorsese probably hates this, but it can take me 6 sittings to watch The Irishman.
yeah,
and-
it puts me to sleep every time.
I mean, pretty much any movie you watch these days, you watch it, you turn it on and off, and you turn it back on again. So it's I don't know how you measure that these days.
Yeah.
But obviously Netflix has something figured out.
If there's one man who doesn't care, it's Reed Hastings. I don't think he cares. He doesn't care if it's 2 minutes, if you watch for 30 seconds. He doesn't care as long as he is taking up any of your free time and beating out video games or whatever else you could be doing. It's not just him going up against studios. It's him going up against anything else you could be doing besides watching Netflix. And he has been adamant about taking over your life. And with as many movies and shows out now, well on their way to doing that, and I'm sure it will keep up in the new year. But we got to take a quick break, and we are back with the market's biggest movers on Wi-Fi PM right after this. check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
Well, Zach, the Dow is down 50 points right now, building on the decline we saw yesterday. Worst performing stocks in the Dow right now are names like Walmart, Boeing, and United Health. These are pretty powerful names for the Dow. When it comes to Boeing, we did get news that the company has reached a compensation settlement with Turkish Airlines surrounding the still grounded 737 MAX jet. Financial terms were not disclosed, but Turkish Airlines has about 24 of the grounded 737 MAX jet. By the way, Boeing shares, believe it or not, are slightly in the green for 2019, up about 0.5% for the year. But if Boeing declines even further today and drops and closes below $322.50 a share, the stock would move into the red for the year. Boeing, by the way, was as high as $440 a share back in February. And then also keeping an eye on shares of NIO. This is the electric car maker out of China. The stock surging 7% today, up for the second day in a row. It was up 50% yesterday when the company reported a 35% increase in vehicle deliveries for the third quarter. Net losses also narrowed. NIO had an IPO right here at the New York Stock Exchange back in 2018. Zach.
All right, Scott Gamm on the floor of the New York Stock Exchange. We'll check back in with you later on in the show. But after the break, a look back on the economy through the 2010s, from a record wealth gap to the sectors with the highest job growth. We'll break it all down when Wi-Fi PM returns. Good afternoon and welcome to the final Wi-Fi PM of 2019. I'm Zach Guzman, and joining me today is Yahoo Finance's Julia LaRoche, along with Clearonomics founder and CEO James Lu, along for the ride as well. We are going to check the market action as we hit 1:30 p.m. Eastern Time here, and the Dow and the S&P are in the red, and the NASDAQ, as you can see there, the lone major index in the green, up just slightly. We'll see what happens as we approach 2 p.m. Eastern Time. But we are breaking down the economy over the last 10 years in charts. Reuters highlighted some of the developments that have shaped the U.S. economy over the past decade, including wealth inequality. And you'll notice that the rich got a lot richer over the last decade. The top 1% of households account for over $34 trillion of the country's net worth. That's up roughly 4 percentage points from the end of 2009. Guys, in September, we actually hit a record when it comes to wealth inequality. The Gini coefficient, the standard for measuring wealth inequality, record in September.
Right. Well, I mean, one thing that is worth pointing out, because you often see President Trump cheerleading the stock market when it goes higher.
Sure.
And then, you know, people will be like, yeah, stock market's great. The fact of the matter is a lot of people don't actually have exposure to stocks. Yeah, maybe through pensions or 401ks, but a disproportionate number of the upper echelon, the more wealthier households hold the majority of the stocks.
Yep.
So I think that's always worth pointing out when you often see the stories about, you know, stocks at a record high. I mean, not everybody's coming along for the ride.
Yeah, because that's a big driver of this too. It's not just actual income inequality, which is talked about a lot when we talk about
That feeds
female
into
wage
the
gap and
income
racing, but
inequality,
it does. It's also stocks and the fact that
The
Julia's
investing gap.
Yeah.
There's an investing gap.
I think that's absolutely true, and it's not just the stock market. It's home prices, which finally rebounded. in the 2012, 2013 time period. You have net worth, which is at record highs, but again, how is that distributed? I think the main challenge with this, well, really there are two. One is just the political implications of this, and of course you go back to the 2016 election, and there's arguments that this drove a lot of the voting population in a certain way. But you look at the underlying causes of inequality, and the question is, how can you fix the system without also killing the golden goose that lays the golden egg? Because you have a system where you have these billionaires with just huge swaths of the wealth in this country, but it's also because they built something. So I think the balance, especially politically, is how do you get that
Because you don't want to demonize the entrepreneurship, because there are real stories of the American dream, if you want to call it that, of folks who built something and also brought people along the way. I just thought of something else though, in inequality. It's not just, there's wealth gap and all these other gaps, but we're also not talking about the gender gap, which I think also plays into that story. And it brings up that report from the World Economic Forum that says it will take 99.5 years to reach gender parity globally, and then another 257 years for gender equality when it comes to economic opportunity, things like the pay gap.
It's a long time to wait. It's a long time to wait, and a lot of people have been promoting the idea that we need to get there sooner, no doubt. But when it comes to the political focus, too, when we talk about the economy and all the politicians on the left
That's all that matters.
Right, focusing on the idea that, maybe there is this breakaway from stocks, all-time highs, but you do have the underlying economy, even with the unemployment rate at a 50-year low. A lot of people not enjoying the gains, and that is true when you look at the job market as well. The gains in jobs have not been spread equally, particularly tech, construction, home, healthcare, and fitness have ramped up hiring over the past decade, according to Refinitiv data and the U.S. Labor Department. No surprise, department store jobs have plummeted as well. We've seen retail get absolutely shellacked as more and more stores close, which again, when we're talking about jobs in the country, and where the highest paying jobs are, you've got a lot of people who maybe not have gone to college, and some of those jobs, like retail, disappearing. So you do kind of wonder, where do you go from there?
Right. Well, it's also, I think, beholden on companies. And I'm going to give some credit where I think credit is due, and they're making a lot of positive steps. Is Walmart, nation's largest employer, was raising wages, but also retraining workers. So technology is changing a lot of retail jobs as we know it. But they've made a point at Walmart specifically to retrain workers for new jobs. So one of them, I think they've created several tens of thousands of personal shopping jobs to help fulfill those e-commerce grocery orders. Yeah. And you know what? They didn't have to do that, but I think that was the right thing to do. And more companies need to kind of look at that playbook, doesn't matter what industry you're in, and think about our workforce and how, okay, if we're not gonna have this particular job anymore because of this technology, look for other opportunities, retrain your workforce.
And it makes sense too if you've got the people on, if you've got good people in-house already to kind of change it around. But one other chart to show us, which we highlight on the show really pretty much weekly, student loan debt, record, climbing above $1.6 trillion according to the Fed. We've talked about that being alarming. We've talked about how that could weigh on consumers as they continue to pay off loans later and later in life. It could be delaying home purchasing. A lot of implications, I think, that often get overlooked on that chart right there.
Yeah, I think it's a big, huge problem. It's going to be a cloud that hangs over the American population for some time. Really, the questions are, one, what is societally, what do we do, not just about student loan debt, but about school in general? Is a four-year degree actually the right thing for everyone? A private school education, that sort of thing. And then on the other end of the spectrum, it's, well, once you have all the student loan debt, it does distort economically the choices you make. Are you going to take that risk and take that entrepreneurial route, or are you going to take that steadier job where you're guaranteed to be able to pay off your student loans on a month-to-month basis? Right. It does have a distorting effect on the economy.
And then I'm thinking of like our generation, we're friends with folks who, you hear the stories of, I paid off my 6 figures in student loan debt, and when there are conversations of getting rid of the debt, forgiving the debt, you have to also wonder, how does the person who spent all that time paying off theirs feel when they see their other peer get there, if that happened, like theirs paid off. So it's a conversation that's really, really tricky. It does burden a lot of people. 1.7 trillion. I think my prediction in the next decade is people are going to look at their state schools. They're also going to look, probably doing 2 years of community college before going off to college. I think people are really going to take, I don't need all these benefits. I don't need the fancy student center, all of these things, when I can get a good, solid education, stop putting all this money toward the administrative stuff and inflating costs, keep those down. I think this is my prediction. I think there's going to be a real awakening of, what is it really worth?
Yeah, and how big of a drag is it really on the economy as well? As you just saw on that chart, the percentage of delinquent payments for student loan
You
debt.
cannot declare bankruptcy. And when you declare bankruptcy, it still follows you.
Follows you around. But although, we don't want to be doom and gloom here on Wi-Fi PM to wrap up the decade. Of course, it's a problem, but there's a lot of positives to point out. So I want to get to one positive, perhaps. Maybe it's a positive if you travel a lot. The 2010s were very friendly to the U.S. airlines. The country's aviation giants posted their 10th straight year of profits, marking the longest profit streak in over 40 years for the industry. While total revenue is likely to dip in 2019, airlines have been raking in more money every year this decade. And interestingly, despite increased consolidation to a point where the 4 largest airlines now control about 3/4 of the market, the average cost to fly has decreased substantially over the last 2 decades, from an inflation-adjusted average per ticket of $507 in 1999 to just $364 a ticket in 2019. But guys, of course, there are extra bag fees, other fees that you gotta factor in too that didn't exist back then. And looking ahead to 2020, about 120,000 unionized airline employees, including pilots and caterers, are going to be renegotiating contracts as well, pushing for more money. So that might make fares a little bit more expensive. But interesting to see that all that consolidation, we hear about breaking up big tech, hasn't actually led to more expensive flights in the country.
No, and actually, I just want to point out, who got into airline stocks in the decade was Warren Buffett, who had famously shied away from the airlines in general. That was something that just worth pointing out for the airlines, that Buffett, who had always shunned them, finally got in the last few years. Just in terms, the pricing is interesting that it's come down, but I feel like people are traveling more. I think you see it a lot more on social media. I always feel like I see friends and they're in Paris like all the time, and I'm like, how do you do that? Like, I don't know how you do that, but
miles, I guess.
I also, miles. I guess it's miles, but will there eventually be a day where you're like, as people become more aware of what's going on in the environment, the climate, you're seeing people who are already starting to pull back from eating meat because of the environmental impact, like say, hey, you know what? Your weekends in Paris is really not that cool, I wonder if we'll see that when there'll be like this awareness of,
or if there's just
footprint.
an awareness of kind of the push. We have electric cars now, push for these plane makers to kind of be developing that technology as well. But interesting that there hasn't been more talk about breaking up some of these airlines that have now consolidated when you control that much of the market.
Yeah, I think even though prices haven't gone up per se,
yeah.
The problem is, as someone who travels for business all the time, it feels like the quality's really gone down.
It's absolutely.
It depends on the airline, right?
Well, it does depend on the airline, but
Who do you usually fly?
Even when you're picking seats, though, the seats that used to just be normal seats, now you have to pay a little bit extra for them.
Crammed in there.
Basically, any additional a dollar amount they can add along the way, they figured out a way to do it.
I'm just saying
that.
And they figured it out. And they're nickel and diamond, and they're making money. They're making more and more money than they've been doing so for the last decade. But coming up, the baby from the famed Time magazine cover of the Decade from Hell issue, written by our own editor-in-chief, Andy Serwer, is all grown up. The night and day recap of how that baby fared over the last 10 years, which was a decade of blessings for investors, right after this.
Jace was on the cover
Yes, that's right. 2020 is almost here. And in honor of the last decade, Yahoo Finance editor-in-chief Andy Serwer is taking a peek into the past by sitting down with the famous crying baby on the 2010 cover of Time magazine. And he is all grown up now. Take a look.
Jace was on the cover of Time magazine 10 years ago, a cover story that I wrote about the decade from hell. Past decade, this was 10 years ago, so it was the previous 10 years before that, was kind of a tough time, and this baby was representing the new decade, but it was so traumatic coming out of the last decade that the baby was going to cry.
Baby New Year crying to get out of the decade.
My brother always brags to me about like how old he is and what he gets that's better than me. I say to him, well, I'm more famous than you.
I was walking down the street and a friend of mine was a casting director and he said to me, you have to get an agent for this kid. And the next time I passed this friend of mine, he passed me a phone number and a name for an agency and said, you have to call them. I already told them they were gonna call. So I called, we went in to see the agent, filled out some paperwork, and about 2 weeks later, I got a phone call saying they wanted to see him for Time magazine. And we got to the space and walked in with him in the stroller, and the lady said to me, who's this? And I said, this is Jace Dittmeyer. And he was all happy and smiley, and she said, oh, great, he's our favorite. He's gonna have to cry. Is that okay? And I said, well, he cries all the time. There were 4 babies that they shot. The baby wrangler was holding him, knowing that he had to cry for this shoot, and Jace was very, very happy, laughing quite loudly. And the baby wrangler said to him, no, your stocks are gone, your 401k tanked, you've got no money left. He was very happy. And then we put him on the table with the hat on.
And then my parents and all the people backed up about like 8 feet or so, and then I started to go from really happy to really sad, and then I started crying right at the camera.
Did the other babies cry too, or was he who was just the best one?
He was the only one that really sat and looked out as he cried. They just had a hard time shooting the other ones. There was a young girl, I think, who cried, but when she cried like this, like downwards.
Look at the camera when you cry.
There was another kid who tried to climb off of the table, and he really did. We sat him on the table, and he was happy and laughing, and it was a big black studio, and we all sort of backed up about 8 feet out of the shot, and he watched us go, that was it. And then he wailed for like an hour.
Well, I had people ask me, like, what did you do to make that poor baby cry? Right. Did you hurt?
The
and I
answer
said,
is nothing.
Right.
Nothing.
No babies were hurt in the making of this cover. Jace, let me ask you about your first decade. So how was it? How's it been?
Great. My life has been good. I've lived it well.
What is that word?
Do you have favorite music? What kind of songs do you like?
So I have an MP3 player at my house, and my dad likes the Beatles, he likes the Foo Fighters, he likes all those bands. I like the Beatles, it's my second favorite band. My first one is Imagine Dragons.
Oh, you're old school. I like it. Okay, what about sports teams? Do you have a favorite team?
Barcelona. The reason why I like Barcelona is because Messi, I've always been inspired by him because I once saw him playing a game where he passed 3 people trying to get him, and I've always wanted to do that, so I've practiced. I got on my school team, and we've never lost a game yet, so.
Do you have any favorite apps and stuff? Do you play on your phone?
I think my favorite app is the App Store.
The App Store.
Well, that's like if I asked you what your favorite wish would be, I'd wish for more wishes.
Yes.
That's pretty good.
Or more genies.
Or more, wow. That's even better. I didn't even think about that. That's really good. That's right. That's very good. That's a very good answer. Listen, congratulations on your Time cover, and I'm so glad I get to meet you face to face again, finally, where we can talk about old times. Thank you for coming by, and thank you, Tamara, for coming by.
You're welcome.
Appreciate it.
All right, so there you go. The 2010's been very kind to him. Started out as a famous baby, now famous, as he said, a life well lived at age of, what, 10, 11? I mean, that's impressive. It's a very impressive feat.
And you have the cover, which we'll have forever. I'm like, goals.
It's all downhill from there.
Why did my parents
That's
put
a
me
lot
on
of
the
fame.
cover?
It's a lot of fame for babies out there. That's more famous than I was at that age. At this age, probably, still. But nonetheless, very interesting to take a look back and see how far we've come just in a short amount of time. But next on Wi-Fi PM, former President Barack Obama names his top songs of 2019, the surprising tracks to make the list, including hits from J. Cole and Migos to Bruce Springsteen. Talk about that range in music taste when Wi-Fi PM returns. Welcome back. Former President Barack Obama is out with his top music picks for 2019 and the 44th president's taste. It's got some range. It spans from Lizzo to Lil Nas X to Bruce Springsteen when you look at the songs that he enjoyed most this year, guys. I mean, that's some serious musical range.
I need to get my eyes checked because I can't read the full screen.
I agree
with Lizzo. I love Lizzo. She was the Time Artist of the Year. I just love her confidence. I love her music. So I'm with former President Barack Obama.
It makes sense. I mean, she's having a great 2019. It makes sense that she'd be on the list.
It is, but she's just like tapped into something that's been needing to like open up for so long.
Yeah.
And I just love her.
It's also interesting to see Suge from DaBaby on there as well. That was trending after Obama named it to his top tracks list of 2019. A lot of people pointing out that a lot of presidents probably wouldn't have that on his list.
He's got a pretty eclectic list going on there.
He does.
Well,
He's like listening to TikTok every day.
Maybe it's for different moods, you know. Like I could see, you know, Obama in the gym and listening to some music, and then other times just kind of chilling at home,
if
relax.
you want to work out, take a song from this
He's got
list.
a good mix.
If you want a long drive track, take a song from
Something
this
like romantic, maybe.
Obama's this country's DJ now.
It's a good mix. It wasn't just music, though, that he was picking for 2019. Of course, he does do this every year. He also highlighted his top picks for movies this year, including The Irishman,
Love that
you
you
talked
picked Little
about a little
Women.
bit earlier in the show, and also Little Woman.
Little Women.
Yeah, Little
Plural,
Women.
lots of women.
It's much better than Little
Yeah.
Woman. Little Woman, much worse, that film.
I can't wait to see Little Women.
I don't know. I mean, when we talk about this, Irishman was kind of mixed reviews, so to have the president come out and say it's one of his top movies, curious to know whether that might boost Netflix subscriptions or streams of the movie as well.
Well, he liked Roma last year. That was a Netflix.
And that won the
movie.
Oscar.
Yeah, you know, it's interesting. When he puts these lists out, it's like, oh, I haven't even seen that one or heard of that one. So then I go watch it. So, I mean, there's some influence. President Obama's maybe an influencer now.
Yeah, such a fall from grace, really, when you think
No,
about
I mean, people are going to, you know, it's kind of become a tradition. And it's like, okay, what did he say? If you're an author and he puts your book on his list, hello, that's a huge compliment.
Well, we also have the books, the list as well. Just got to highlight that real quick. His favorite books of the year, including The Age of Surveillance, Capitalism, and How to Do Nothing, Resisting the Attention Economy. So maybe a nod there to focusing too much on influencers as well. Very meta advice from President Barack Obama there in his best of 2019 list. But guys, it's been a great year. Thank you for wrapping up the last Wi-Fi PM of the decade. James Liu and Julie LaRoche, appreciate you guys being here with me.
Thanks, Zach.
Happy New Year.
Happy New Year.
Now we can say it. I think we can say it now. But
I'll
don't
see
go
you
away.
next year.
Yeah, next year. It'll be great next year. Don't go away. We're headed to the New York Stock Exchange in 60 seconds. Stick with us. All right, let's check in with Scott Gamm on the floor of the New York Stock Exchange. Scott?
All right, Zach, we're joined now by Peter Tuchman. We're all ready for the new year. All right, so we're wearing the glasses. The light's kind of giving me a headache. But
I know, it's okay. As long as we don't have a seizure, we're good.
Yeah, well, what do you expect from the markets in 2020?
Okay, so, you know, I think it's interesting to see that normally these days, the last couple of days tend to be fairly volatile and big moves. This sort of seems like everybody's all in, right? They've already done what they need to do to close out their year. What am I looking for 2020? You know what, I think it's going to be a continuation of this volatile, crazy year, right? There's still a lot of anxiety on the table. We still don't have a closed deal with China.
So you're kind of bearish. I mean, you're wearing the red glasses.
No, I'm colorblind,
Okay,
so
okay, fine.
I'm not bearish or bullish. I'm going to take it a day at a time. But I really think that we're going to see a lot of volatility. I think we're going to see forward moves on the upside, I believe. We've got the administration still here. Hey, David. So there's going to be volatility there. We've still got a lot of stuff going on with China. We've got Brexit, the big unknown, right? You've got some slowing global growth, which I don't know if it's bottomed out or what. So there's a lot of anxiety on the table. There's a lot of good fundamental growth in the U.S. I don't think there's anywhere else to invest except here on the floor of the stock exchange.
Well, that too. Well, and also, I mean, we've had, 6 weeks, 2 months of gains, and the market really, for the most part, has held on to that gain, notwithstanding today and yesterday.
Absolutely. I look today. Let's not give anybody a mixed message here. Down 40 points is absolutely insignificant. This is not even a pause. This is just kind of a churn and burn last couple of days here. The market is going to close out 2019 up double digits across the board, with closing basically at every record in every indices.
All right, we got to go. Peter, thank you. Happy New Year.
Everybody.
Taking these off. Zach, back to you.
You should keep them on. They look nice. Happy New Year to you, Scott Gamm.
It's giving me a headache.
All right, fine. Never mind. Coming up, President Trump reveals the timeline for a U.S.-China trade agreement. The ticker all over that starts in 2. Happy New Year.
afternoon and welcome to The Ticker on Yahoo Finance. I'm Shauna Smith, checking in on the market action on the last day of the decade. We're seeing the Dow back off of its highs, off just around 41 points. S&P also trading to the downside, though it's still set to gain almost 30% so far for just 2019 alone. The Nasdaq is the only major index moving to the upside. It's up just around 0.1%. Let's get to our big four tickers of the day. We have Tesla. That will be one of the tickers that we will be discussing, and that's because it's disclosing impressive new production data for its Shanghai Gigafactory. We also have Uber filing a federal lawsuit to block a new California freelancer law coming into effect tomorrow, and we have Baird naming Amazon and Zynga as its top internet plays for the year. Well, first, let's get to Uber filing a lawsuit. Now, the ride-hailing company is trying to block the new gig economy law in California, saying that it's just simply unconstitutional. Now, this is a law that's set to take effect in the new year and could force Uber to treat their drivers as employees. Jared Blickery is standing by. And Jared, what's interesting to me is what Uber is saying, that they're claiming that violates guarantees of equal protection and due process. What's the potential implications here for the stock?
Well, this is going to be massively, I think it could be very costly for Uber and for Lyft and any number of other companies that are subject to this law. And it has unintended consequences as well. We already saw Vox lay off a number of its staff, which were gig economy workers, in anticipation of this coming into effect. But if this does pass, this is going to mark an important reversal, and we could see this happen in other states. Now, the suit would apparently have some merit, too, because they're saying it violates equal protection clauses of not only the U.S. Constitution, but California. And this suit is filed in federal court in California. And they give the example that there are certain exemptions for people like travel agents, construction truckers, and really, why is this? This is seemingly arbitrary. So that's where they're coming from this. Stock not really being affected today, but if we take a look at what's happened since its IPO date, we can see it's right near the bottom here in its trading range over the last few months, and it really hasn't seen any kind of signs of life in quite some time.
Jared, the big question, though, is that some companies might have to cut workers as a result of that. Is that something that could really affect these companies going forward?
Yeah, I think it's one of the unintended consequences. I gave the example of Vox. Well, if this law does take effect and Uber and Lyft and some of these other companies don't find some exemption or don't get it repealed or don't get some kind of stay in court, they're probably going to end up letting a lot of drivers go. Remember, they have to turn a profit by the end of 2021, and that's why their stock prices are so under pressure right now. It's not only Uber, but also Uber Eats, which relies on this as well.
Jared, there's also a story that I'm watching here in the New York Post saying that Google's food ordering business could deliver a blow to Grubhub and Uber Eats. That's, I think, one of the main reasons that we're seeing Uber move to the downside today.
It could be. This is a big story because if you'll recall what happened a few months ago in the hotel industry, when Google Hotels started pushing traffic, SEO traffic, to its own site instead of Expedia and TripAdvisor, when those other companies had to disclose that, they took 20-25% hits in one day. So Google is the big kind of monster in the room here. And if they're getting into Grubhub's business, which owns Seamless and Postmate and DoorDash, that could strike a huge blow for them. And in fact, Grubhub, which had a huge decline about 2 months ago, and that is because of its disclosure here that it lost a significant amount of traffic. Now people are saying that that wasn't due to their partners necessarily. That might be Alphabet, Google, really ramping up Google menu items here, the delivery service.
That will be a story that we continue to watch here heading into the new year. Jared, thank you. Well, let's get to Tesla. It's hitting its early production target numbers in China. Now the automaker is saying that it can produce more than 1,000 vehicles a week in its Shanghai facility. And it aims to reach 3,000 a week in the near future. Dan Halley is here with us. And Dan, those numbers, 1,000 a week already, 3,000 not too far away. That's pretty impressive.
It's super impressive, especially when you consider how long it took them to get that up to that kind of speed at their Nevada facility. And that was kind of an ongoing struggle for them to get the cars out the door, to get them produced. And obviously they've managed to do that now, but being able to do that so quickly at the Shanghai facility has been incredibly impressive, especially when you consider that they broke ground on it earlier this year. So, 1,000 vehicles coming out weekly. They did this through loans through Chinese lenders. And so it's really kind of, it behooves China to push this as a good story, as well as Tesla to push it as a good story, because it shows that China, has not been impacted by the U.S. trade war war issues, and that they are an area where companies can invest and succeed.
What about the fact, though, that the U.S. tax credit for electric vehicles here in the U.S. is expiring? I mean, it's going to zero as of tomorrow, as of January 1st. There's also the fact that the credit over in China will be reduced as well. How big of a headwind do you think that is for Tesla going forward?
Look, I think that's going to be a big headwind for any electric automaker, right? The whole idea behind buying these and being able to get them at a good price was because you had these tax credits. Same thing going on in China. Luckily for Tesla, at least, they're going to avoid a 10% import tariff because they're being built there now. But, for regular consumers to be able to go out and purchase one of these vehicles without a tax credit, I mean, it makes it seem much less affordable than the Model 3 originally was supposed to. I think to get back on track, or to get people to continue to want to purchase these vehicles, Tesla's going to have to either do something about pricing or really lobby for a new incentive for purchasing electric vehicles.
Within the space, we also took a look at NIO yesterday, surging for a second day today. Are you reading into that at all? Because we have to keep in mind, the move looks significant. It's up almost 10%, but it's still only a $4 stock.
Yeah, this is wild. Basically, the company is admitted that they are just running out of cash, kind of like Tesla. They've
some similarities there.
They've really come out and just straight up said, look, to keep going, we need to find loans. We're working on it right now, but we don't have the money to continue to operate, or we won't have the money to continue to operate in the year. So, they're a company that's struggling, obviously, to ensure that they can continue to produce vehicles. They're not producing nearly the volume that Tesla is because they don't have the ability to do so yet. But it is interesting to see that the company did manage to produce as far as its last results go. So it's something to look forward to. For Tesla, though, they're doing well right now, but going forward, it makes you wonder, will they continue to be the EV company to beat, or will local producers become the go-to for local consumers? It's kind of that issue that's kind of going on with the tech industry right now, where Apple is facing off against the homegrown smartphone makers.
They're cheaper there, too.
Exactly. So that could become the same kind of issue you see in the EV market.
All right, Dan Howley, thank you. Well, let's get to bullish calls on Amazon and Zynga. Now, Baird naming both of the companies to its top internet picks. In a note to clients, analyst Colin Sebastian wrote that Amazon has underperformed relative to its mega cap peers, and that Zynga is well positioned thanks to new title launches and the potential for more M&A. Anjali Kamlani is here with me. And Anjali, what's interesting is they talk about Amazon. The stock is up almost 23% so far this year. So maybe it's not posting the types of returns that Apple has. It still had a very, very strong year.
It did have a very strong year, and other analysts have noted that Amazon is one of those companies that has positioned itself really well in terms of the moves that it has made, at least in the last few years and even in the last few months, to be able to provide that return. So, and on that note, of compared to its peers, let's look at what those numbers look like. For 1 year return, Amazon is at 30%, where you have Google at 36%, so it's kind of on par there. But then you have Microsoft, Alibaba, Facebook, and Apple all in the 60 to almost 90% range. So it is a significant underperformance there.
Anjali, let's switch gears here and talk about Zynga. Now that stock performing very well so far this year. We just had the chart up. It's up over 50% since January 1st. But going back over the last 5 years, it tells a little bit of a different story. Why do you think this bullish call is coming in now for Zynga when a lot of Wall Street analysts on the street are questioning the company's future?
They are questioning it, especially because of the entrance of a lot of the tech giants and a lot of the larger legacy gaming companies and how much they're looking at sort of Zynga's format and what they've been doing. I mean, you have to take a look at the numbers for the market. In 2012, it was estimated that mobile gaming was going to be $7.8 billion globally, where right now you have on track to generate $68.5 billion. So that's a really big jump that you're looking at, and the potential is obviously there. So with the company having had the history and the trajectory for such a long time in this area, it's easy to see why they would be calling out for that.
All right, Anjali, thank you. Well, straight ahead, President Trump announcing the phase 1 trade deal with China will be signed January 15th. But the toughest battle of the trade war may still be ahead of us. We've got all of that. Stay with us. Welcome back to The Ticker. The big story of the day, President Trump saying that the Phase 1 trade deal will be signed next month. Now, he tweeted earlier this morning, I will be signing our very large and comprehensive Phase 1 trade deal with China on January 15th. The ceremony will take place at the White House. High-level representatives of China will be present. And at a later date, I will be going to Beijing, where talks will begin on Phase 2. Joining us now is Fred Hochberg. He's former chairman and president of the Export-Import Bank. And Fred, I think the most important part, we'll get to Phase 1 in a second, was the fact that we could see a Phase 2 deal. What do you think about that?
Well, number one, this is not mission accomplished. This is a start. It's better to be talking and have some less tension in the air. But there are a lot of open issues, and the open issues are not going to be solved by just buying more agricultural products from them.
Fred, you talk about the open issues remaining. When we talk about what could be included in Phase 1, do we have any clarity on that at this point?
Well, President Trump is keenly focused on reducing the trade deficit. He stands alone in that. I mean, most economists don't think that's a big issue, don't think that's an important issue, but that's paramount in the president's mind and many in the White House. What more goes to the point is things like intellectual property, and most importantly, what we call trade secrets or tech transfer. And that is, China has often, quote unquote, stolen things you can't buy. For example, you can't buy the formulas of Coca-Cola. And it's those kinds of things that also at the heart of an unlevel playing field we have with China right now that's going to be very difficult to solve.
Now, Fred, the issue that isn't being talked about really in addressing this is competing with China. And I know that you say that's where the Export-Import Bank comes in. From your experience there, what needs to be done?
Well, the battle with China is also around the world, in sub-Saharan Africa, in Asia, in Latin America, and where U.S. companies could be competing and go toe-to-toe with China. One of the things that China has that we lack is they have 4 export banks that finance their exports. Huawei is one good example mentioned in the press just this week. We have sort of disabled our Export-Import Bank. It now has a new 7-year life, but it's been chipped away at in terms of its flexibility and ability to go toe-to-toe with some of the most brutal competitors that we have.
When you take a look at, Fred, how President Trump has dealt with some of these trade issues, imposing tariffs on China, this back and forth rhetoric that we have seen gone on for more than 17 months at this point, what's your thoughts on his approach, and do you think it will be effective in getting some major concessions from China?
Tariffs are a discredited tool of the 20th century. We're now in the 21st century. We ought to be using tools that are more suitable to technology, to digital, to entertainment, to financial services. And we keep thinking of trade and trade deficits in terms of how many airplanes or how many soybeans or how many cars we're exporting versus importing. And that is really not at the heart of the matter. But yet that is what the president seems keenly focused on, as well as his advisors.
So, Fred, then what's a more effective way to deal with this?
Well, obviously more effective, but it's slower. The rest of the world agrees with us. You know, the EU agrees with us, Japan, Australia. It is hard to build a coalition. It's hard to get, but they all are in the same place. And we could be much more effective, I believe, if we were to find ways so we could bring them along, as opposed to making it part of the problem, not part of the solution.
Tariffs, could they have an impact on the quality of goods you think that we are getting from China down the road?
I think without doubt. You know, when tariffs are less than 10%, I think that there can be some shortcuts made on the manufacturing side, on the distribution side, and maybe absorb that. As tariffs grow or stay prolonged, they may have an impact on quality. Companies are going to cut corners, both at the manufacturing side and perhaps at the selling side here in the United States, to preserve profit margins. You know, Chinese companies are not going to willingly give up their profit margins because we've imposed tariffs or a tax, a sales tax, on their product. So I think that is a very real issue. And the other issue is, China, it's very hard to move supply chains. These supply chains and manufacturing chains have been established over years. And frequently, if you're talking about electronics, there is a supply chain, there's the warranties and so forth. So these are not easy to move. So we may see some degradation in quality or some price rise.
Do you expect the trade war that's been going on with China, looking forward to 2020, do you think will have a large impact or be a drag on economic growth?
Well, I think it's hard for it not to be. I mean, partly we need peace and prosperity, and the instability around trade, the instability we're going to have a deal. I think Donald Trump tweeted over 300 times last year about the trade deal with China. So we have a deal, we don't have a deal. We have a deal, the deal falls apart. The stock market has been gyrating in part as a result of, are we in a trade war or we solved the trade war? So that isn't good for business confidence. That's not good for making investments in plant, equipment, technology when there is so much uncertainty in the air.
All right, Fred Hochberg, thanks so much for joining me today.
Thanks.
Well, coming up, Wall Street is ready to close out trading on a banner 2019. We'll head live to the floor of the New York Stock Exchange for reaction next. Welcome back to The Ticker. Let's check in on the markets. The last trading day of the decade, the Dow off 43 points. S&P also trading to the downside, yet both of the indexes are not too far from the recent record highs. NASDAQ, on the other hand, still holding on to gains. Scott Gam is standing by on the floor of the New York Stock Exchange. And Scott, as the decade comes to a close, what's the feeling down there on the floor?
Well, Shauna, the Dow's down 43 points, building on yesterday's declines. Laggards in the Dow right now, names like Walmart, Boeing, United Health, these are pretty important components for the Dow. When it comes to Boeing, though, we did get news that the company has reached a compensation settlement with Turkish Airlines surrounding the still grounded 737 MAX jet. The airline flew about 24 of the plane's financial terms were not disclosed, but Boeing stock, by the way, is down right now, but it's actually still positive for 2019 by just a hair, by about 0.5%. Now, if the stock today closes below $322 a share and 50 cents, that would put the stock in the red for 2019. And Shauna, also just quickly keeping an eye on shares of NIO. This is the electric car maker out of China. The stock is up about 12% right now. Yesterday it was up 50% when the company reported a 35% year-over-year increase in vehicle delivery sales. NIO had an IPO right here at the New York Stock Exchange about a year ago, back in 2018. Shauna.
Scott, what was all that singing going on behind you? I was surprised you were able to keep your composure during that.
The annual singing of Nelly.
There we go. Well, I'm happy that we were able to broadcast it live. Scott Gam, thank you.
Happy New Year.
Happy New Year. Well, coming up, how investors should position themselves as the 2020 trading year prepares to kick off on Thursday. A top expert joins us to weigh in next. Well, Wall Street is having a banner year despite trade tensions with China and global growth concerns. Now, all three major indices are up at least 20% since the start of the year, with the S&P 500 still on pace to post a gain of nearly 30%. Joining us now is Frances Newton-Stacy, Director of Strategy at Optimal Capital. And Frances, this has been a record year for stocks. I just mentioned the fact that the S&P on track for nearly a 30% gain in the S&P. The question is, how long can this momentum to the upside last?
Yes, that's the question on everyone's mind. And actually, in the next few days, at the end of the week, I kind of expect some selling because I think people will take some profits and they're pushing those capital gains off for another year. Just because people will probably take some profits. I mean, it just makes sense. Take some money out of the casino. Anyway, joking. But it depends really on the repo market and the Fed. I mean, we've added so much to the balance sheet to make sure that the overnight repo market is in place. And that is keeping everything very, very liquid. Also, on the banking side, the monetary, basically the money supply has grown about a little over 7% this year, as juxtaposed to a little over 3% last year. And as long as the credit markets are this liquid, it really supports equity prices. Share buybacks have been a big story this year. Those are going to probably slow. But again, if there's a lot of liquidity, I think investors will stay interested in stocks.
You mentioned the repo market. One thing that stuck out to me was Bloomberg had a headline out saying that the Fed wins its year-end repo battle, but the war continues, the war to control rates continues. It drags on. Do you agree with that?
Oh, absolutely. You have to manage it constantly because we have in certain areas of the system, we have a record amount of leverage, and they really tried to unwind the balance sheet. And I think that was some of the reason that we had, sort of a sour year last year at the end of the year. But you just have to keep those credit markets liquid because anytime you see cracks in the foundation or any kind of default situation, then you're looking at a very deflationary risk that's popping up out of nowhere. The markets obviously shrugged off a lot of the China trade. I think some of the muted volatility this year was because of positivity on the China trade. I don't know when the deal is signed, if it will be sell the news or encouraging about phase two. Trump will probably tweet and let us know
Yeah, I think that's
how it works
safe bet
out
at this point.
But the backbone of the economy is credit markets and the money supply, and that is growing. And so that's a good sign.
The one thing traders are watching, you mentioned the Fed before, the fact that they signaled the fact that they won't raise or cut rates in 2020. When you take a look at when you expect the Fed to do something just rather than get off the sidelines, not remain on hold, when do you think that will happen?
Hard to say. Depends on, again, these credit markets and also probably equity prices. Jerome Powell's obviously shown some interest in that. Trump has obviously shown some interest in criticizing him to incentivize interest in that. But the thing is that they're really stimulating the economy right now through the balance sheet. And I think that's better than lowering rates because I think a lot of money has come from overseas looking for the positive yield that we have in the U.S. We don't have a lot of room to use monetary policy to lower interest rates for correction. So in 2000, 2008, we lowered 5%. We don't even have 5% to work with. So the balance sheet expansion is sort of trying to get ahead of that curve so that our monetary policy tools of the limited room to move rates is more effective.
When you take a look at where the U.S. equities are right now, I mentioned the fact that the S&P is up nearly 30%, the Dow not too far from its most recent record high, NASDAQ also pushing above that 9,000 mark. From a valuation perspective, do you think where we are today is justified when you look at the fundamentals?
Well, earnings have decelerated pretty substantially, but I don't know how much of that, and particularly in the CapEx and the manufacturing numbers, I don't know how much of that was uncertainty over China trade and how much certainty the phase one deal will give and how skinny that deal is when we get all the details. So that, I think, is going to be, we could have a reacceleration, or we could see our business cycle rolling over as, we basically peaked in earnings in the third quarter of 2018. And we could see our business cycle begin to roll over as, overseas they bottom out. So this just has to be watched. It's hard to say at this point.
All right, Frances Newton-Ceci, thanks so much for joining us today.
Thank you, Shauna.
Well, coming up, a new escalation in Mideast tensions with protesters thought to be backed by Iran attempt to storm the U.S. Embassy in Baghdad. Details on the potential fallout for energy prices next. Welcome back to The Ticker. I'm Shauna Smith. Let's give you a quick recap of the tickers that we've covered in the show today. First, we looked at Tesla. Now the automaker announcing its Shanghai Gigafactory is now producing more than 1,000 of its Model 3 sedans per week. Yesterday, Tesla officially began deliveries in China. Also in focus, we have Uber. Now it's filing a federal lawsuit with the food delivery service Postmates to try and block California's new freelancer law. That's set to take effect tomorrow. Now the law is expected to force companies like Uber and Lyft to classify their California drivers as employees rather than freelancers, which would significantly increase operating expenses for businesses. And we also took a look at Amazon and Zynga. Now Baird is naming the two companies as their top internet picks for 2020. It cited Amazon's dominance in e-commerce and growth opportunities for the choice. Also saying that increasing visibility for Zynga's social video games and new title launches will likely boost the company's stock in the new year. Checking in on the closing price of oil today. Now crude, taking a look at where it closed the year, just to the downside, off around 0.5% at $61.34 a barrel. This coming after protesters attempted to breach the U.S. Embassy in Baghdad in response to U.S. airstrike on an Iran-backed militia group in Iraq. Now the siege drew a strong rebuke from the President Trump as well. Joining us now is Julian Emanuel. He's Managing Director and Chief Equity and Derivative Strategist at BTIG. And Julian, when we take a look at the reaction in oil, nothing too significant there. Why do you think that is?
Well, it's difficult to read into trading on the last day of the year, first off. But second off, if you look at it, oil prices have been very, very strong for a number of weeks right now. It's been a very good quarter for oil prices. So in that respect, you may have had it could have been anticipatory in a way.
Taking a look at energy just overall, it's the last trading day of the decade. Energy has obviously been a huge underperformer when it comes to the broader markets. Looking ahead to next year, do you see that changing at all?
We actually do. We think the elements are in place for a return to sort of a more value orientation. And while, clearly part of the story for energy shares in 2019 has been, the overhang of the largest IPO ever from Saudi Arabia, which has now cleared. Obviously the divestment from ESG portfolios and so on and so forth. What we would say to that is, with the sector now representing about 4.5% of the weight in the S&P 500, and the idea that fossil fuels are not going away anytime soon, in an environment where, if anything, politicians are creating upside risk to economies in 2020, we think that is a very compelling story for owning energy shares.
One commodity that we are watching today is gold. Now, gold has been on the uptick really recently. Taking a look at how gold settled the year, posting its best, or it's on set to post its best yearly performance since 2010. When you take a look at where gold is trading today, above $1,500, do you think there's still room to move to the upside?
We do. In fact, we could see prices, in our view, reaching as high as $1,700 next year. Look, no matter what the story, particularly since we all know there's an election in November of 2020 to be contested, geopolitical headlines are going to stay front and center, regardless of the ebbs and flows of trade, Brexit, obviously the hostilities in the Middle East. And the biggest difference between now and a year ago is, in our view, the dollar has turned over and is more likely to be in a downtrend next year, which is supportive of gold.
How weak could the dollar get? You mentioned the fact that it's been very weak. The dollar index down about 3% over the last 12 weeks alone.
Sure, we see, sort of another 3 to 5% next year. And on the euro, you're at 112 dollar to the euro. We think that number could get to 120 sometime next year.
All right, Julian, thanks for stopping by today. Happy New Year.
You too.
Well, coming up, why 2020 may prove to be a turning point for top video game makers like Activision Blizzard. We've got all that next. Welcome back to The Ticker. Let's get to our next group of tickers. Cowen predicting the new heights for Dick's Sporting Goods. Also, Credit Suisse getting bullish on Activision Blizzard's prospect in the new year. And XLE and the energy sector poised to turn around into the green in the new year. That's a big question. Julian thinks so, but we're going to get another perspective coming up. First, let's get to Cowen predicting Dick's Sporting Goods has more room to run. Now, the firm's analyst raising his price target on the stock to $53, noting that Cowen's survey data on shoppers' taste for sporting goods shows gradual improvement across demographics. Anjali Khemlani is back with me with the details. And Anjali, when you take a look at this call, it's interesting because they seem room to run for Dick's on the heels of Nike and Under Armour both seeing some weakness in North America.
Absolutely, but on the flip side, they are working with Adidas, which does have strong sales in North America. We know that they are rolling out the Adidas Yeezys, that's Kanye West's premium footwear brand, and that is a really smart sort of market to get into. Obviously, we've seen just in shoes alone for Q3, they grew almost 9% in a market that is $32 billion worldwide. So that's a really strong move there. And in addition, let's not forget that they did stop the sale of guns earlier this year. And so looking at the $150 million loss in profits for that and destroying $5 million worth of rifles, it seems like they found that balance and that way to recover.
Anjali, any thoughts here, any concern, worry about how Dick's could be impacted from the trade war? We know we have a phase one deal. There's not too much clarity in terms of what is exactly in the deal. So could this be a headwind for the company going forward?
Absolutely. It's a headwind for any company that's dealing with getting products made or marketed or in any way is affiliated with working with China. So as with every other company facing the same headwinds.
All right, Anjali, thank you. Let's move on. Credit Suisse getting more bullish on Activision Blizzard. Now the firm's analyst raising its price target on the video gaming stock to $69, up from $67, so a $2 increase there, along with hiking his 2020 earnings estimate to $2.39 a share. Dan Howley is back with me. And Dan, I know you follow the gaming sector very closely. Is Activision Blizzard, from your perspective, going to be a winner this year?
It's honestly, it's really hard to tell. At the outset of the year, it was kind of, oh no, what is this company going to do? They lost a major title and franchise in Destiny. That went to Bungie when Bungie split off from the company. It's Activision Blizzard just on its own now. They did have some really big surprises, though. They had a re-release of a game that I probably played too much of in high school and college called World of Warcraft. It's now a classic version, World of Warcraft Classic. Did incredibly well for them. It was a huge shock. And then the new Call of Duty, they released them every single year, but this year they did incredibly well in developing it. So it's done well as far as sales go. Now, going into 2020, they're talking about new games like Diablo 4. Diablo's a huge franchise for them. It's just been up and down, sold incredibly well. I think 30 million copies in their last sale. And then they're also going to have another Call of Duty because it's another year. So I think as long as the main franchises like Diablo, Call of Duty do well, they'll also have a new Overwatch game. Overwatch is their big esports play. It's going to be Overwatch 2. Kind of weird how they're doing this, though. It's not a full re-release or full release. It's going to work with the original game somehow. I'm not even clear on how it's going to work. It's super bizarre, but anything that they can do to squeeze more juice out of Overwatch is good for Activision Blizzard. And if they can do that here, I think it'll be good. Diablo is going to be incredibly important for them, though. If that game manages to sell well, gets good reviews, then I think that that's going to be a standout for them in 2020.
Dan, one thing that we have seen, we talk about consumer trends or their preferences changing when it comes to retail. It's also changed when it comes to gaming, just in terms of people aren't buying the physical games that they once were, say, 10, 15, 20 years ago. Now, more people are playing online. They're doing it more on their mobile devices. Do you think Activision Blizzard is doing enough in order to change their business model to reflect this shift?
Yeah, I mean, they have a huge play in mobile. They have King Games. That's really a great spot for them, as well as Call of Duty Mobile is a game that they actually have. So I think for them, they are well positioned for mobile. It's been kind of up and down with King. It can be kind of cyclical to a degree in the gaming industry, especially in mobile gaming. But hey, you get those people that just want to play on the train hooked, and they will keep going and keep going and keep going. I think for a company like Activision Blizzard, and for any publisher, the more that they can get out of having to produce physical copies, the better, because they're not going to have to put in that extra cost for those games. They can sell them through their own storefronts online, and that's what Activision Blizzard does. You can purchase things directly through them. They get a better slice of that margin. So good on them. They also push out games to every console, Nintendo, Xbox, PlayStation, PC, mobile, you name it, they're on it. For 2020, we're going to see a new Xbox and a new PlayStation. That will do gangbusters for sales of new games, especially if they can put those new Call of Duty games, that new Overwatch game, and that new Diablo game on those new consoles, because people want games for those new systems. And if they can come out around the same time, ooh, that'll be nasty for them.
Will be. All right. Well, we'll see. I guess only time will tell, Dan Howley, thank you. Well, let's move on. Energy. It's on track to be the worst performing sector of the year, while the S&P 500 overall rose nearly 30%. Jared Blickery is at the Wi-Fi Interactive Board breaking down all the details. And Jared, let's look back over the last 10 years. Why has energy been such a huge underperformer relative to the broader market?
Well, 10 years ago, we were just getting to know the shale revolution. We didn't really have any idea how big it would be, but there was a huge growth spurt throughout the first half of the decade from, let's say, 2010 to about 2015. And the price of oil was also rising during that period. There was a huge growth spurt, and people thought these energy companies, they're just going to make money hand over fist forever. Turns out they couldn't, because the price of crude oil crashed from $100 all the way down to $26. That was into 2016. And since then, a lot of these companies are just saddled with huge amounts of debt. They're encouraged to return a lot of money to their shareholders with share buybacks and dividends, but that means that they don't have a lot of capital. And this is a very capital-intensive industry. So right now, the shale oil boom is really over. And now we're transitioning into a period where the majors like Exxon and Chevron and BP and Royal Dutch Shell, they're really getting into shale oil. They'll take over, but the margins are slimmer. There's just not that growth in the money there. The good thing we have going forward into the next year is that energy prices, crude oil prices, have really rallied over the last month. We've seen crude oil hold over $60 a barrel, and that's supportive of energy company prices. But with crude oil up 33% this year, and we see XLE up only 4.2%, that's a big disparity. How far is that going to carry into 2020? We'll have to see, but there's huge supply coming online in terms of shale oil from the US and also Brazil, and Norway is developing more North Sea oil fields. So there's a lot of supply coming into the back of the year. And one final factor that's going to affect all this is what OPEC Plus does. Now, they can extend their cuts, which are set to expire in March. They could extend those for a longer period of time, but they might even have to cut more, and a lot of members might not want to do that.
Jared, you mentioned some of the big oil plays. I was going through this. One call that stuck out to me was from Bank of America. Now, at the beginning of the month, back in the beginning of December, they said that they see Exxon could rally almost 50% in 2020. It was one of their top picks for the oil sector going forward. Do you think that that's a realistic call? When you take a look at Exxon, it's not like it was an awful performer. It was still, I mean, it's still up just around 1% for the year, so we're not seeing losses at least.
No, but it basically break even. And look at all the losses, or look at all the gains that it gave up. This was that big rally in crude at the beginning of the year. Then we saw the trade war. We got this huge downdraft, and really it's just been making lower lows ever since in a kind of consolidation pattern. So I would say, look at this, figure out which way it breaks, wait for that to happen. And yeah, because it's been consolidating so long, it's likely to get a lot of momentum. If it goes to the upside, maybe 50%. Again, it depends on the price of crude oil. If it breaks down, watch out below.
All right, Jared Blickery, thank you. Well, coming up, the top investment picks for the next decade. A top analyst joins us with his recommendations next. Well, it's been quite a decade for the U.S. market stocks, finishing 2019 on a huge upswing with all of the major indexes near record highs. And over the past 10 years, the S&P 500 up nearly fivefold since the market bottom in 2009. Well, joining us now with his predictions for 2020 is Ted Oakley. He's the managing partner of Oxbow Advisors. And Ted, when you take a look at the market's extremely strong performance over the last 10 years, where are you placing your bets when it comes to 2020?
Well, for 2020, what we're doing right now is we're looking at companies we think can go ahead and increase their earnings this year. We like companies that can grow earnings over the next 3 to 5 years, but we've got a lot of liquidity right now. If you look at the price multiples on things, it's really very high. You had a lot of chasing going into year end. And so we think we'll have a little better entry point. But having said that, we like companies that will give you a push. We think healthcare will be okay. We think energy will probably surprise people this year with the dollar falling. So those are the things we're really concentrating on right now.
Ted, when you drill down here, trying to identify some of the healthcare names that are positioned to outperform, are some better positioned than others in the space?
Well, they are, but in one sense, you like to cover the whole spectrum. And for us, that includes the drug makers, the Johnson & Johnsons of the world. In addition, the healthcare providers, United Health, that sort of thing. And we also try to even go towards senior housing because, see, this is all a demographic trend. And so we have a kind of a mixture of all of those things.
Ted, one of the things that the major thing that the market was pretty much able to shake off in 2019 was all this geopolitical uncertainty. And the headline there was the latest between the U.S. and China when it comes to trade. We have President Trump tweeting out this morning that the Phase 1 deal will be signed on January 15th. Do you expect that to add any momentum to the market, or has that mostly been priced in at this point?
Shauna, I would suspect that's all in the price. I mean, we've had so many months of it, to finally get down to the happening. I don't think it will have much of an impact, and it's not one of those things that really includes a lot of meat in this thing. It's a sort of a window dressing sort of thing for both countries, I think. But we'll see. But I doubt if it has much impact.
Well, then on the other hand, could some of these geopolitical issues cap some of the gains that we could see in 2020?
Well, I think they will, because I think you've had so many people chase the markets in the year end that what you'll have is people taking profits. And we have a number we're using, though, for a fourth quarter GDP that is probably not as strong as everybody expects. I mean, everybody keeps talking 2%, 2%. We don't think we even get close to that. And if that happens, that's going to put a damper on the first month or two of the new year.
Yeah, that's what I wanted to ask you about that. I mean, do you think that we've seen this rally, if we don't get that 2% growth, how big of a pullback could we see in the markets?
Well, it's hard to say on the number itself, Shauna, but my guess is what happens is you pull your multiples back to a number that is really coincident with what they can actually make, these companies can make in 2020. Their margins are going to be contracting. We know that already. Labor costs going up, margins going down, which tells us that it wouldn't be surprising any time during the year to have, and particularly in the first part of the year, to have a 15 or 20% pullback just because you get back to the norm.
Ted, what are your thoughts on just in terms of what we should expect from earnings season? Because it was, if you look at it, really the overall picture in 2019, it was a bit of a disappointment. Do you expect that to continue next year?
Well, I think it continues for the first half and maybe the whole year, because if you look at it, okay, now what you have happening is you've got a change in the guard, so to speak. We have more companies overseas that are doing better. And over here, these companies are really stretched in terms of what they're doing. And I think they continue to be able to show some numbers because they could move some things around. I don't think they get the same benefit in the first and second quarter of next year.
All right, Ted Oakley, thanks so much for joining me today.
Thanks, Shauna.
Well, coming up, unsettling new data from the Fed on the surge in student debt over the past decade. Stay with us. Welcome back to The Ticker. Let's give you a quick recap of the tickers that we've covered in this show today. Well, Tesla is saying that its Shanghai Gigafactory is now producing more than 1,000 Model 3 sedans per week. The disclosure coming after Tesla officially began vehicle deliveries in China yesterday. Also in focus, we have Uber. It's joining food delivery service Postmates, filing a federal lawsuit aiming to block California's new freelancer law that will take effect tomorrow. Now, the law is expected to force businesses like Uber to treat its workers as employees instead of independent contractors, which would likely add significant new operating costs. Plus, we took a look at Amazon and Zynga, now Baird naming both of these companies as their top internet picks for 2020. Baird citing Amazon's dominance in the e-commerce industry and future growth opportunities for the decision. And it says that improving awareness of Zynga's social video games and new title launches would likely boost its performance in the new year. Well, it's time for our last tick of the day, and as 2019 draws to a close, Netflix unveils its own list of popular titles released on its platform this year. Taking the #1 spot was Murder Mystery. Now, this was the starring Adam Sandler and Jennifer Aniston. We also had season 3 of Stranger Things, 6 Underground, The Incredibles 2, and also The Irishman, rounding out the top 5. We have Anjali Khemlani, Dan Howley, and Jared Blickery all back to weigh in. And Dan, when you take a look at this list, Adam Sandler's Murder Mystery, I don't think that was a huge surprise. That generated 30 million account views within just the first 3 days alone.
Yeah, I got nothing. I mean, I don't know. Somehow everybody still loves to watch Adam Sandler movies. I guess they're a lot of fun. I kind of think he went over after Billy Madison and the like. So I, obviously did not watch this, but Stranger Things I watched. Umbrella Academy was something that I watched, and there's a couple of other on there that I didn't think were gonna do that well. Especially The Witcher coming out very recently. It's a hugely popular video game franchise, and the fact that and book series, and the fact that it's done so well so quickly is really surprising.
What's interesting here, Jared, the fact that the top 5, they're all are all Netflix originals, just pointing to the fact that maybe their investment in the original content is paying off.
It might be now. How much are they going to spend in the years to come? We talk a lot about peak content. There's a lot of competition right now, a lot of money flowing into these things. In 5 years, are we going to look back and say, was it wise to get Scorsese, Pacino, De Niro, all these guys back together, Pesci, and we got, what, the 5th most watched movie of the year on Netflix? I don't know if it was worth it.
Well, it also came out at the end of November, so maybe over the next couple of months, it will gain a few more viewers.
I think these are measured from 28 days from beginning to finish, and if it's less than 28 days or been out for less than, then they guess. They basically predict that.
All right, well, Anjali, let me get your thoughts just in terms of how they're measuring this. So it's interesting to note that that Netflix ranked its most popular titles by the number of subscribers who watched during the 28 days. That was what Jared was just talking about of its release, but for just 2 minutes. That seems like such a brief amount of time.
It is, like why someone would even click on it, whether it was by accident or the way that they do the pre-roll, does that also count? It's a question on the analytics that they're deciding to use, and as we've often talked about on Yahoo Finance, Netflix does release these things whenever they do feel like. But the other question too is it any different than counting clicks per se, which is what ad sponsors really look for? It's a question.
It is, yeah, but 2 minutes doesn't really seem like much to me. All right, guys, let's go beyond the ticker. Now, this decade may well be defined in part by student debt. Now, according to Federal Reserve data, loans have increased by 107% over the last 10 years, with roughly 44 million Americans collectively holding $1.6 trillion in student debt. Dan, the question is, how do we best address this? Because this is a situation we have been talking about for years, and it seems like nothing is being done, at least on a satisfactory level.
Yeah, I mean, it really does seem like an intractable problem. You have these students who are graduating steeply in debt. A lot of them get their first jobs, and oh well, they can't now go and pay for an apartment, let alone a house, which we constantly talk about millennials not buying. But it seems like this is just going to continue to be an issue. I personally am fortunate. I ended up paying off my student loans fairly recently. I didn't have a scholarship, so it was a lot of money. I'm free of that, and it really does feel like a huge burden. but a lot of people can't be in that position.
Jared, do you think that this will make some people think twice about even going to college because it's so expensive?
I think it already is, and we're seeing that effect. What they really need to do, if Congress is going to do anything, roll back that law in 2005 that says you can't discharge this debt in bankruptcy. That is a travesty of justice.
All right, Jared, Dan, and Anjali, thank you so much for joining the show today. Well, coming up, keep it right here on Yahoo Finance. We have the very last hour of trading for the decade ahead of us. The final round is all over it next.
Miles London here in New York. This is the final round on Yahoo Finance. Stock's not doing much here. The S&P poised to close out its best year since 2013. We'll have more on that and all the market action in the last hour of the trading year. Plus, what were the best and worst sectors of the year? We have the score. Morgan Stanley is out getting bullish on the world's biggest retailer on this final day of the year, and it's our final round call of the day. Plus, we have our New Year's resolutions. Viewers might want to know what I will do differently in 2020. You got to stick around to find out about that. Joining me right now, or excuse me, we've got midnight in Dubai, in the UAE, because though it's 3 o'clock here in New York, it is midnight somewhere. There they are, live pictures from Dubai. Pretty exciting celebration there. The Burj Khalifa all lit up. That is a couple thousand feet of fireworks and a light show.
That's dope. Yeah.
I think that's great.
Wow. I don't know if I'd pay the entrance fee, which is a ticket over there, but looks nice on TV.
I mean, look, it looks great. That's why we got the internet. You can experience New Year's from all around the world at all times.
Also tracking Santa.
That's right.
Is that over?
That is over. Okay. That is over. Those are the distended voices of Jared Blickery and Brian Sazzi, of course, joining me here on this New Year's Eve day. Market open for a full session. We've got about 58 minutes to go in the session. Let's see where we stand right now. The Dow is down 36 points. The NASDAQ is up 12 basis points, and the S&P is little change. This is the last trading day of the year, the month, quarter, and of course the decade. Been quite an exciting one, I think, for investors overall. Jared talked about it a little bit yesterday in the look ahead and a little bit in Sam Rowe's note this morning. But if you go back and kind of chart where this decade started, you tweeted out today, Greek yields. Now, you are now getting a discount if you're buying U.S. paper relative to Greece.
Yeah,
I mean, it's been quite a decade. And I guess for you, thinking about where we were in 2010 versus now, is there one thing that you could even point to that's the most surprising surprising, or is it just kind of an endless string of surprising moments that have continued to impress
I would say the most surprising thing is no recession. Never thought this expansion would last a decade. In fact, longer than a decade, because I think we emerged in 2009. But how is that possible? Because there were some dark clouds over the horizon in 2009, 2010. I didn't expect this. We got some 20% corrections, in various markets around the world. So you can argue about bull or bear, but definitely didn't have a recession.
Yeah.
My big thing is where's the credit rating downgrade on the U.S.? Our debt continues to balloon by big rates. Hit what, $1 trillion potentially next year? Where's Moody's? Where's S&P? Why aren't they dropping the hammer?
Because they learned their lesson the last time.
Well, let's get out in front of it this time.
Yeah.
I mean, we're not clearing up this debt anytime soon. And also, too, by the same extension, the market can care less about the country's rising debt. Doesn't even care, not even on their radar screen.
Well, I mean, maybe that's part of the story just on what we thought mattered and what we realized does, right? I mean, obviously, for investors, the debt is something that it's just a number, right?
So helicopter money matters.
Right. I mean, I think the Fed's preeminence, obviously, big part of this decade. For me, it's just the fact that oil prices fell 70%. What was that, 5 years ago? Yeah. And I mean, there were bad things that did happen, but it was nothing that you would have assumed a generation ago. 70% drop in oil prices, you'd have world wars and recessions around the globe. And yeah, it wasn't like all smooth sailing. I think China was very, very much on the brink, 15 into 16. But the way that we came through such a major macro event, the most important macro asset, and it was fine. I think it kind of is amazing to me.
Where's peak oil? Remember that super spike in oil a couple of years ago? That was huge.
I remember learning.
Sachs.
We had a class called, I think it was called like Global Affairs or something back Milburn High School. This is like, 05, and we're taught peak oil, right? That was like a thing I learned in school, that this was a major concern. And I guess, yeah, there is a finite amount of oil, but at that time we hadn't yet learned the technology that would be available to unlock all that oil.
That was peak supply, but now we're going to have peak demand.
Right.
Maybe. There's forecasting.
Well, maybe demand has peaked. I mean, because the other thing, too, is then you've got all these alternative energy sources, right?
I don't think it's peaked right now, but could be 2025, 2030.
Yeah.
And we can also debunk officially, I think as of today, Nouriel Roubini's market crash call for the decade has not panned out.
That's another thing, too. And I know that there's plenty of time to dunk on the crash predictors. And I think, look, there's many serious things that there are problems in the market. But this really has been, and maybe it's just because it's the only decade I paid attention, just an endless amount of not like, oh, things are going to be tough, like outright crash calls. Like the market will fall 50% in 3 months. And I just don't, maybe we can finally get past that. It's just not a realistic view on how a bad market would behave. Even a really bad market would take months and months and months to kind of unfold.
Everybody wants to be a hero.
Well, and we're only 1 decade removed from the great financial crisis. As that fades into history and the recessions and the corrections become milder and milder, as it probably will, I think you will see less of those.
Yeah, interesting. All right, for more of today's market action, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Scott, no glasses, Scott. What's up?
No, that was the 1 p.m. hour. You missed it. But for today, we're keeping an eye on shares of Tencent Music. That's because a group led by them, and by the way, Tencent is actually traded here at the New York Stock Exchange. It's a separate publicly traded company. They're going to be buying, along with this group, upwards of 20% of a stake of Universal Music Group, which is a pretty large label representing a lot of big name artists. And that would value the company at about $34 billion. Tencent Music shares are up more than 1% right now. And then we're also keeping an eye on shares of NIO for the second day in a row. That's because NIO is up 12% today. It was up about 50% yesterday. This is the electric car maker out of China. The pop yesterday really came from the company's latest financial results, which included a 35% year-over-year rise in vehicle deliveries for the third quarter. Net losses also narrowed, and NIO had an IPO right here at the New York Stock Exchange just over 1 year ago. Miles.
That's Scott Gamm live on the floor of the New York Stock Exchange. Well, the year was 2013. Thrift Shop by Macklemore and Ryan Lewis was the top song. Iron Man 3 topped the box office. It was also the year the S&P 500 returned nearly 30%. Now, another huge year is about to be in the books for the market in just about 54 minutes. But let's dig a little bit deeper to see what powered some of those returns. Let's kind of go through the sectors here in the S&P. Not a huge surprise. Infotech and communication services, two of the three best performing sectors. but then financials in there. And I think a very interesting decade for the financials. Jared, obviously coming off a low base because they got destroyed in 08, 09. But I think you can tell a lot about the market's story through the lens of the financial sector this decade.
Well, yeah, consider the PR job that Goldman Sachs and JP Morgan have inflicted on the world. They were the boogeyman's 10 years ago. Nobody liked these companies, and now people just kind of look the other way. Oh, it's JP Morgan.
I mean, Occupy Wall Street was only 9 years ago.
Hard to imagine. Yeah.
I'll add one risk for the next decade. You have the likes of a Morgan Stanley, a Bank of America. I would even say, let's say, a Citigroup, potentially next leaders. The next generation of CEOs will be leading these banks, even JP Morgan, over the next decade. So it'll be very interesting to see how they reposition these companies. Everybody wants to put their own stamp on a business.
Yeah, I mean, yeah.
It's only within the last month or two that XLF, the S&P 500 financial sector, was able to reclaim its all-time highs. That took a long time, and it's lagged until very recently. But now that it's these are value stocks again. These financial stocks and regional banks are doing well. Supportive regulatory environment. They might accelerate next year, but it's taken a long time to get to this stage.
Well, and that's why I feel like, obviously tech was the story of the decade, right? You had Facebook shares come public. Everyone wanted that to be a disaster. Ends up being one of the stocks of the decade. Netflix is the stock of the decade. But financials, to your point, Jared, had such a long slog to get back after the crisis. There were so many different moments throughout that. 2011, you had the Euro banking crisis. And then, 2013, it's like, where are we going with QE Infinity? Is that really going to be the problem everyone wanted it to be?
I mean, the Federal Reserve propped up the zombie banks, and they were a big drag on not only the financial sector, but the economy writ large. That had an effect. I think that dragged on GDP growth for the entire globe. And at what cost? We're never going to know the other case, but yeah, that was a big part of it. Most of these, you look at a graph of a chart of Citi, not even close to its highs before the financial crisis.
Yeah, Bank of America, same story there.
But also the regulatory environment, at least in the Trump administration, I think has become more favorable, a little more favorable to the banks. But also a lot of these banks have been slashing thousands of jobs, and I think for them that has helped improve their bottom line. And I can't imagine they will reverse that in the years ahead.
Well, and I think what's interesting about this sector, we'll get to the losers in just a second, but looking at the financial sector, okay, so fine, XLF goes back and makes a new high, but with the regulatory overhangs and what the bank looks like now, and I think these companies, frankly, inability to defend themselves against, the new wave of fintech. And I know that gets a lot of buzz, and I know some of those products haven't really turned into profitable companies yet, but their whole models have been changed by Robinhood coming in saying, actually, trading isn't really worth anything. It's more over in Europe than it is in the U.S. right now. But checking account products that I think maybe a company like a Google wants to get interested in, as was reported recently, or that you just see some of these other players trying to offer where these companies have completely punted.
It is pretty amazing how a lot of the big banks have let PayPal essentially acquire all the up-and-coming major fintech plays, and I'm surprised that Goldman Sachs hasn't gone out there and made a play for SoFi.
No, and JP Morgan has done a little bit of that, but I'm surprised at how little Goldman Sachs really wants to innovate. I mean, they have this entrenched position that was only solidified by the reaction to the great financial crisis, and they haven't really used that to their advantage. They're just big and they're not innovating.
Yeah, it's going to be a very interesting decade ahead for financials, and I think one that, if you're in the financial industry, I don't need to tell you, is going to be challenging to say the very least. Let's look quickly at the losers. Worst performing sectors of the decade, not a huge surprise. Energy on that list, materials on that list, but healthcare, I think, perhaps somewhat surprising. Now, it's not like healthcare was down during the decade. It just wasn't up as much as some of the others. Jared, I mean, I guess, obviously, energy is kind of the story here that jumps out.
Yeah, energy has really underperformed since 2015 when we had that huge crash in oil prices from $100 to $26 a barrel. That was the big one. Before that, everybody was excited about the shale oil boom. It looked like that was the huge growth story of the decade, which I guess it was for the energy sector, but it turns out it's not the profit center that everybody thought it was. So now you have all these companies that are saddled with debt. We're at the end of the decade. Yep. Next year, we should have a lot of energy bankruptcies, more than we have had in previous years. And they're going through consolidation. There's no more growth in shale oil, not the boom days that we saw, and really the majors are going to take over, Exxon and Chevron.
Yeah, and the energy stocks, I think, have come under pressure. Finally, a lot more people on Wall Street are paying attention to ESG. And corporate governance. And a lot of these, I think these stocks have been sold just based on that and just the theory that climate change is real. Why do we own shares in oil companies if as a firm we believe that climate change is real, and we really want to focus on ESG and type investing.
And of course, RIP value investing, right? Every energy stock is a value stock, and those things have kind of just been value traps for a long time.
Until the last 2 or 3 months.
That's right, yeah. And I mean, if you want to talk about underperforming sectors, you could have gone by style, right? You could have looked at the outperformance of growth momentum over value and things like that. So
and it's despite, the sector still hasn't really caught a bid, maybe recently, but despite Warren Buffett's play for Occidental, or his help with Occidental.
Well, I mean, on the other side, when Warren Buffett gets involved, isn't that a sign that the sector is probably kind of has major problems anyway? Like, he's only going into Occidental because it's so cheap.
He
right?
will always make money on these plays. He's making 10%,
Yeah.
but he also bought Goldman Sachs at the bottom. That didn't really accelerate. I mean, they had a nice year in 2009 because it was junk off the bottom, but Goldman Sachs really hasn't been a great performing stock. He made money because of the interest.
Oh, right, exactly. Only Warren Buffett goes in and says, I'll do $5 billion preferreds at 9%, and then they say, yes, sir, where can we sign? Same thing with Bank of America, right? Comes in with a huge preferred offering. Now he's got common, and it's all been good for him. But, when you are Warren Buffett, things tend to work out in ways that it doesn't for people like us. All right, coming up here on the final round, that big Times Square crystal ball that is dropping in just a few hours. We will take a look at how it was made and maintained coming up in just a bit. But first, take a look at where European markets closed on this New Year's Eve day. All right, it's New Year's Eve, and roughly 1 million people will gather in New York's Times Square to watch the famous ball drop at midnight. But do you know what's behind one of the most iconic traditions in the world? Here's a brief history of the famous New Year's Eve ball drop.
Right now, we are in Times Square in New York, in Manhattan, the crossroads of the world. On this amazing six-ton structure behind me, this Waterford crystal ball, there are 2,688 Waterford crystal triangles. And this morning, we are going to be replacing 192 of those Waterford crystals with this year's brand new theme, with this year's brand new design, the Gift of Goodwill. So this is one of the actual panels from the ball that you can see this year. And for decades, the pineapple has been the symbol of hospitality and has been the symbol of good fortune and, of course, goodwill. And that's something Waterford Crystal are quite happy to have, that global sentiment, that communication that everybody can understand. when you think of the town of Waterford, it's not just a brand, it's a physical place. I was born there, my dad was born there before me. We were a Viking town founded in the year 914. Waterford Crystal began in 1783, and here we are, 2019, just about to walk into a new decade. It's quite a feat when you think that there's going to be about 198 million people here in the United States watching the Waterford Bowl. There's going to be 1 million people in Times Square. God bless them, because they're going to be there all day long on New Year's Eve. And of course, then 1.2 billion people around the world are going to watch this ball drop.
I've heard a lot of estimates on how many people actually go to Times Square. 1 million does seem high.
Yeah, especially with no bathrooms, because that just blows my mind.
know?
I used to live right there because our office was there.
Yeah, yeah.
And I would vacate. There's no place I wanted to be less than Times Square.
Right, and like our office used to be there, and you just kind of eyeball it, right? There's no way 1 million people can fit.
A lot of people wearing diapers. I mean, how are you going to the bathroom?
Yeah.
Right. I just feel like I feel like we just gotta just think about it. 1 million people.
Yeah.
There's not that big of an area. Like the Congressional Mall, like down in D.C., that can clearly fit 1 million people, and that is way, 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 way bigger than Times Square.
Probably pretty all bullish Apple too.
Yeah.
There you go.
That's your. You should go in the thing today and get
Happy
stock
to dress up in
tips.
purple, tell
And just
everybody
be like,
download
hey,
the Yahoo Finance app.
what's the stock that you like for 2020?
I'm all for it.
Man on the street.
Let's go.
Here you go. All right, let's send a camera crew out.
I used to do that.
Rob Demetrius has loose plans tonight, so maybe he could be your producer.
I still have the skills. I'm ready to roll.
All right, coming up here on the final round, Morgan Stanley is getting bullish on the world's largest retailer. It's our final round call of the day, but first let's check out today's New Year's Eve edition of the Trending Tickers here on Yahoo Finance. All right, time now for our final round call of the day. Today we've got Morgan Stanley out on shares of Walmart. The firm, a little tweak to the model here into year end, raising its price target on the stock to $130 from $125. Now the bull case goes up $15 a share to $180 from $165. The base case, of course, at that $130 per share. The firm has an overweight rating on the stock. Kind of looking at the good old fashioned here, Brian Sozzi, CFA level 2, sum of the parts analysis. They're doing $3 from higher brick and mortar EBITDA. I think that's interesting just because there's so much buzz around the online business. Now, they're not making any changes to their view on Walmart shares based on that, but just going to Walmart stores is something that Morgan Stanley wants to reflect in or thinks will be reflected, could be reflected in Walmart share price.
Well, isn't it interesting that they can raise up how much the stores will earn on an operating profit basis, despite wages next year at Walmart, hourly wages might go north in the store of $15 an hour. So I think it's remarkable what Walmart is doing. It just speaks to their stores becoming a lot more productive. In part, that's because of the buy online, pick it up in store, and various other initiatives they're driving from the stores and even online.
Yeah, well, I'm looking at the stock here. It hasn't really done anything over the last 3 months. We had that huge spike up, I think it was their last earnings day, to 125, and then it closed at the lows of the session, which was by a prior high, and it hasn't been able to reclaim that. I think a part of it has to do with the fact that they were one of the high flyers, and they were kind of getting punished when we had this regime change in interest rates, when the Fed started expanding its balance sheet again, and you had that shift in the value in cyclicals. There were some groups of stocks that were still able to advance clients, but Walmart's not one of them for whatever reason.
And the next catalyst here, mid-February, there will be probably two catalysts. Obviously, their earnings report, but they will also hold an analyst day down at the New York Stock Exchange.
You know this guy loves analyst
in
days.
February. Love it. I'm very excited to be going there. But I think there's a pressure on for them just to come out with some form of really good long-term outlook here, and I think they do. There's a lot going right at this company.
Yeah, and I think the interesting question, just from like what Walmart means. I mean, we all remember beginning part of this decade, it was actually negative when Walmart stock went up a lot because that meant people didn't have money to spend, so they had to shop at Walmart. And the way that the company, the way the stock fits into the macro narrative is very interesting because this year it kind of became, a good old-fashioned, hey, consumers doing well, you can buy Target and Amazon and Apple and Walmart, and they all mean good things. It's not, I remember the dollar stores, right? We're kind of that counter indicator for a little while. So interesting part of how they fit into the macro story that the stock market tries to tell. All right, Brian Sozzi, happy freaking New Year,
Happy
man.
New Year. It's been a pleasure doing this all year long. I really like your sweater and enjoy your
Thanks,
White
bro.
Claws.
Yeah.
Really nice sweater.
I will enjoy a few White Claws tonight. Have a great New Year. We'll see you back here.
Jared,
You're back.
Happy New Year.
You too.
You're back on Thursday, so
ready to roll.
yeah, right.
I'm here tomorrow.
Not going anywhere.
Yeah.
Don't be here tomorrow.
Okay.
Please
Not
don't be
leaving.
here tomorrow. All right, coming up here on the final round today, Riverfront's chief strategist Chris Constantinos joins us to talk about how his firm is deploying its $8 billion in assets under management as we head into a new year. But first, take a look at where big financials are trading right now. 37 minutes to go in the session. All right, 35 minutes away from the final closing bell of the year. What does 2020 have in store for investors? Chris Constantinos is the Chief Investment Strategist and Director of International Equity at Riverfront Investment Group. He joins us now to discuss. So, Chris, you guys are starting 2020 a little bit overweight stocks. What do you like here and why that allocation?
Yeah, sure. And Happy New Year to everybody, and thanks for having me. If you look at the setup for 2020, I think the knee-jerk reaction for any of us that have been involved in this craziness that has been stock markets over the past 20 years is we just had a great year, so bad things must be on the horizon, right? We're all sort of still shell-shocked from two of the worst bear markets in history over the last 20 years. But if you actually look at the historical data, history's on your side for 2020. First, it's an election year, which tends to be better than average returns in the market if you look back over the last century. You also have technical analysis on your side. Momentum in the market tends to beget more momentum. There is that historical momentum effect. And by the way, the breadth of the market is also improving. If you look globally, that technical momentum is improving in a lot of areas outside the United States, which I think speaks well for the global recovery. You have a year, which is kind of astounding to me. 2019 was the year of negative equity net fund flows. If you think back to the late 90s, and you think about how big stock net inflows were, that gives you kind of a window into the level of complacency and exuberance, if you will, of that era. You're not seeing that today. You're seeing huge flows into bonds over the last decade and over the last 12 months, frankly, and outflows out of stocks, which is astounding to me in a 30% plus S&P year. And then you have dividend yields above the level of 10-year government bonds in all the important parts, the major parts of the world. I think that all bodes pretty well for stock returns in 2020.
Jared Blickry here, and I agree with your analysis, but I got to be a contrarian here. How does your bullish case, which seems to be the base case here, how does that fall apart? What comes out of left field? Anything on your horizon?
Sure. Well, there's always uncertainties. This is why there is an equity risk premium in the first place for us to harvest. The big uncertainties to me, certainly trade, and I don't think I'm alone in this. Trade is a major X factor. The relationship between the world's largest and second largest economies matters for everywhere, everyone, everything. I would say that both U.S. and China, I think it's in both of their best interests to put trade, to take it from page A1 of the journal to B7 is in both countries' best interest for 2020. And I think we're seeing signs that that's happening. I'm not saying the trade war is over. I'm not saying that these two ideological polar opposites have somehow, reconciled all that in 2020. But I do think that it's in both parties' best interest to at least have a ceasefire, if you will. And I think we're in the early stages of that happening. The other big X factor, I think, has to do with European political uncertainty. And this is something we've been dealing with, frankly, for much of the past decade, right? Probably starting in 2011. And it's still there. I mean, I think if you look at Brexit in the UK, I think the probabilities of major left tail risk there have decreased significantly, particularly with the Conservative victory last month. But there's still some tail risks that Brexit goes off the rails. You still have a caretaker government in Italy. You have Spain. The political situation is still very fractious there. Germany, somewhat uncertain. So, I think political tail risk is still going to be with us in 2020 and might lead to some buying opportunities as we move throughout the year as well.
All right, and Chris, just thinking about areas you can put your money to work, what do you like right now? What's attractive at these levels as you look to put money to work in the new year?
Yeah, sure. So starting with the U.S., where we do a lot of sector work, we're still bullish on technology. And I know I've appeared on this program before talking about tech, but I want to be really clear. There's areas of tech, and it's the boring, unsexy tech that people don't really like to talk about. But there's companies that trade at or below market multiples that throw off tons of free cash flow, increasingly in this day and age pay growing dividends. Those are the types of profiles of companies we like. They're not necessarily the sexiest tech companies, but you look in the software and services space, you'll find a lot of them. We think that's one durable theme. We think that theme can work whether it's a growth-oriented market or a value-oriented market in 2020. There's certain parts of healthcare, talking about contrarian stuff. Obviously, the healthcare space in general is on edge given the 2020 presidential election in the U.S. We think healthcare is priced for an adverse outcome in the 2020 elections. So should you get something different than that, we think healthcare, there's significant upside in places like medical devices. In general, companies that throw off cash and pay their shareholders back in dividends and do so in a consistent fashion, I still think that's going to be in style in 2020. I think that's a durable theme, regardless of the backdrop. And also logistics companies. There's some very interesting logistics plays, particularly some of the consumer-oriented ones. So that's where we're looking at in the U.S. Overseas, this is a bigger X factor here, given the fact that their economic backdrop outside the U.S. is a little bit more uncertain, but we still like Japan as a highly contrarian place for risk-tolerant investors to put their money. And emerging markets, we're neutral there, but should the global backdrop trend more towards our bull case moving through 2020, you'll likely, that's a place where you could see significant upside.
All right, Chris Constantinos with Riverfront Investment Group. Have a great new year. We'll talk to you in 2020.
Thanks, you too.
All right, coming up here in the final round, we'll have more. Plus, the Indian Navy is banning Facebook and smartphones for service members. Dan Howley will tell us why coming up. right after the break. Welcome back to the final round here on Yahoo Finance. Miles with them with you in New York. I'm joined today by Yahoo Finance's Jared Blickery. Let's take a look at where we stand right now. 26 minutes to go in the trading year. We've got all three majors moving back into the green. I think a fitting end, Jared, to this year where stocks always go up. Finding a way to move from a mixed market to a green finish, see where we shake out. But for more on today's market action, let's go to Scott Gamm. He is live on the floor of the New York Stock Exchange. Scott.
Yeah, well, Miles, 26 minutes to go in the trading decade as well. And hey, by the way, 10 years ago in early 2010, the Dow Jones Industrial Average was trading at about 10,500. Now we are, getting close to 29,000. That's a 175% increase over those 10 years. Of course, back in 2010, we were still kind of reeling from the 2008-2009 financial crisis. And it's not just stocks that have had quite a move over the past decade. Bonds, too. Take a look at the 10-year Treasury yield, now trading at about 1.9%. But 10 years ago, in early 2010, the 10-year yield was at about 3.8%. And it certainly has bounced around over the past couple of years and over the past decade, because it was just 13 months ago when we last saw the 10-year yield north of 3%. And then finally, oil prices about a decade ago were trading just shy of $80 a barrel, at least for West Texas Intermediate. And now it's a big deal if oil prices can stay above $60 a barrel, and they have been able to do that over the past couple of weeks. But certainly the U.S. shale revolution has really taken shape over the past decade, with the U.S. flooding the market with oil, which has pushed down prices, Miles.
All right, Scott Gamm, we'll talk to you after the closing bell. All right, time now for today's Tech Howl with Dan Howley. The Indian Navy has banned the use of Facebook after 7 naval personnel were allegedly caught leaking sensitive information to Pakistani intelligence agencies in a honey trap. Now, the Indian Navy has also banned smartphones at naval bases, dockyards, and onboard warships. I guess, Howley, this now means that part of your military training needs to be how to not get honey trapped.
Yeah, they got
potted. Yeah,
they got good. These 7 sailors, they were busted in this honey trap operation, and essentially they ended up giving away sensitive information.
So I guess we should define honey trap before we go.
Yeah, they were basically suckered in by people posing as women on Facebook.
By the Pakistani intelligence agency.
By Pakistani intelligence, which is not, for India, particularly egregious. And so they ended up giving away sensitive data on the Navy. And this has been an issue that's reared its head before in the Indian Navy, where positions of warships were given out, patrolling patterns were given out, things along those lines. So this is an ongoing issue. So what they're saying now is, if you're in the Navy and you have Facebook, delete your account. Don't bring your smartphone on warships. Don't tell people where you are if you're on a warship. Don't give away locations of our.
You're in the military.
bases.
You're supposed to play it
Don't
cool.
Venmo people or strangers money.
Yes,
which
exactly,
is a
yeah.
thing nowadays, which I can't believe.
Yeah, I don't understand that. Yeah, well, it's the new Prince, where you get someone sends you a Venmo and says, oh, you know, I'm trapped in, I don't know, some part of the world and I need help.
Yeah.
Venmo me $1,000 or something like that. But this is actually interesting because, you know, we look at it and we go, well, that's just dumb. Why did these people do this? They got caught in a honey trap, so obviously they didn't want to do it. They're arrested on espionage charges now, though. But this is something that's happened before to a different degree when the Stravia app was used.
I remember that.
Yeah, so there were a couple of soldiers, not a couple, a good number.
Many.
Yeah, around the world in secret U.S. bases who were working out, and the Stravia app marked their location, and then you can share that online, and it happened to be shared online. And these tracks kept showing up in places where there shouldn't be U.S. military, but there was, and they ended up getting busted, having the bases there. So it's interesting how consumer technology is really kind of becoming a hindrance to military personnel and military operations by just straight up giving away locations.
Well, and I think it speaks to how little, how ill-prepared I think militaries and governments are to deal with what consumer tech really does. Because remember, if you're in the military, yes, that's your, you know, you have specific status kind of within society and all that. But I mean, these guys have leave, right? You have downtime. Just because you're stationed on a base doesn't mean 24/7 you're only doing military stuff. They want to like go out and like be on their phone like a normal person during the hours when they have liberty or leave or whatever you want to call it. And those risks, I think, are just being completely discounted by the government and obviously by the militaries themselves.
Yeah.
Because this isn't just an India problem, right? We've seen this in the U.S., as you mentioned, with Stravia and TikTok and all that stuff.
The New York Times just did a big expose, big investigation into location tracking, and lots of companies with lots of apps have access to tons of information. And this is probably the biggest one that I've seen. And they tracked people who were going, these are contractors going in and out of the Pentagon.
Yeah.
And
They track the president.
Yeah. I mean, it's interesting. And it's you're right the way you put it, that you're in the military, you have a certain standing in society. People don't think you go home and play video games or something. They think that you're constantly a soldier. But it turns out military people, men and women, are just normal people too, and they're going to use Tinder or any social media app out there. And unfortunately, this is the consequence of it. The proliferation of consumer goods into the military sphere has been kind of a thorn in their side. And I think it's going to continue to be, and we'll probably see more issues like this in the future. But I mean, this in particular is pretty bad.
It's pretty hilarious, I gotta be
I mean,
honest.
yeah, getting busted like that in a honey trap through Facebook. I mean, and it's, India and Pakistan obviously don't have the best relationship. So the fact that it's Pakistani intelligence getting
cross-border honey trap.
Yes, exactly. Yeah. It was very bad. China, by the way, tries to get in on India's military as well. So it's a whole other.
They need a better honey trap or mouse trap.
Yes.
Well,
Bug trap. Honey trap?
Honey trap is fine.
Yeah. I like
classic catfishing, whatever you want to call it.
There it is,
Stuff
catfishing.
that.
I like that better.
All right, Dan Howley, have a great new year.
Thank you. You too.
All right, coming up here on the final round, we'll have today's winners and losers in the stock market. But first, check out how big tech is trading right now. 20 minutes to go in the year. take a look at some of the stocks we're watching in today's market. NVIDIA, good old-fashioned Yahoo Finance favorite here, moving slightly higher. Analysts over at Benchmark upgrading the stock to buy, raising their price target to $275 per share, indicating about a 17% upside from Monday's close. Also taking a look at shares of Boeing after the company reached a deal with Turkish Airlines to compensate for losses caused by the grounding of the 737 MAX jet. Also, shares of McDermott International tumbling today as investors brace for a bankruptcy filing that was originally reported by the Wall Street Journal yesterday. Jared talking about those energy bankruptcies.
Oh yeah, they're coming.
They are coming.
Lots of them.
They've happened. They kind of went away. 2016 was a big year for it. We sort of forgot about it. Everything was fine. Stocks went up 1 million points. And now, possibly a story into the early part of next year, even with rates this slow. Coming up here on the final round with the market near all-time highs, one strategist tells us why you need to keep an eye on one thing, and that is companies with high free cash flows. But first, take a look at how some of 2019's big IPO names are faring in today's market. We're heading into the final closing bell of the year. Been quite a year for markets. Joining us now to discuss where we could be headed in 2020 is Janet Johnston, portfolio manager at Trim Tabs Asset Management. So, Janet, I guess before we get to where we could be headed next year, what do you make of what we've seen over the last couple of months of 2019?
This has been a fabulous Santa Claus rally. It was fueled off of the fact that last year, I think, a bell rang and people realized we're not in a recession. There's no profits recession. There was extreme pessimism, very high levels of cash. And in some ways, the investor sentiment is opposite of what it was last year, going into 2020.
And I guess when you look at that, though, we've still seen, we were talking with the guest earlier, net equity outflows so far this year, right? It still seems like there's some caution in the market. Does that to you still indicate that this is a healthy market? Because it's not like people, are diving in with everything they've got to try to chase stocks here.
I think it is a healthy market. I would not be surprised if we didn't see a consolidation or a correction sometimes during the first quarter. The market is very oversold. We see sentiment levels that indicate there should be a correction, and that would be helpful for the market to consolidate, digest this big move. But over the long term, the fundamentals continue to be strong.
I'm wondering about fund flows. I read that going back to 1996, about 1/3 of portfolio allocations now occur in January. Does that affect stocks overall? Is there going to be some kind of rotation under the hood? What are you looking to expect here, and what happens historically?
It's very hard to tell. I think in the past, the January effect has had to do with tax law selling in the fourth quarter, and then those stocks are beaten down and people step in and buy them. They tend to be smaller, mid-cap names. We didn't have that this year. So I'm not sure that we're going to get your typical January effect.
So then when it comes to looking ahead to next year, we've got a decent fundamental backdrop for the economy. You say we're likely not headed into recession. What are the things that you're going to be looking for a sense of what the market is reacting to, right? 2019, it became very clear. It was all about the Fed. Anything the Fed did, the market was going to react. Are there things that you are looking at that might be signifiers of how this market will trade in the new year?
Well, I think going into the year, the Fed is accommodative. I think fiscal policy globally, generally speaking, is accommodative. I think we're going to be looking to see if there's a global pickup in manufacturing. That will sort of indicate whether portfolios should be more positioned towards companies that are levered to an economic increase in the global economy, or if it's going to be just kind of a low growth, steady Eddie type environment. We do think fourth quarter looks to be trough earnings. I am going to be paying particular attention to, we know that companies can manipulate earnings. So when I hear things like Uber is going to be profitable on an adjusted basis, I'm a little bit skeptical. We use free cash flow as a reality check to make sure that there really are underlying profits.
I think we'll all learn a lot about the difference between corporate profits and earnings per share in the year ahead. There's been quite a divergence there. All right, Janet Johnston is a portfolio manager at Trim Tabs Asset Management. Have a great new year. Thanks for joining us.
Great. Thank you so much.
And coming up here on the final round, we will have the last closing bell of the year in about 10 minutes. But first, we are going to get technical with Jared Blickery over at the Wi-Fi Interactive Touchscreen. We are back with that right after this. 7 minutes to go in the year, stocks turning green. A fitting way, I think, Jared, to celebrate the end of 2019.
Yeah, nail biter here. I thought we were going to end in the red. You can't do that on the last
Can't do that,
day.
not in 2019.
Even with negative seasonality on the last day, which turns into positive seasonality in 2 days. So lots of tailwinds here going into the next decade. Dow is up 37 points, S&P 500 up 15 basis points, NASDAQ up about the same amount. Russell 2000 here, look at this, pulling it out. And it was in the red. It was underperforming towards the morning, but guess what? The yield curve is expanding. Yields are heading higher. I think the 2-year 10-year is about 35 basis points now. It's about the highest that we've had in 14 months. So let's take a look at the Russell 2000, a 1-year chart. It's going to be the same as a year to date. And we see it finally broke up towards the end of the year, concurrent with that expansion of the yield curve. Good for biotech. Biotech is up about 20% this quarter, and financials also outperforming.
This really is the toughest time of year when the year to dates turns to the 1 years, and then starting on Thursday, year to date is meaningless.
It's going to be today.
Yeah, that's tough. All right, let's take a look at the VIX. Yesterday we saw a pop in the VIX earlier in the session, back towards 14 today, and you mentioned that maybe yesterday was sort of your chance to buy the dip, even though we were down like 30 basis points. At least today doesn't look like such a bad call.
No, and not only that, it was I was waiting for it to get to 16 and a half. Still hasn't done that. Got to about 15 today, but it's based on this trend line that I've been watching for a very long time that's worked so well in the past. All you got to do is buy stocks when it comes up to meet that trend line. So it worked here, for instance, here a little bit, and trying to work here. I would say today is probably the low going into the first part of next year. We do have a lot of bullish seasonality, as I said, for Thursday and Friday. Then it's kind of up in the air. It depends on what the market wants to do, but not expecting any repo problems at least.
Yeah, how about that? Repocalypse has come and gone with no issues. Let's take a quick look at the 10-year. Obviously, big story of this year has been the journey, really, that we've seen the 10-year take. We opened, I think, 2.5 maybe, or was it a 3 handle on the 10-year at the outset of the year?
2.65%, but just before that, in December, it was north of 3.
When the Fed raised rates for the 4th time in 2018. What a world that was.
Yes.
And I remember talking in this area, right, kind of August, September, that we were destined to retouch those record lows, 137 back from July of 2013 or 2015, I believe.
Yeah.
Never got there, but we have seen certainly quite a run in the 10-year.
Yeah, we got close, and some people were saying we'd overshoot and maybe get all the way to under 1% on the 10-year. Of course, that didn't happen, but if we look at a slightly lower time frame here, a 6-month chart, we can see this is a big consolidation, and it's going to be interesting to see which way rates break in the new year. If we get this continuation of an expansion of the yield curve, this continued rotation then into values and cyclicals, all of that will go together with higher yields. How high can it go? That's going to be the big question of the year.
All right, one last time, for old time's sake, let's look at Bitcoin. Because, all right, it's fine. Bitcoin not have been an exciting year, but it has doubled, more than doubled so far this year.
Yeah, well, the thing is, it had been up something like 250%.
It's doubled, 90%.
That part right there. Yep. Now we've given back a lot of ground here, and I was saying, some of my Bitcoin timers are saying this is the time to get in, but a little bit of caution. We still haven't broken this downtrend line. Yeah. And here's another case where you have this long consolidation. Whatever way it breaks, it's probably going to have a lot of upside or downside. And I think we do got to show the NASDAQ 100 year-to-date heat map, because this is a company favorite here. And we're just going to show this. Who was the big winners and losers? In the NASDAQ 100, it's AMD. We can see all the big guys over here, nice gains, but if we sort by market performance, that's the Dow. So we're going to look at the Dow instead of the NASDAQ. But Apple up 86%, Microsoft 55%, only a few in the red here. Walgreens, Pfizer, and 3M.
Visa, every hedge fund's favorite stock, up 40% this year. All right, Jared Blickreed, Wi-Fi Interactive Touchscreen for the last time in 2019. Thanks for joining us. Coming up here in the closing bell, we will have we'll have the last closing bell of the year, and we'll have Morgan Stanley getting bullish on Walmart in our final round call of the day. We're back with that right after this. and welcome back to the final round here on Yahoo Finance. These are live pictures from the New York Stock Exchange and the NASDAQ market site for the final time this decade. There it is, the last closing bell of one of the most interesting, consequential, and eventful decades we have seen in market history.
In at least a decade.
Certainly an amazing year for stocks. 2019, the best year for the major averages since 2013. That's it. And of course here, New Year's Eve in New York. That is midnight in Moscow. New Year's Eve, of course, breaking out around the world. We were with the folks over in Dubai at the 3 p.m. hour. Now Moscow is celebrating its New Year.
We're with the folks in North Korea in the 10 a.m. hour.
Interesting choice.
I know, right?
That's what's happening once in an hour.
Yep. So from Kim Jong-un to Vladimir Putin, we cover all the bases here on Yahoo Finance.
Happy New Year, guys.
That's great fireworks.
Record close.
Now, the Burj Khalifa. Boy, you missed it at 3 o'clock though. The Burj Khalifa was lit. Yeah,
that's an event.
That's a real party. It's funny. Like Times Square, it's all fine and all that, but these look better, right? There's more space. There's more sky.
Greener.
There's more sky in Moscow. It's in the middle of a plain. So, all right. Here's live pictures of Times Square filling in.
No grass there either.
Jared, this would have been, I guess we are looking basically from the corner where our office was, right? I think that Old Navy was on the east side of 7th Avenue, if I remember correctly. And then we were just over on 43rd. Yeah, 43rd.
How did you guys ever escape after working on New Year's Eve?
You know, it's fun. Back when our office was over there, New Year's Eve day was a company holiday, so we didn't work. And now we do 2 hours of live streaming coverage of the stock market all the way until 5 p.m. on New Year's Eve day. This is Heidi Chung. That's Jared Blickery. I'm Miles Upton. Welcome back to the final round here. So let's take a quick look where the majors finished during today's trading session. All three finished higher. Jared, I think a fitting end to what's been a year where stocks go up every day because those are the rules in 2019. No debating that. We're not going to finish at record levels here, but
Apple and JP Morgan did.
Apple and JP Morgan did, and the only thing that matters is that Apple goes up 105% every year from now until the end of time.
And at the end of the decade, who would have thought 10 years ago that JP Morgan would be making record highs after sinking so far in 2008 and 2009?
And I think JP Morgan friends over at Citi and Bank of America would like to have those record highs as well. Those stocks have not recovered from the levels they hit ahead of the crisis. But we're talking financials, we're talking real stocks. We would be remiss if we did not mention the decade in crypto, specifically Bitcoin. This is sort of like a fake number, but it's true. It's fine. We'll have to go with it. 9 million % increase since July 2010. That's according to data compiled by Bloomberg. Back in 2017, Bitcoin hit $20,000 per coin, settled around 7,000 today, but the market never closes, so it hasn't settled. It was at 7,000 when Jared and I were discussing.
Can't IPO either, but there is a first trade. I think it was like 5 or 6 cents.
It's been interesting because Bitcoin it's real. Like, it's now real. It's a real part of
physical features.
I think institutional investors look at it as the right kind of investor wants to have it in their portfolio in the way they want to have gold. The ICO market is a different conversation, what's happening with Ripple and Ether, but I think it's real, Heidi.
Okay, so my question is, when it was first created in 2008, right?
For buying drugs and
as a white paper.
Right, so it was supposed to replace fiat currency, it was supposed to replace the US dollar. So that's not the case right now. It's essentially a digital gold, right?
It's diversified.
So it's where you put money in and you let it sit like gold. And so the argument has long been, what's the use case for Bitcoin along with the rest of the altcoins and the other cryptocurrencies in the space?
But getting rich.
Yeah, to get rich in an uncorrelated way.
Okay, so one of Bitcoin's Wall Street bulls has long made the argument that there are two major catalysts for Bitcoin, right? The first being that institutional investors need to show it love. It needs wide institutional adoption in order for it to be legit. The second was, so this bull specifically said this back in September of this year, that if we see equity markets rally to record highs, Bitcoin will sort of follow suit. Now, equity markets near record highs, hit those record highs, but Bitcoin has had a good year, but it's not anywhere near those 20,000 level that we saw at the end of 2017. So I don't know, it seems range-bound to me, Jared, you tell me, from a technical standpoint.
Well, it's actually in a downtrend right now.
Bear flagging, Heidi.
But, I did say uncorrelated a few times, right? Yeah. So there you go. So wait till stocks go down, then Bitcoin can go back up to 14,000. We'll see. I think backed too. I'll explain that because a lot of people know what it is. But that's the futures. Yeah, BAKKT, sponsored by ICE, parent company of the New York Stock Exchange. Microsoft also a partner. Starbucks also a partner. Now they launched physical futures. So these are futures in Bitcoin that don't settle in cash, but they have a custody solution. So they went to a lot of effort. They had to register as a custody agent with the state of New York, took a lot of back and forth with the SEC. This does pave the way for an eventual Bitcoin ETF, which I think is kind of the holy grail, because you can't have a bubble unless retail participates.
Yeah.
And they really couldn't do that in a big way in 2017 because they just didn't have the operational infrastructure.
Yes, but I mean, I think if you look at kind of what happened with the average Coinbase wallet, I mean, millions and millions of wallets are being made in summer, fall 2017. I think like retail participated enough, because obviously there was a bubble in Bitcoin that only lasted maybe a couple of months, like a really aggressive bubble, but I think retail had enough participation there.
Well,
I remember the crew on the show talking about buying Ripple at, whatever. Yeah. Like sitting here, should I buy it at 93 cents?
But
well, now it's 20.
The problem at the time was the actual market for Bitcoin, the transactions were taking forever to clear. It was costing $20 to $100, which is just ridiculous, instead of pennies. And so that bubble could have had a lot more fuel. It just didn't have the chance to get off the ground because they didn't have the institutional infrastructure, which is now getting in place right now.
Yeah.
So I think there will be another bubble.
Yeah.
And it will go farther and further.
What about Libra, though? Is that going to happen, you guys think?
No, too much.
Especially in 2020?
It's possible, but look at the headwinds they face. Right. Facebook is going to be lucky if they can survive just getting taxed.
Right. I mean, they're trying to be Facebook, Instagram, and WhatsApp without being broken up, let alone try to
launch their own currency.
But it'll be interesting to kind of, in 2010, we wouldn't have wrapped up the decade by saying, I bet you Bitcoin will be the big thing in the next decade. So
I don't think that was on anybody's.
Well, which I guess actually sort of answers the question. It can't be Libra, since we know that it could be, because then it can't be a black swan if everyone knows it's going to happen.
Yeah.
Anyway, for more on today's market action, let's go to Scott Gam on the floor of the New York Stock Exchange. Scott.
Well, the Dow closing with a nice gain of 76 points, helping to eat away at the decline we saw yesterday. A nice New Year's Eve rally today, especially since the Dow was in the red for most of the trading session. Top performing Dow stocks today, names like IBM, Cisco, Dow Inc., and Apple hitting a record high today. The stock is now well above $290 a share and has clocked an 86% gain for 2019. Pretty incredible. The laggards in the Dow for today's session: Walmart, Boeing, United Technologies, and Merck. By the way, Boeing was able to stay in the green for 2019 by just under 1%. The stock stayed above $322.50 a share. That was the closing price from a year ago today. So if it had fallen below that level today, it would have been in the red for the year. But pretty stable for Boeing considering all the issues the company has had this year. And then for the decade, of course, Netflix, best stock of the decade, up something like 4,000% over the past 10 years. This year, though, for 2019, really underperforming the broader market. Netflix had a gain of about 21%, which is impressive, but underperforming the broader market by as many as 9 percentage points. And that really speaks to the first mover advantage that Netflix was lucky enough to enjoy for most of the decade when it comes to streaming, just because it was really this year that Wall Street woke up and realized that there's going to be more competitors in the streaming space, most notably Disney and even Amazon too, although Amazon stock over the past decade is up only 1,200%, guys.
All right, Scott Gam, have a very happy new year. We will talk to you on Thursday.
You bet, you too.
All right, time now for our final round call of the day. Today we are talking about Morgan Stanley's latest on Walmart, the firm coming out with just a few cosmetic tweaks, may we say, to their model here as we enter the new year. The firm raising its price target on the stock by $5 up to $130 a share. That's from $125. Morgan Stanley does the nice, cool thing where they outline their bull, base, bear case on a lot of stocks. This is where we get the Adam Jonas $10 Tesla kind of thing from this exercise. Their bull case, $180 a share. That's up $15 from where the firm had it previously. Their base case, however, is that $130 $30 price target. They are overweight rated on shares of Walmart. Now, Heidi, looking at Walmart, the year that they've had, I think in many ways, been a solid year, been a fine year. Their e-commerce business is okay. They've struggled with some of those individual brands. The Jet.com integration has had some of its challenges. We've seen the Jet Black project kind of die. Bonobos is apparently on the sale block, overshadowed to some extent by Target.
Where are you going to get your pants?
You're asking me. But you know, I think pretty solid year here for Walmart amid a strong consumer environment.
Strong year for Walmart. I think one of the things that we should be focusing on as we head into the new year, though, is the grocery business. So management noting that on the most recent earnings call that they actually need to focus on selling more general merchandise because the margins are better on those items. And with the push that we are seeing into same-day delivery, I think Walmart is going to be one of those adapters that adapts pretty quickly to when Amazon releases their own strategy, right? But let's also look at the past decade in retail, because it all started out with, oh, brick and mortar is dead. Retail is not going to be able to stand up to the behemoth that is Amazon. But look at the latter half of the decade. The fact is, a lot of these direct-to-consumer, a lot of these e-commerce companies have realized the value of brick and mortar and having a physical footprint. You use that as a fulfillment center. You're able to use that as a place to collect returns. You know, Amazon had to eventually partner with Kohl's. Amazon realized that it needs Whole Foods, it needs other physical retail locations in order to sort of thrive in an environment where Walmart already has that huge brick and mortar presence. So I think we're seeing smaller DTC companies like Casper Mattresses, whether it be, you know, one of those other small, I can't even think of the names right now, I'm blinking, but yeah, all the smaller companies that said we don't
all the
need
things in the subway.
Right. So the ones that said we don't need brick and mortar, they're like, now we need brick and mortar. So it's been a really, really fun decade, I think, for retail.
It has.
My favorite phrase that came about in the kind of the latter part of the decade, maybe only in the last few years, multi-channel.
That's right.
Yeah, multi-channel.
Omnichannel.
Well,
Omnichannel.
it kind of morphed from. Was Omni first or was Multi first?
I think Multi was first.
Multi was first, now it's become Omni.
You have to be Omni now.
Yeah, everyone has to be
so
Omni.
Walmart's doing good with that Omni thing.
And just looking at the final year-to-date performance for Walmart here, up 27.3%. That's on a price basis. Their dividend yield is 1.8%. So let's call it 29% up for the year for Walmart. The S&P up 28.7%. That's not including the dividend, though, so I guess just a slight lag.
Not too many gains in the last few months.
There you go. Did outperform the Dow by about 5 percentage points. All right, Jared Blickery, have a great new year. We will see you in 2020. And coming up here on the final round today, it's a Chung versus Chung food fight. Which one of our resident food experts has the better palate? We will find out. But first, let's take a look at where the restaurant stocks finished on this final trading day of 2019. has seen many food trends come and go, and our very own Heidi Chung has been on the front lines of it all. Let's see what she learned in Yahoo Finance's first annual food fight.
This is Yahoo Finance 2019 Food Fight. I'm Heidi Chung. I'm a reporter covering the food and restaurant industry. So some of the hottest food trends of 2019, we have the rise of spiked seltzer, chicken sandwich wars of the summer, and the plant-based meat craze.
I feel like you should know which one each is, right? Even if you're blindfolded.
Should we go through the different categories and try it out and see who wins?
Okay, so you're the expert though. I'm the Fed guy. I usually cover the Fed, but today I guess I'm getting fed, but we'll give it a shot. We'll see, was that bad? Here we go. So we each pick one at the same time.
You know how I can tell, Brian, the scent?
Yeah.
Because one of the buns is buttered and it's a brioche bun. Yeah, you can definitely tell.
Okay, and which one is that?
Okay, based on scent, the left is the Popeyes chicken sandwich, the right is Chick-fil-A.
See, the thing is, I gotta compare because it tastes like chicken. It is a chicken sandwich of some variety.
Time out. This one right here that I am eating is the Chick-fil-A one. I put $10 on it, Brian. So if I'm wrong.
Yep.
All right.
Okay. Okay. And I also agree. I think this is the Popeyes one.
Our left is Popeyes and our right is Chick-fil-A.
They were right.
Are we?
Nice. Okay, here we go. Here we go. I don't think smell's gonna do anything in this case. Am I just putting my hands in sauce now?
Uh-huh.
Okay,
Oh my
I lost
goodness.
the patty. Oh, I found it. Okay.
Where is
I found the patty.
Wow.
This is tough. This is tough.
I have no idea.
I think the drier one, which is the left one, is impossible because I think the Beyond Meat patty has a little more juice when I remembered it. So that's my final answer. Right is Beyond Meat. Left is impossible.
I'm gonna say the left is Beyond and the right is Impossible.
And why is that?
The difference between the Beyond and the Impossible is what the main ingredient is. So for the Beyond Meat patty, it's pea protein isolate. And for the Impossible Whopper, the reason why it bleeds like a real burger is because of the heme. To me, the Beyond Meat actually has slight of an irony aftertaste. And I'm getting a little bit of that. Now, if I am completely off base here, this is like absolutely terrible because I sound so certain.
Beyond is on the left.
Oh my God! The rise of hard seltzer has been epic. I mean, I don't want to call you out, Brian, but I know your summer parties all involved hard seltzer.
Yeah, this is the one I'm excited for.
And I know you have a personal favorite. Which one is it?
I'm Team White Claw all the way.
Okay, so do you think you can tell the difference between a White Claw and a Truly, even if they're the same flavor?
Yeah, you no doubt about it.
I would
Okay,
cheers
here we
you,
go.
but I can't see.
Yeah,
so.
just spill it all over each other.
Cheers.
Cheers. This one's a little metally.
It's in a metal can.
They're both cold, so that's good. Nothing's worse than a warm claw.
Okay, you all ready for the left?
All right, let's do the left. Okay.
Ooh.
Ooh.
Do you agree this one
Ooh,
tastes
I
better?
don't like, no.
Really?
No, absolutely not. This one is definitely the Truly, and then this one is definitely the White Claw. I think this one, the one on the left, is more sugary.
Sorry, I've just been sipping nonstop.
I was gonna say, I gotta taste this one again.
I think I have to agree with you. I think the right one has a more subtle raspberry
It's not
flavor.
as sweet, which is what I like. I'm gonna say 95% confidence interval. This one is the White Claw. Okay, ready?
3, 2, 1. Oh my
gosh! No! Oh!
Did you even drink it over the summer?
Oh.
Okay.
My
so that
spiked
was
seltzer license has been
absolute-
revoked.
Well, my thanks to my fellow Chung Brian. Thank you so much for doing this with me. I mean, 2019 has been so fun, so many hot food trends of the year, and I'm so excited to see what 2020 holds for us. But on that note, should we cheers?
Let's cheers.
This is
The Truly,
to-
which is my new favorite.
This is to 2020.
Cheers to 2020.
Is there anything better than seeing someone declare their certainty within a 95% confidence interval and then get it wrong?
So
Absolutely
wrong.
nothing better than that.
Did you hear him? He was like, it's kind of metally. Well, Brian, it's in a metal can. That being said, Brian was such a good sport about this. In that video, he was like, oh, I usually cover the Fed, but today I guess I'm getting fed. So it was a lot of fun. I hope.
Oh my God.
We miss you, Brian.
So he doesn't know what White Claw is and he can't make jokes.
Yeah, I mean, he was 95% confident that the Truly was White Claw. But it's been a really fun year in the food space, and I hope 2020 is also as fun.
I've been thinking about that. Like, I know that we all cover it a lot because they're consumer names and they're fun stories, but it has actually been an interesting year in the food space.
Yeah,
right?
because-
like this was more interesting than say 2017.
Right, because there's so much competition right now to get customers into the door that the innovation has really ramped up, right? So we're seeing new product launches from Taco Bell, from Pizza Pizza Hut, partnerships with different plant-based meat companies in order to sort of pique interest. And I think the rise of social media has sort of been a major player in that, as we saw with the chicken sandwich wars. But I really, fingers crossed, that I have a lot to cover in 2020. First of many food fights. So, but yeah, it was a lot of fun.
On the one hand, I want to be a part of one. On the other hand, I don't.
Yes, you do. It's what the cool kids do.
Well, yeah. I gotta say, it's funny. The longer I'm here, the more I'm not a Yahoo Finance cool kid. I'll tell you that. You guys are like,
I have nothing to say.
You guys
to
are
that.
out doing stuff. Based on your receipts this year, what was your preferred fast food of the year?
I would have to say Popeyes.
That's where you were eating the most?
Yeah, I don't even know how many Popeyes chicken sandwiches I've had.
That's lit.
And I usually go to Taco Bell the most.
I was gonna say, I smashed Taco
but McDonald's as well. When I did my Grubhub year-end review, the 10-piece McNugget meal was my most ordered food item from
Lit.
Seamless.
Love that. Love that. I don't want to look at that, but I have a suspicion what it is. All right, coming up here, we'll have today's Sector Watch. That's coming up on the final round right after a short break. Let's take a look at today's sector winners and losers. Only one sector in the red, industrials XLI, down actually less than 0.1% here. Lockheed Martin, Boeing, and Deere weighing on industrials there. Looking at sectors in the green today, energy up about 0.5 rather of 1%. Contra Resources, Devon Energy, and Diamondback doing a lot of the work there. Diamondback, best ticker in the market. FANG, not a tech stock. Tech sector, XLK, up about 0.3%. Western Digital, NVIDIA, and shares of Cisco leading the way there. Best performing sector on the S&P today, real estate, XLRE up 0.76%. All right, well, coming up here on the final round, we'll have what we're watching on Thursday in the new year. Plus, we have our final round New Year's resolutions. We'll find out what I may or may not do differently in 2020. We've got that right after a break. All right, now here's a look at some of the stories that are going to be making headlines on Thursday. Well, on Wednesday, a new year begins, and while Wall Street always has lots of predictions for the upcoming year, there is one this year that stands out as particularly notable. There will be no recession in 2020, according to pretty much every Wall Street economist. Low rates, an attentive Fed, and a lack of major financial imbalances are among the reasons cited for why a recession is unlikely. Meanwhile, the consumer sector remains in good shape. The trade war appears to be cooling off, and the stock market has gotten quite excited about the idea that we are beginning a new leg of this post-crisis bull market. This, of course, stands in stark contrast to the prevailing mood in the middle of 2019. The yield curve had inverted, Europe's economy was stuck in the mud, and the U.S. appeared on the brink of rolling over, while manufacturing activity slid to a 10-year low. Recession calls then were popular, rampant, and actually backed by market history. All of these calls, of course, turned out to be wrong. Now, this newfound certainty that the worst of this little mini cycle is behind us comes as the most obvious risk of the last few years finally faces markets. That, of course, is the U.S. presidential election in November. But as the calendar turns to a new year and a new decade, investors seem confident that the thing they've come to fear the most won't come to pass in 2020. Now, turning to the calendar for Thursday, on the economic data side, we'll get the weekly report on initial jobless claims, the final reading on manufacturing activity in December from IHS Markit, and then on the earnings side, no major companies are expected to report their results. All right, it's that time of year again when we say how much we're going to change in the new year, and then, of course, never follow through, or follow through like President's Day, something like that. New Year's resolutions have been a tradition for over 4,000 years since the ancient Babylonians started them to appease their gods. You'd think that with that much time, we would get better at sticking with our resolutions. Heidi, one, do you make resolutions and stick to them? Are you a resolutions kind of guy?
I just kind of guy. Well, no, but I made a resolution.
It's a catch-all kind of gal. Fine.
In the commercial because you told me I had to, and I have decided that I'm going to be less wasteful in 2020, whether it's money or plastic or food. That's a good one, right?
Sure.
Okay, what's yours?
I want to get up earlier. I really let that slide in 2019. I started the year getting up at like 6:05 every morning.
What time do you get up now?
As late as possible. As late as possible. On a normal day, I'm out of bed at like 7:20.
Oh, must be nice.
I'm getting like dragged out of bed at 7:20. So I kind of want to go back, get that hour of my day, hour plus back. Remember at the beginning of this year?
Yeah.
I was pulling double duty. I was
That's
in for
true.
the morning show, so we had a 7:30 meeting. So I was getting up at 6 and coming right to work. If I got up at 6 now, I'd have an hour or two to do whatever.
That meeting is at 6:45 now, but you're going to be on the final
That's right.
show on Friday.
I will be on the final
So
show.
all those people out there that missed Miles Udland on Wi-Fi AM, well, your lucky day is Friday. He will be on Wi-Fi AM.
With Melody Hom.
Yeah.
Newly engaged Melody Hom.
Oh
Congrats
my
to
gosh,
Mel.
I was crying.
And Dan Roberts. Do you know, are we on for the whole show? Or are we just doing this part of it? I have to do the whole show?
I usually do Fridays, but I am not having to do that, and it's all you.
I was going to be sick on Friday. Jen Rogers, for regular viewers, Jen Rogers, normal co-host here on the final round, who has been in Machu Picchu for the last couple of days. Her New Year's resolution, which she had said in December, was to learn an instrument in 2020.
That's a good one.
I don't know if it was learn or play, because I feel like she knows how to play from the past, but she's definitely not playing instruments now, so I guess anything would count as learn.
Wow.
So I'm going to get up earlier, and Jen's going to play an instrument, and Heidi's going to be less wasteful. We'll see how long we last with that. All right, Heidi Chung, have a truly and enjoy a truly happy new year.
Oh, gosh.
No free ads,
Oh,
but that one
gosh.
worked. All right, coming up here on the final round, bond king Jeff Gundlach looks back at 10 years of double line capital and where he sees markets headed in 2020. We're back with that right after this. Welcome back to the final round here on Yahoo Finance. Miles Eldon with you in New York. Let's take a look at where the market finished on this final trading day of the month, year, and decade. All three majors finishing higher during a year that saw the S&P rise a little over 28%, the best year for the benchmark index since 2013. Second best performance for the S&P during the 2010s. Well, 2019 marked a 10-year anniversary for DoubleLine Capital. Earlier this month, Yahoo Finance's Julia LaRoche sat down with CEO and founder Jeffrey Gundlach to reflect on 2019 and to discuss what's next for the markets in the year ahead. Take a listen.
2019 looks really strong when you look at global stocks and bonds and gold and Bitcoin and just about everything. But you have to remember that it came off of an extremely arbitrary point. Year-end was a very low point because the fourth quarter of 2018 was incredibly weak. And so if you look at things in a broader context, markets are kind of turning around. I mean, Treasury yields have been at around 2% on the 10-year for a while. The S&P 500 and the Dow Jones have reached new highs, but stocks outside the United States are still below where they were January 26th of 2018. So we're kind of grinding along, and what's really helped 2019, no doubt, was the massive U-turn by the Federal Reserve. It's really hard to believe how things have changed over the last 12 months in terms of the Fed's outlook and their behavior. A year ago, the Fed was in automatic QT, and they said so in the December conference that they would be on automatic pilot QT no matter what the data said. And then the markets tanked. They also said that they were going to have sequential rate hikes in 2019 and 2020, and that changed a few weeks later too because the markets were tanking. And then all of a sudden we went not only into no more quantitative tightening, but in response to the repo markets dust up back on September 17th and some other subsequent dust ups, we see the Fed is kind of doing quantitative easing part 4, but they don't want to call it that. They're kind of using semantics, saying that, well, we're not doing it for long-term interest rates, we're only doing it for overnight money and short-term interest rates, but they're still expanding their balance sheet. And that has driven the market for sure, I think. I think it forestalled the market kind of settling back down in the second half of this year because of the quantitative easing that they've begun. So the markets are at pretty high levels given that GDP has started to look worse. The ISM manufacturing came out today. The only way to characterize the number is terrible. I mean, across the board, we expected to bounce back. Instead, the consensus expected to bounce back. Instead, we got something different. But what's interesting is that the bond market seems to be showing some trouble signs. The dust up in the repo market basically, to me, shows that the Fed has manipulated interest rates to a level that the market really doesn't accept. Because if you can't float overnight money at a level of the Fed funds rate, it means that the natural demand isn't there, which reinforces my thesis that in the next recession, absent the Fed doing massive monetary purchases, interest rates at the long end of the curve would probably go up because of supply problems. I've been talking about this for a long time, that the growth in the national debt is substantially higher than the growth in nominal GDP. It's pretty amazing when you think about it. We talk about how the economy is so good in terms of employment, it's true, but in terms of other things, the economy isn't that good. And if you weren't expanding the national debt at all, if you were just keeping it constant, we would actually have negative nominal GDP right now. So it's kind of a sobering thought that the entire expansion that we have had in recent several quarters is all debt-based. The national debt and the deficit as a percentage of GDP are at levels that historically have been associated with the depths of a recession in terms of a stimulative policy. So I think 2019 has turned out to be one of the greatest, easiest years ever for investors. Just about anything, just throw a dart and you're up 15, 20%, not just the United States, and global stocks as well. I think that the pattern of the United States outperforming the rest of the world has already come to an end. And I think that in the future, what investors should think about is a pattern. I've talked about this chart, which I call the chart of the year, which we take the world and we divide into 4 regions: the United States, Japan, Europe, and emerging markets. And we go back to the 1980s and we just take the major indices from those 4 regions. And it's interesting that in the late 80s, Japan was viewed to be invincible. They were absolutely killing it. The real estate was booming. They were by far the strongest stock market was the Nikkei in the world. And then the recession came in the early 90s, and the Nikkei got completely wiped out. And what's fascinating is here, 30 years later, it still hasn't come close to that high. Then, in the 00s, it was Europe. In the late 90s, it was Europe, with optimism that I think was misguided, but optimism about the euro being potentially a reserve currency, and it was just formulated. It came into being in 1999, and it turned out that Europe was killing it and outperformed every other stock market region of the world. And then the recession came in the early 00s, and the euro stocks got kneecapped, and they've never been back to that level again. Then you had the emerging markets with the dollar being weak in the middle of the 00s and the ascension of China. You had emerging markets were by far the strongest region in stocks in the world. And then when the Great Recession came, they got completely destroyed, and they've never made it back to that level again. So where are we today? Today we have S&P 500 is killing everybody else over the last 10 years, almost 100% outperformance versus most other stock markets. My belief is that that pattern will repeat itself. In other words, when the next recession comes, the United States will get crushed, and it will not make it back to the highs that we've seen, that we're kind of floating around right now, probably for the rest of my career, is what I think is going to happen. Now, my career doesn't have 30 years to go, but it also doesn't have a year or two to go. So I think that there's going to be a rotation into non-U.S. stocks. Like the dollar is going to be weak. The dollar has been very stable this year. It's really remarkable. The Dixie index, the DXY, started this year at 96.25, and today it's a 97 handle. So it's been remarkably stable. I think in the next recession, the dollar will fall because of the deficit problem in the United States, and that investors will be better served to own foreign stock markets instead of the U.S. stock market in dealing with the next recession.
All right, coming up here on the final round, he's a beast at the gym. So how does CrossFit champion Matt Fraser refuel and stay fueled, ready to go for his workouts? We hear the secrets of his diet and how you can get on board with his program. We're coming up with that right after this. Four-time CrossFit Games champ Matt Fraser has a pretty strict workout and diet regimen. One of the people responsible for his nutrition is his fiance, Sammy Moniz, who runs the Feeding the Frasers Instagram page. We recently had the chance to talk to the two of them about the page's success.
Really remarkable. I'm really surprised how many people are interested in what one person eats, which is really cool for us. It was kind of happened by an accident. I started the page for myself just to keep track of what I was doing and using it as almost like a food photo journal. And so I'd be doing if it was just for me, but it's really cool that people are latching onto it.
How important is what you eat to your performance? Because if I worked out as much as you work out, I would be eating anything I wanted, and it would be like junk food.
Yeah, that's how it was before I met Sammy. I ate pizza, Chinese food, and lots of ice cream, and it showed. So yeah, when we started dating, and she has a love for cooking, and we were able to tailor my diet, and it's a lot easier that I'm able to just focus on training. I don't have to worry about food prep and, grocery shopping, cleaning, all that stuff. Sammy's taking care of everything, and I have to eat a lot. I'm always on track, aiming for 9,000 calories a day. It's a pretty big task, and it requires a lot of cooking. I'm not too close to the 9,000, but it's a part-time job, the amount I have to eat.
It's a part-time job cooking for that.
9,000 calories.
And Sammy, when I go through the recipes, they're pretty healthy, but it's not like strict keto. It's not a bunch of stuff that you look at, you're like, this is not really food. I guess in finding that balance between things that are healthy but still like taste good, what are some of the ingredients that you find yourself going back to time and again?
Yeah, we stick to pretty basic food, a lot of rice, meats and vegetables. So raw vegetables, roasted vegetables, and that's pretty much the basis of it. I think when we're in season, it's definitely much more simpler, where it's just, here's your big pile of rice, here's a little bit of meat, and here's some veggies to kind of help fill it. And then out of season, of course there's the brownies and some of the treats, but those all have a time and place. And like we say, a treat is a treat. If you're having it all the time, that's just part of your diet then, right? So it's not much of a treat.
And then what's kind of the mix between stuff that Matt's saying, we've had this, can we have this again, versus things that you've seen that you want to make? Obviously at 9,000 calories a day,
all the time,
there's going to be a lot of opportunities there.
Well, the great thing is he also kind of uses the page the same way as like a little menu of, hey, do we have anything to make this tonight? And that's the good thing about it.
If she's doing a grocery run, she's like, hey, is there anything you want this week? I'll take a quick look through the page for just a reminder. You see the picture of one of your favorite meals, and it's like, oh, can you make the brisket? And then she puts that on the list, and a couple days later, it shows up.
Yep. Hearing brisket, I'm thinking that the answer to this is no, but we talk about Beyond Meat a lot. That's been a really hot stock this year. It's a plant-based protein. Do you like that? Have you experimented with that at all?
With plant-based?
Yeah.
No, I grew up with a vegan vegetarian, and so I've tried tofurkey and the fake bacon, and if someone wants to do it, good for them, not for me. I eat a lot of meat.
Yeah, for us, it's just the importance of the quality of the ingredients. So we make sure that we source our meats from, organic, grass-fed. I prefer regenerative farms, knowing that it's, good for the soil. So I think for us, it's important about the quality of the ingredient, not necessarily whether it's keto or paleo or, conforming to a particular diet.
Now, obviously, the Feeding the Frasers page is kind of like its own little business, but it certainly speaks to the diet that, Matt wants to stick to as an athlete. You guys are on the road a lot. You've been on the road for, I think, 3 weeks in a row now, 2 weeks in a row, still more to come. So there's a practicality to this as well. What do you do when you're on the road to try to keep something like that diet together? Even if you can't create the meal that's Insta-worthy, you can at least eat something that isn't just garbage.
Yeah, it's definitely challenging. It's very easy. There is food that is very easily accessible. It's just not necessarily always good food. So we just try to stick to, if it's something we would eat at home, then it's something that we'll get on the road. So once again, it's a lot of Thai food, and it's rice, it's meats, it's vegetables, and it's pretty simple stuff. Flavorful, but also, it's easy to find high quality when you're looking for it. But you do have to look for it.
I think another big thing is we schedule our travel throughout the year around training and competing. So it's like, I know for the big competition 4 to 5 months before that competition, I'm not leaving my house. I go from I train at home and then the gym right down the road. I'm not getting on an airplane. I'm not like sleeping in a hotel or being away from the setup that I've built for my ideal training scenario. So like with this trip, we're on the road for I think the better part of a month, and you know, we finished up the first phase of competition. It's okay to kind of kick the feet up for a little bit and travel around.
Yeah.
You're basically a small business, and you're working with your partner. It's
kind of a big business.
In it. It's a it's not Apple, but it's a medium-sized business.
Mom and pop shop.
Yeah, you are. My parents work together, and it has challenges sometimes. Like, what's your best advice to people who are working with their partner?
I mean, I don't think we really consider what we do work. You know, so actually right now, Sammy is a manager and agent for basically all the top athletes in CrossFit. That's her full-time job right now.
So you're just a client.
Well,
just another client.
Yeah.
well, so, you know, she'll do some of my scheduling and that type of stuff, but when it comes to contract negotiations, we kind of keep church and state separate. So I have my other friend that originally was doing it. He still manages mine, just because we didn't want to take that risk of a contract negotiation going sour and then it bringing resentment in the house. But I mean, in terms of the cooking and me competing, it's never even really been an issue that crossed our minds.
We see it all the time. You know, we talk about throughout the day how lucky we are that we get to spend so much time together. You know, there'll be days where I'm like, oh, I missed you. I feel like I haven't seen you all day. And he's like, Sammy, I've been home. I've been working out in the garage.
We both work from home. We're both here all day.
Yeah, we see each other all the time. So we're super fortunate that, you know, we get the chance to work from home essentially and get to spend so much time together.
All right, we have obviously Thanksgiving coming up next week. As you look back at the year and what things have been for you, what do you find yourself, Sammy, most thankful for 2019?
Oh my goodness, in 2019, it was a big year this year. I think for you know, obviously Matt getting his 4th title, that was awesome and such a huge accomplishment for him, for our family. And just super excited for what Feeding the Frasers has grown into. It's kind of crazy that's, you know, it's its own thing now.
For myself, you know, we try to be thankful for what we have every day. Like, we literally sit down and kind of look at where our lives were 5 years ago and like, how did all of this happen? You know, just the travel, the friendships, the people we've met on the road. But, you know, I just love my life with Sammy. I know it sounds cliche, but, you know, we both get to work from home. We're both happy and healthy. I'm just glad that we both have a good work ethic and we both have something to apply it to.
All right, and coming up here in the final round, Riverfront's chief strategist, Chris Constantinos, will tell us how his firm is deploying its $8 billion in assets under management in the new year. We're back with that conversation right after this. Today was the last trading day of 2019, and earlier today we spoke with Riverfront Investment Group's Chris Constantinos to see what he's watching in markets as we head into the new decade.
If you look at the setup for 2020, I think the knee-jerk reaction for any of us that have been involved in this craziness that has been stock markets over the past 20 years is we just had a great year, so bad things must be on the horizon, right? We're all sort of still shell-shocked from two of the worst bear markets in history over the last 20 years. But if you actually look at the historical data, history's on your side for 2020. First, it's an election year, which tends to be better than average returns in the market if you look back over the last century. You also have technical analysis on your side. Momentum in the market tends to get more momentum. There is that historical momentum effect. And by the way, the breadth of the market is also improving. If you look globally, that technical momentum is improving in a lot of areas outside the United States, which I think speaks well for the global recovery. You have a year, which is kind of astounding to me. 2019 was the year of negative equity net fund flows. If you think back to the late 90s, and you think about how big stock net inflows were, that gives you kind of a window into the level of complacency and exuberance, if you will, of that era. You're not seeing that today. You're seeing huge flows into bonds over the last decade and over the last 12 months, frankly, and outflows out of stocks, which is astounding to me in a 30% plus S&P year. And then you have dividend yields above the level of 10-year government bonds and all the important parts, the major parts of the world. I think that all bodes pretty well for stock returns in 2020.
Jared Blickry here, and I agree with your analysis, but I got to be a contrarian here. How does your bullish case, which seems to be the base case here, how does that fall apart? What comes out of left field? Anything on your horizon?
Sure. Well, there's always uncertainties. This is why there is an equity risk premium in the first place for us to harvest. The big uncertainties to me, certainly trade, and I don't think I'm alone in this. Trade is a major X factor. The relationship between the world's largest and second largest economies matters for everywhere, everyone, everything. I would say that both U.S. and China, I think it's in both of their best interests to put trade, to take it from page A1 of the journal to B7 is in both countries' best interest for 2020. And I think we're seeing signs that that's happening. I'm not saying the trade war is over. I'm not saying that these two ideological polar opposites have somehow, reconciled all that in 2020. But I do think that it's in both parties' best interest to at least have a ceasefire, if you will. And I think we're in the early stages of that happening. The other big X factor, I think, has to do with European political uncertainty. And this is something we've been dealing with, frankly, for much of the past decade, right? Probably starting in 2011. And it's still there. I mean, I think if you look at Brexit in the UK, I think the probabilities of major left tail risk there have decreased significantly, particularly with the Conservative victory last month. But there's still some tail risks that Brexit goes off the rails. You still have a caretaker government in Italy. You have Spain. The political situation is still very fractious there. Germany, somewhat uncertain. So, I think political tail risk is still going to be with us in 2020 and might lead to some buying opportunities as we move throughout the year as well.
All right, and Chris, just thinking about areas you can put your money to work, what do you like right now? What's attractive at these levels as you look to put money to work in the new year?
Yeah, sure. So starting with the U.S., where we do a lot of sector work, we're still bullish on technology. And I know I've appeared on this program before talking about tech, but I want to be really clear. There's areas of tech, and it's the boring, unsexy tech that people don't really like to talk about. But there's companies that trade at or below market multiples that throw off tons of free cash flow, increasingly in this day and age pay growing dividends. Those are the types of profiles of companies we like. They're not necessarily the sexiest tech companies, but you look in the software and services space, you'll find a lot of them. We think that's one durable theme. We think that theme can work whether it's a growth-oriented market or a value-oriented market in 2020. There's certain parts of healthcare, talking about contrarian stuff. Obviously, the healthcare space in general is on edge given the 2020 presidential election in the U.S. We think healthcare is priced for an adverse outcome in the 2020 elections. So should you get something different than that, we think healthcare, there's significant upside in places like medical devices. In general, companies that throw off cash and pay their shareholders back in dividends and do so in a consistent fashion, I still think that's going to be in style in 2020. I think that's a durable theme, regardless of the backdrop. And also logistics companies. There's some very interesting logistics plays, particularly some of the consumer-oriented ones. So that's where we're looking at in the U.S. Overseas, this is a bigger X factor here, given the fact that their economic backdrop outside the U.S. is a little bit more uncertain, but we still like Japan as a highly contrarian place for risk-tolerant investors to put their money. And emerging markets, we're neutral there, but should the global backdrop trend more towards our bull case moving through 2020, you'll likely, that's a place where you could see significant upside.
All right, coming up next on the final round, we'll have what you missed today here on Yahoo Finance, and we're back right after this. All right, it's time now for all the best moments that you missed today right here on Yahoo Finance.
I think that there's definitely going to be some value hunting occurring here as we go into the new year, and rightly so. I think with specifically Uber and Lyft, there's a lot of uncertainty around these companies in the short term. I mean, this new law really kind of implies a lot of changes for the whole business model. I'm sure they'll work something out, but at the same time, that uncertainty is going to weigh on the stock.
Last week, you printed the Dow 29,000 hats.
Yeah, I guess I may have jumped the gun on that.
There was hope we would hit it by today.
I was hopeful. I guess I was wrong.
It's a pyramid scheme. You only make money based on people who enter after you. It has no real utility. It's a solution in search of a problem, and it still hasn't found a problem to solve.
Well, I think this will be the golden age of banks and technology. They've dated, they've broken up, they went their own ways with risky behavior, they've reconciled, and now we think they're engaged to have a more permanent relationship.
This is a story that's going to continue for quite a long time. This is just a phase one deal. It's quite positive. You get the tariffs that weren't put into place. You get some tariffs rolled back. There's a framework for potential agreements down the road. But this is a cloud that's going to hang over markets for quite some time.
With the sector now representing about 4.5% of the weight in the S&P 500, and the idea that fossil fuels are not going away anytime soon, in an environment where, if anything, politicians are creating upside risk to economies in 2020,